named in the bill include China, Azerbaijan, Hungary and Slovakia. India is the second largest buyer of the Russian oil on that list. For India, this is not new. Remember, Washington has been threatening India with tariffs over its purchases of Russian oil for some time now. The US previously penalized India with additional tariffs in July 2025 before withdrawing them in February this year. And the latest data just goes on to show how much India has shifted towards Russian crude. According to Reuters, India's oil imports from West Asia fell by about 27% to 1.55 million barrels per day between April and June and the first quarter of this fiscal year. In contrast, imports from Russia rose 8.3% to 2.26 million barrels a day. Now, last month, India's Russian oil imports surged to a record 2.64 million barrels a day. That was up nearly 37% from May and accounted for about half of India's total oil imports of 5.24 million barrels a day.
It's a Tuesday morning. We are back with Power Breakfast right here on CNBC TV 18 in the Mumbai News Centre. I am Hormas Fatakia. With me as always, Rashna Dhanrajani. Rashna, good morning to you.
Good morning to you as well, Hormas.
Well, let's start off with the top headlines then that we are tracking this morning. US President Donald Trump claims that the Strait of Hormuz is still open and instead seeks compensation from Iran for casualties in the war. Meanwhile, Tehran has said that the Strait of Hormuz will not be safe until the US ends the blockade of the Iranian ports.
Wall Street ends lower in overnight session. The Nasdaq and S&P 500 closed lower, led by declines in Intel and other chip makers. Asian markets are mixed in early trade.
Oil prices see sharp gains, rising to near one-week highs on fading hopes of a deal between Iran and the US. The Brent crude hovers around $88 a barrel mark. Gold prices, meanwhile, have risen to the highest level in 2 months.
Wipro will exit benchmark Nifty while BSE will enter. These changes will take effect from September 30, which may trigger passive fund flows into BSE.
And the government says there is no policy barring airport operators from holding substantial equity in commercial airlines. The Minister of State for Aviation confirms that the Airports Authority of India has received a letter from the Adani Group seeking waiver of contractual restrictions that would allow entry into the airline business. The government is yet to examine the matter.
All right, those were the top headlines of this morning, but let's take a look at Asia. Now, Asia is trading thin and mixed this morning, but Taiwan is where we start. Now, the index is in the red, but just about. Chip names are setting the tone for the region. As you can see, 0.5% down for Taiwan. The Hang Seng is in the green, however, but again, nothing big there as well, almost 0.5%. Again, tech and property names seem to be doing the heavy lifting. Now, no Nikkei on the board today because Japan is shut for Mountain Day, and that takes Asia's biggest market out of the picture, but Korea is the one to watch. The Kospi is in the green for now, but again, nothing big there as well. Semis are expected to be under pressure after Intel announced a $15 billion share sale overnight. Now, that does not confine itself to just Kospi, but reads across the whole Asian chip complex. The US handover. Now, Wall Street slipped off its record close. Brent pushing back above $84, with Donald Trump saying the Strait of Hormuz is open, but is it really is the question. What does it mean for us? Now, GIFT Nifty is slightly above 24,600 level, with Nifty implied open down about 50 points, pointing to a lower start for us in trade this morning. Hormaz.
And I must say, I love these holidays in Japan. Mountain Day, Sports Day, all sorts of days. The Nikkei is shut for trade today, but the implied open is suggesting a minor downtick in today's session to start off the weekly expiry, of course, for the Nifty contracts. We are starting off with updates from West Asia. Then US President Donald Trump says that the US will seek restitution for all of the people that Iran has killed in many conflicts. Now, this comes after Tehran demanded payment for the damage caused by the US and Israel during this 6-month-long war. Now, speaking to reporters later, he said that a massive escalation is still on the table, also adding that the US military cleared the Strait of Hormuz of mines placed by Iran. Listen.
You said this last round of talks was Iran's last chance before decapitation. So what now? What comes next?
You'll find out.
Are you still, are massive escalation, is that still on the table?
Well, we have that, certainly that ability if we want to do that. Yeah, you'll find out.
You said you're low-keying it with them, that you're semi-negotiating. What exactly does that mean?
Well, they asked for reparations, you might say, or they asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period. It was $52,000 a month and a half ago. So now what is it? So if there's damages to be paid, I think Iran should pay those damages. It's open now. Look, the only one that has control of the Strait of Hormuz right now is the United States Navy. We have a blockade that's been infallible. It's a steel wall. And we let people in that we want to let in, and those people come in, and they've been coming in and they're going out. So it's actually open now. We do not let them go into Iran. They're not admitted into the Strait to go to Iran. But it's open for others. Now, a little bit complex because they will, on occasion, drop a mine, and we find the mines. You know, we've mine swept the entire Strait, as you probably maybe heard, maybe you didn't hear, but we control the Strait 100%. Now, can they make trouble? Yeah, they can make trouble. But they're broke. They have no money. You know, Iran is broke, totally broke.
Now, Iran's foreign ministry spokesperson Ismail Baghei pushed back against the US Treasury Secretary's claim of suffocating Iran through sanctions, saying that the remarks were evidence of America's compulsive addiction to sanctions. Meanwhile, Iran's Supreme Leader Mustafa Khamenei has issued decrees appointing 6 senior commanders to roles within the armed forces, the IRGC and the Basij Domestic Security Force.
All right, Hormaz, I think the main question for this morning is going to be regarding the Strait of Hormuz. While Trump is saying it's open, but the blockade is infallible, like he said. But now, how will these overnight cues impact our Indian markets? We have our research team joining in. And first up is Vivek to get us all the market cues we need to watch out for this morning. Good morning, Vivek.
Well, good morning to you too, Rachna. Now, when you're looking at this morning, quite a few tepid overnight cues is what we're looking at. The U.S. markets ended largely lower, but not too much in the red. Oil prices higher, as you just heard. The kind of limbo that the Strait of Hormuz currently in. Brent is now trading about the $87 a barrel mark. In yesterday's trading session, it was largely a steady session for the Indian markets, ended largely higher, and especially when you're looking at the mid-cap index, it outperformed. Top movers in yesterday's trading session on the back of brokerage upgrades, on the back of news flow and earnings, were names like Paytm, Bharat Foods, Hitachi Energy, as well as Info Edge. And Asian markets and GIFT Nifty today are indicating a bit of a subdued start. Now, what are the key cues that we will be watching out for in today's trading session? Remember, the NSE Index Subcommittee met last evening, and they've gone ahead and decided that BSE will replace Wipro in the Nifty 50 effective September 30th, 2026. Today we will get the July AMFI data as well. Apar Industries has gone ahead and launched a 2,500 crore QIP. Expect results reaction from the following names like Gland Pharma, Kolte Patil, Bosch, KEC International. All of them will react to results, and a few important results today that are lined up include names like Siemens India, NBCC, Bata, Zydus Life, PI Industries. All of these stocks expect reactions once the earnings does come out during the course of the session.
Not to forget MRF, the most important result of the day. Vivek, thank you for that update there. Lots of results lined up as we count down to the end of this quarter's earnings season. But implied open still suggesting around about a 50-point downtick. What are the other stocks that should be on your radar? Ria is here with that complete list. Ria, morning.
Well, good morning. Let's take a look at all the stocks that will be in focus primarily on the back of the Q1 results. First up is Vodafone Idea, with the net subscriber additions going up by 0.3 million in the first quarter, marking the first positive quarter of sequential subscriber additions since the merger took place. For Bosch, the revenue has seen an increase of 22% compared to the previous year, with margins also going up to 14% compared to nearly 13.5% in Q1 of last year. For Lloyds Metal as well, we have seen a good quarter this time around, driven by strong operating leverage as well as higher iron ore EC limits, with the revenue going up by nearly 210% and margins also expanding to nearly 38% in this quarter. For Gland Pharma, we have seen the net profit increasing by nearly 47% compared to the previous year. Revenue also going up by nearly 20% to 1,800 crores for Q1. For KEC, on the other hand, net profit has tanked by nearly 42% to 73 crores this time around, with the revenue remaining unchanged at nearly 5,000 crores thereabout. For Z Entertainment, this time around, Z5 has turned EBITDA positive, with FIFA driving strong engagement, but the high investments have weighed heavily on margins, with the margins tanking to nearly 4% in this quarter versus nearly 13% compared to Q1 of last year. For Idea Forge, we have seen the revenue seeing a strong increase to nearly 69 crores versus 13 crores in Q1 of last year. Order book, however, has moderated to 257 crores versus 314 crores at the end of FY26. For Apar Industries, sources say that Apar Industries has launched a QIP for a fundraise of nearly 2,500 crores, with the indicative price being set at a nearly 10% discount to the current market price. So that will be in focus. And the last stock on our list today is IRB Infra, with the gross toll collection going up by nearly 26% compared to the previous year to nearly 800 crores in the month of July.
All right. Thank you so much, Ria, for that. A long list of stocks to watch this morning. But like we said earlier, all eyes are on Brent, especially with everything that's surrounding the Strait of Hormuz. To get us more on that and all the updates from the commodity space, we have Manisha Gupta joining us. Good morning, Manisha.
Morning, Rachna. Thank you for that. I'll start with the crude oil prices, as you suggested, and we have seen 5% of gains in the overnight market. And with that, we are trading very close to the $90 mark yet again. There is uncertainty over a potential deal between the U.S. and Iran, with both of these countries now demanding compensation due to war concerns, and then U.S. also indicating on more economic pressure on Iran that could go ahead and intensify. So clearly things are far from getting a resolution therein. And then apart from that, Iran and Oman are yet to reach an agreement to reopen the Strait of Hormuz, and that continues to add premium in case of prices. Today is the fourth straight day when the crude prices are trading in the positive there. But there also is a very sharp surge that we are looking at in precious metals. So gold prices are trading at a 10-week highs, silver at a 7-week highs, platinum prices at a 2-month highs. Well, there is a strong buying momentum, investor demand. Markets are looking at very weak U.S. jobs data and the decline in U.S. dollar index that's trading below 100. All of that has been very, very supportive in precious metal prices. So everything in metals clearly glittering.
Oh, indeed. glittering for sure. Gold prices are the ones that are ones to watch out for. Manisha, thank you for that update there. Take a short break. All the action from Wall Street on the other side. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, in the U.S. market, Wall Street ended with mild losses on Monday. The S&P 500 ended with a negative bias, and the Nasdaq Composite lost 0.3%, while Dow Jones was just below the flat line. Now, investor sentiment was pressured by renewed uncertainty over efforts to end the U.S.-Iran conflict and reopen the Strait of Hormuz. Now, let's get you some opinion from Wharton's Jeremy Seigel and NEC Director Kevin Hassett on U.S. inflation concerns and the Fed rate path ahead. Listen in.
It's wages after inflation. That's real purchasing power. And really the most disappointing data I saw on Friday was what wages were up. And they were only up 3.2%. Now on Wednesday, we're going to get the CPI. That's expected to be up 3.4. So what does that mean? Workers are losing to inflation. Now, what's the biggest source of workers gaining to inflation? And that is productivity growth. And frankly, productivity growth in the last 3 quarters has been very disappointing. We need to ramp that up. And there are some positive signs for this quarter, but the last 3 quarters have been below the 15-year average. And that's one reason why I think a lot of the public is not happy.
The consensus was it would be plus 88,000, which I think is consistent with everything else we've seen, which means it's a pretty strong economy. And the reason it got negative was there was a big decline in government workers and people who were leaving hospitality because of the World Cup. And so if you think it's an 88,000 number, then you'd have to say that all the other signals like booming investment, booming wages, incredible factory construction, 85,000 construction workers now building factories when it was about zero when President Trump took office. All of that says really strong economy, but that this is all supply side stuff, which should increase supply, put downward pressure on prices. It's not a Phillips curve kind of thing where there's government throwing money at things and that's creating jobs. And so if I were at the Fed right now, I would either hold steady or cut rates because there's so much supply side momentum.
Take a short break. All the updates from the world of AI on the other side. Stay tuned. Welcome back. Now, the government says that there is no policy barring airport operators from holding substantial equity in commercial airlines. The Civil Aviation Minister confirmed that the Airport Authority of India has received a letter from the Adani Group seeking waiver of contractual restrictions allowing entry into the airline business. The government's response came after a written query by a Member of Parliament stating that no decision has been taken so far. Now, moving on then, the United States Senate has passed the Russia sanctions bill, which could result in a 100% tariff on India due to Russian oil imports. A senior Commerce Ministry official has said that India is closely monitoring the developments and continues to remain engaged with the United States on a trade deal. Abhimanyu is here with all of those details. Abhimanyu.
Several developments have transpired in the United States on the political front and also on the possibility of a levy of more tariffs in near future. Now, a senior Commerce Ministry official has indicated that India is closely watching all developments and both the countries remain engaged on the issue of trade. Now, it remains to be seen how early both the sides are going to announce the BTA, the first tranche of the BTA, which already had witnessed a joint statement which was issued earlier this year. Both the sides have also indicated that 99% 9% of the talks have already been completed. What has been cited by India's side so far that India is seeking preferential tariff access compared to several of its competitors, several other exporters in the US market. Now, currently, India's exports to the US are facing 10% plus MFN tariffs, which enjoy a certain advantage of 2.5% compared to 43 other countries which are facing 12.5% plus MFN tariffs, courtesy the Section 301 probe, which already has been completed. Now, it remains to be seen what other instruments are going to be devised by the United States, not just to levy tariffs, but also possibly to provide preferential tariff access to India's exports into the US market, which will possibly form the cornerstone of a trade pact between both the sides.
Abhimanyu, thank you for those updates there. Over to Rachna now, who has hopped over to the wall to get you the AI Pulse, your daily wrap of all the world from the AI.
Well, first up is NVIDIA, that's trying to turn AI chips into Wall Street's newest asset class. The company has signed MOUs with Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs and KKR. The aim is to mobilize over $500 billion in third-party capital to fund data centers and NVIDIA hardware without customers tapping their own balance sheets. CEO Jensen Huang told CNBC that this is the first time chips have become an investable asset class. NVIDIA shares fell around 3%, with analysts flagging circular financing concerns. But listen into what Jensen Huang had to say.
This is really the first time that technology chips have become an investable asset class. This is a very big concept. It's a big concept because the computers, these systems are not like our PCs or like our phones. These are revenue-generating assets now. They're productive, they're long-lived, they're fungible, they're flexible. You can use it for all kinds of different things. And so you have the opportunity to support a very large ecosystem of off-takers and NVIDIA developers and AI clouds and AI partners and enterprises all around the world. And it's incredibly revenue generating.
Well, then there is Intel that's cashing in on its turnaround rally. The chipmaker has launched a $15 billion share sale to fund its foundry build-out, with underwriters holding an option on $2.25 billion more. Price and share count are not yet set. Microsoft will unveil its Maya 300 AI chip this fall, possibly in September. As per the information, it is in talks with TSMC for over 300,000 units for 2027 delivery. Then there's OpenAI that has completed a roughly $7 billion employee share sale ahead of a potential listing. The valuation held at $852 billion, unchanged from March. OpenAI bought the stock back itself rather than bringing in outside investors. On security, OpenAI has split its Daybreak program into 2 tiers and launched GPT 5.6 Cyber for vetted researchers. Hardware security keys become mandatory from September 1, and the timing here is pointed because we saw 3 major models from top frontier AI companies going rogue. And amid all that, ABC Australia has reported that an AI agent found an authorization flaw in a gym's booking system and cancelled another customer's reservation to move its owner up the wait list. It was running on Claude Opus 4.6, which is a February release. In the US, the Ninth Circuit has declined to hear a Section 230 appeal as premature, leaving thousands of addiction suits against Meta, TikTok, Snap and Google to proceed. That's all that we have from the world of AI for now, but we'll get you more updates through the day.
Rachna, thank you for that update there. And in a tragic incident, an earthquake of 7.4 magnitude has rattled Colombia, killing more than 100 people and damaging over 1,500 residential buildings. Death toll continues to mount as authorities search collapsed buildings. The catastrophe was recorded as the strongest earthquake in the 21st century, with 21 aftershocks and possibility of additional tremors. That we call time on this edition of Power Breakfast from Rachna and me. Thank you for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Morning, you're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. Slightly tougher start today with crude prices rising to about $88 per barrel and the US 10-year yield back at 4.7. Markets have been range bound, at least at the index level, but the action has been in individual stocks.
That's right, and today is the weekly expiry for the Nifty, so maybe some volatility creeps in, but otherwise we have been very, very range bound for the last many trading sessions. But Prashant, I think let's take it from the top.
Absolutely. Oil's jumped, and I think the reasons we kind of knew, it's just that we don't know, or rather we never know, when prices start to react. Sometimes it's almost immediately, sometimes it's not. So we may wonder what is new, right? Why are oil prices now closer to 88? Because, I mean, to my mind, the reading through is pretty much, except of course one thing, everything else is same. So this basically hopes that the Strait of Hormuz is going to reopen in a quick way. Perhaps that hope faded a little bit. And this is the reason, this is the new thing. Trump essentially, in response to demands by Iran, which we put out extensively yesterday morning, same time, in terms of what Iran wants, Trump essentially saying, well, we've heard them, here are our demands. So he's essentially saying that for all the atrocities committed by Iran, for US service personnel killed, for all the protesters killed in Iran, we are demanding, we want Iran to pay a compensation, reparations, whatever you want to call it, right? So it's kind of, demands for reparation on this side, demand for reparations on the other side, and it's a deadlock. Iran, and just to repeat what I put out yesterday, Iran had earlier tied the issue of reparations directly to reopening of the Strait of Hormuz. Essentially, bunch of things, but basically damages for damage from the war, unfreezing of Iranian assets straight up. There was, withdrawal of troops, American troops from the region, and a bunch of other things as well. So this is what we had yesterday, and now, of course, Trump has got his own demands. President Trump has got his own demands. And I think this is the reason why markets kind of repricing the probability higher that this is going to perhaps drag on a little bit more. Well, the other side, you had US 10-year yields, which also shot up 6 basis points, about 4.7. And there's basically two reasons here. One, of course, is the Fed official essentially saying that I think now is the time for us to start acting. Basically, actually even going to so far as to say that one hike perhaps is not going to do anything. We need a bunch, but I don't want to put a number to it. And I think that got a fair bit of play, and people sort of focusing on it. The other reason why bond yields jumped is because of the heavy corporate issuance, bond issuance. So some $28 billion raised via issuances across 19 companies. That also kind of putting the spotlight on everything which has been happening in that part of the market with financing for AI, etc. I mean, NVIDIA's Jensen Huang sitting down with the top US companies, top US financial institutions, tying in money directly, and we'll play some sound bites out. But that was, of course, on CNBC last evening. So that remains a talking point, no doubt. US equities are down, but down small. Nasdaq was down only about 1/3%, and so not this way, that way. For us, of course, what is material is not this, but of course the move in yields and of course the jump in oil prices. I think those are more material than 1/3% loss on the Nasdaq. I'll just tie in the levels here. There's not very much new because we've been in a very consolidatory kind of zone for the last several days. So in this consolidation zone, so 24,500 on the downside, 24,475 as we've put out for the last 2-3 days now, actually more. And resistance is about 24,775. And once that gets taken out, we'll talk about higher levels. But about 24,980 is the second level. GIFT Nifty gives you a quick sense of how we're likely to start. And we'll pick it up from there. It's about 47 odd points lower, implied open. Nigel is here. He's walked across with the F&O cues positioning and more. Nigel, take it away.
Well, going by the GIFT Nifty, we're bracing for a bit of a softer start because Brent crude prices have spiked. So obviously you get some kind of reaction on that front, but it's still at very, very tolerable levels. Well, the Nifty has gone through a phase of consolidation. And if you look at it, in the last 4 trading sessions, we have been in a broad 200-point range. Just take a look at that. And if you extend it to, say, 6 trading sessions, then we have been in a 250-point range. Well, that's telling you the kind of consolidation, the sideways moves that we have seen. It appears just in the near term, we're in this broader band of around 450 to around 500 points. And a break of either which direction will give us further direction from here on. Well, in terms of flows, they were mixed in yesterday's trading session. The FIs were buyers, the DIs were mild sellers in trade. Moving to the FI action, the F&O market, though, they added some shorts on the index. The short positioning continues at around that 87% or thereabouts. They also went ahead and they added some mild shorts on stock futures as well. While on the option side, they wrote more puts while they unwound some of the calls that were written earlier. So if you look at all those data points, well, you're not getting any big direction. It appears like a mixed bag coming in from the FIs in the F&O market. But today is the weekly expiry. So we'll take a look at the nearest possible strikes. The 24,600 call, well, yesterday it added close to around 27 lakh shares. The premium out there around 78 rupees. While the other one is the 24,500 put, that added close to around 40 lakh shares. With the premium in that vicinity of around 35 to around 40 rupees or thereabouts. Just looking at the options data, looking at the recent highs and lows that we have seen, you get a broad range just in the near term. So on the upside, where that 200 EMA comes in at around the 24,750, that becomes a bit of a resistance mark. While support comes in at around 24,450. That's for today's trading session going by the options data. A couple of stocks that I'll be tracking. We have SAIL that's moved into the F&O band. So we'll keep an eye out on that particular stock. There is some buzz that probably there will be some fundraise. We don't know whether or not that's going to happen. But for the time being, that one's moved into the ban. And there are a couple of stocks, as I alerted yesterday, could probably come out of the F&O ban. That's what's happened, both on LIC, it's finally come out of the F&O ban, and Keynes as well. So maybe keep an eye out on these stocks as well. Consolidation for the last few days. I guess today, the last 60 minutes will add some spice to the Nifty.
Thank you very much for that. Let's get you the latest then, the updates that are coming through from West Asia. While there is still no progress of a possible Iran-Oman or Iran-US agreement, Iran says that US must lift its naval blockade before the Strait of Hormuz can reopen, which is why the stalemate is hurting sentiment and pushing up crude prices. At the same time, Iran-Oman bilateral talks continue, but now Trump has raised the compensation issue. So US President Donald Trump said US will seek restitution for all the people that Iran has killed in many conflicts after Tehran demanded payment for damage caused by the US and Israel during the months-long war. Speaking to reporters later, he said a massive escalation is still on the table. He also added that the US military cleared the Strait of Hormuz mines placed by Iran. Listen in.
You said this last round of talks was Iran's last chance before decapitation. So what now? What comes next?
You'll find out.
Are you still, are massive escalation, is that still on the table?
Well, we have that, certainly that ability if we want to do that. Yeah, you'll find out.
You said you're low-keying it with them, that you're semi-negotiating. What exactly does that mean?
Well, they asked for reparations, you might say, or they asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period. It was $52,000 a month and a half ago. So now what is it? So if there's damages to be paid, I think Iran should pay those damages. It's open now. Look, the only one that has control of the Strait of Hormuz right now is the United States Navy. We have a blockade that's been infallible. It's a steel wall. And we let people in that we want to let in, and those people come in, and they've been coming in and they're going out. So it's actually open now. We do not let them go into Iran. They're not admitted into the strait to go to Iran. But it's open for others. Now, a little bit complex because they will, on occasion, drop a mine, and we find the mines. You know, we've mine swept the entire strait, as you probably maybe heard, maybe you didn't hear. But we control the strait 100%. Now, can they make trouble? Yeah, they can make trouble. But they're broke. They have no money. You know, Iran is broke, totally broke.
Richard Harris, Chief Executive at Port Shelter Investment Management, is now joining us on the show. Richard, so much to talk about. But let me begin with the massive $500 billion AI infrastructure deal that NVIDIA has struck with the who's who of Wall Street managers. We're talking about Brookfield, KKR, Apollo, Goldman Sachs, and two others, 6 of them in all. What are the implications of this? Are we going to see crowding out of corporate borrowers as this $500 billion comes into the market? Is this one of the reasons why we also saw the pressure on the US 10-year yield? And what are the implications of this massive AI infrastructure deal that's been struck?
Well, I really think what we're seeing is an enormous increase in liquidity all around, where we're getting new players in the market that we never really had before. Typically it was banks or investment banks raising money, but now we have corporates that are the size of countries, large countries that can actually raise substantial sums of money themselves, often cheaper than sovereigns. And they're really using it to chase this AI bubble that we're seeing. So it's not really surprising. There's this fear of missing out, I think, that's going right through the market now. It's affecting professionals as well. We're just seeing an enormous creation of debt that's driving this whole liquidity bubble that we're seeing at the moment.
Okay, and for the Indian markets now, the turf is sort of muddied with rising bond yields, crude back above, closer to $90 per barrel. What is the view on India sitting there?
Well, I think it's not as easy as it was. Obviously, India has a lot of what now seem to be old economy industries, things like some of the outsourcing, call centers, these kind of things. So India, I think, is subject to some of these AI attacks. But what does seem to be interesting is even though people are trying to save money by using AI and reducing labor, there seems to be no real reduction of labor. People still seem to need people. Now, I think the jury's still out in terms of, are we seeing jobs moving from relatively high-paid roles such as coding, which AI seems to be able to do, at least on the simpler side, into jobs that perhaps are not as well paid in education, in health. Jobs are coming out of manufacturing in the US and moving into some of these service industries. So we're not really seeing a reduction in jobs, but I think we are seeing quite a big shift in the kind of roles that we're seeing. So AI is affecting that around the world. And I think India, because it does have a lot of jobs in those sort of areas, I think obviously is, we have to have the jury still out, but I think it's obviously subject to some of these issues.
All right. Hi, Richard. Good to see you in. Richard, for the Indian markets, what was weighing for the last many, many months was the FI flows. They continue to sell lock, stock and barrel here. However, in the last month or so, we're seeing a trickle coming in. What's the kind of feedback you're getting with regard to the Indian markets, particularly in the pecking order? Because from the emerging market basket, we were underperforming by a mile. Now it seems that the FI holding has come to those levels, but they're dipping back in. Your feedback?
Well, I think you're right. I think what we've seen is that there's been so much enthusiasm about, Western AI markets that really the focus has moved there. So if you're a foreign investor, you're chasing after the silvery things like a magpie at the moment. But of course, from time to time, people will see that there's undervaluation in some of these other markets and will move in. It's quite a fragile time at the moment, I think, in terms of the fact that there is so much liquidity buoying Western markets. It's keeping them up. And a lot of the reflection, if you like, has come off many of the emerging markets. There are some concerns about China growth. There's some concerns about disinflation in China. So we're seeing people come out of that sector. And I think what we're seeing too is the same with India, is that there's been just less of a spotlight on these markets. Now, normally, what you have is a movement in the Western markets, and then that reflects then onto the emerging markets as people see that there's valuation there. Whether that's likely to happen at the moment because of the amount of liquidity we are seeing in Western markets, I'm not sure. But if this kind of bubble continues, I think, into the second half of the year, then I think FIIs will start to look much more at emerging markets.
Okay, Richard, we'll leave the conversation here. Thank you very much for joining.
Thank you. Nice to see you.
Nice to see you, as always. Let me tell you the interactions lined up on the show today. So coming up at 8:35, the management of KC International will talk about the June quarter numbers. 9 a.m., Abneesh Roy of Nuvama will talk about Z Entertainment's Q1 earnings and the triggers ahead. 9:20, Trideep Bhattacharya of Edelweiss AMC will be the market master for the day. 9:35, we bring you a discussion around mining and cement stocks as the centre is looking to introduce the MMDRA amendment bill in the parliament. Following that, the management of HCG Healthcare Global will chat with us at 9:45 on the quarterly earnings. And towards the end of the show, Lata will speak to Macquarie Capital Suresh Ganapathy on how different financial sectors fared in Q1.
Time to slip into a quick break. We go full tilt on stocks on the other side, though. For the time being, I'll run you through the top 10 list of stocks that we're looking at. BSE, Vodafone Idea, Bosch, Lloyds Metals, Gland Pharma. They'll all be reacting to positive news flow, but the list doesn't end there. You have Prestige as well that will be dipping into the green terrain. The other stocks that will be reacting to negative news flow, KC, Z, Idea Forge, and Apar Industries. Take that break, come back. We get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now, as always, to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. Vivek, let me start with you. The NSE rebalancing changes are out. So who's in, who's out?
Well, that's right. We'll focus on the Nifty as of the moment because, that's where the big headline is. So the Bombay Stock Exchange, or BSE, will make its entry into the Nifty 50 effective September 30th, 2026. And all of the changes, all of the passive fund managers will have to make the changes in their respective portfolio on the close of trade as far as September 29th is concerned. So BSE, expected to get inflows of a little over $620 million, which equates to almost 6 days of the average daily traded volume. And Wipro will make way. Wipro will see outflows of a little over $150 million, equating to close to 5 days of its average daily traded volume. The main reason for this particular change is that BSE has met all of the criteria required for inclusion into the Nifty, and the average 6-month free float market cap is greater than 1.5 times the average 6-month free float market cap of Wipro. So both of these stocks will remain in focus. BSE expected to move higher in trade, and along with that, NSE has also gone ahead and made a whole raft of changes in all of the other NSE indices as well.
Thank you very much for that. I'm watching for Vodafone Idea, and here the headline is, for the first time since the company's merger between Vodafone and Idea in August of 2018, since then, quarter after quarter, the company was bleeding subscribers. This is the first positive quarter when subscribers have been added on a sequential basis. So it's been muted, just about 0.3 million subscribers, but it's the first net positive number. So just to go back and recap the numbers, when the merger took place, the first quarter when they reported numbers, the total subscribers of Vodafone and Idea combined was 422 million subscribers. In the current quarter, we're down to 193 million subscribers, which means net-net, from the time the deal was struck, the merger was there, we've lost close to about 230 million subscribers. Very, very seminal. Is this the bleeding had stopped. Large numbers became a trickle in terms of a decline, but this is the first time it's a positive. Now on the numbers, revenue was ahead of estimates, margins in line, and the reported loss was aided by an exceptional. So revenues are up 3.2%, EBITDA margins unchanged at 43.1%. At the reported level, there is a loss of 3,747, but this is after an exceptional gain of 1,611 crores. So net-net, we are looking at an adjusted net loss of close to about 5,500 crore. ARPUs have inched up by 1.7% on a quarter-on-quarter basis, largely in line with what Jio and Bharti Airtel have reported. But as I said, the big headline is, for the first time since the merger, Vodafone Idea has added subscribers in the current quarter, quarter-on-quarter. Well, let me go across to Hormus now, who is going to tell us about Bosch. Hormus.
Morning, Rima. And continuing the trend with a lot of these auto ancillary companies that have reported strong numbers. You saw that from Samvardhana Motherson as well last week, Bosch as well, an operationally strong quarter coming in. Of course, on the profitability front, you would see that 36% decline optically, but that's also because of the fact that there was an exceptional gain of 556 crore in the base quarter, and that's why the numbers are skewed. But otherwise, if you take a look, the revenues were up as well on a year-on-year basis by around 22%. EBITDA was up 28%. Margins have expanded by 70 bips from 13.5 to well over 14% at the end of the quarter. They've also said that the growth was driven by the higher demand in passenger cars and the off-highway segment. They're saying that the automotive industry is now transitioning towards a cleaner, more personalized vehicles, and they are well positioned to cater to this transition. And in fact, the two-wheeler business was the fastest growing this time around. It grew 41% on a year-on-year basis, mainly led by the value-added EMS products and the increased sales to premium motorcycle platforms. So a strong number from Bosch, going with green on this one.
Got it. All right, Hormus, thanks a lot for that. Well, let's focus on Lloyd Metals. Well, the quarter one EBITDA has come in at 2,781 crores. Remember, that was nearly its annual turnover just 4 years back. Remember, the mining development business as well as related services, that's been included into the core business, and that's bumped up numbers a little bit. Nonetheless, these numbers look very, very strong. The results have been driven by operating leverage that played out, the higher iron ore, environment clearance limits, faster ramp up of the pellet plant that was just commissioned a few quarters ago, improved sponge iron volumes, and some other cost-saving measures as well. For example, they've commissioned the slurry pipe. That's lowered the logistic costs. Better product mix, higher contribution coming in from value-added products like pellets. That's what's led to the meaningful margin expansion. That's why margins from around 30%, they have come in at around 38%. The guidance is very ambitious as well. Just take a look at that. They're talking about iron ore production at around 26 million tons. Just 5 years ago, they were doing only 3 million tons. Pellet production, nearly around 8 million tons. That's phenomenal. DRI production, which is sponge, that as well will be higher. And, the steel production will gradually start coming on stream in the fourth quarter. So put everything together, numbers are good. The stock has seen a big rally, mind you, because we spoke to the management here on CNBC TV 18 just a few months ago at around 1,200 to 1,300 rupees. From there, it's already seen a big run, but these numbers are good. So we're going with green. Hopping across to Ekta, she's here to tell us about Gland Pharma. Ekta?
Well, good numbers coming in for Gland Pharma. The revenue was up 19% this quarter. The margins expanded all the way to 27% versus 24.4% on a year-on-year basis. And the profit did show strong growth as well. Now, key segments such as USA was up around 32%, but it was flat sequentially. EU, which was up around 20% and India, which was up around 12%. Now, the CDMO segment did very well. It was up around 20% on a year-on-year basis. So it came in at around 891.5 crores in terms of total revenue. And they have indicated that the annualized revenue from a CDMO partner going forward is estimated to be $90 to $100 million once all of the molecules are commercialized. And this revenue is estimated from 2029. So overall, the guidance also seems quite bullish. And the numbers supported is likely to support the stock today.
Got it. All right. Thanks a lot for that, Ekta. Well, let's go across to Vinny. She's here to tell us about KEC. I think those numbers are a little bit softish, Vinny.
Yeah, we had a soft quarter that came in from the company. Last time also was a soft quarter, but that impact of West Asia crisis, labour shortage, that's still not normalized, as well as slower execution in water projects continues to impact the numbers. So revenue, the company had said in Q1 would be flat, and that is what it's come in, right? 5,023 crores. No increase versus last year. Now, where the miss came in was the EBITDA margins. That came in at 5.79% versus 6.98% last year. We're seeing a contraction in terms of margins, but these are the lowest and the weakest margin levels that we've seen coming in for the company, at least in the last couple of years. So that impact is seen on the margin front as well. Now, overall, in terms of the order inflows, they've been at around 6,300 crores. T&D, civil, renewables, cables and conductors, transmission and transportation business. This is where the order wins have come in from. Though T&D revenue has remained flat, non-T&D side of the business, especially railway, as well as renewable side of the business, that has seen a decline in terms of revenue as well. But that will be key to watch out for. Now, two positive things, though, that came in from the earnings was the net debt. That's seen a reduction versus March quarter, as well as in terms of net working capital days. That has come down now to 134 days versus previously 137 days. So, slight bit of an improvement there. But is this sustainable will be key to watch out for. As of now, soft numbers. So we'll see some red on the screen here. That's about KC International.
Well, Vinny, don't go just yet because you're also looking at Z Entertainment and the numbers. And most curious, what kind of an impact did the FIFA subscription have? Because you had to go through Z5.
Absolutely. So overall numbers, decent, nothing great about it. 5% revenue growth. Ad revenue has actually seen a decline of 11% during this quarter. Subscription revenue was strong. That was around 16% growth in terms of subscription revenue. Apart from that, margins have seen a very sharp contraction. We're seeing the profits of the company that are down by 47% as well. Now, Z5, yes, that did turn a bit positive. And FIFA was something that was driving the strong engagement. But investments are something that are weighing overall on the margins of the company. And that is why the contraction there. Now, apart from that, obviously, we'll expect red on the screen for Z because the overhang of the SEBI's order, SAT proceedings, that remains a key monitorable for the company, and that is why the way forward will be key in terms of that as well, apart from earnings.
All right. Thank you very much for that. Ria now joins in to tell us more about IdeaForge.
Well, it has been a weak quarter this time around for IdeaForge. The execution has been impacted by supply chain disruptions. EBITDA has turned positive this time around, but margins have remained sharply below what we saw in quarter 4 of FY26. But remember, quarter 1 is seasonally weak for defense companies. Now, the revenue this time around has gone up by 437% compared to the previous year, but sequentially it has gone down by almost 50%. EBITDA, as I mentioned, has turned positive at nearly 2.5 crores versus a loss of nearly 19 crores that we saw in the year-ago quarter. Margins have fallen sharply to nearly 4% this time around versus around 44% margins that we saw in quarter 4 of FY26. Net loss also this time around coming in at nearly 3 crores, and gross margins have also fallen sharply to 49% versus 62% that we saw in quarter 1 of last year. Now, the order book currently stands at nearly 257 crores for the company, which has moderated slightly from the 314 crores of opening order book that we saw for FY27, and the company has said that of course, they have executed 20% of the FY27 opening order book, and they are targeting the completion of the entire order book by quarter 3 of this year. So going forward, it will be key to watch what the order inflow revenue visibility is for the company.
Okay, all right. Thanks very much for that, Ria. Let's talk about Prestige Estates next. Sonal is here with details on this one. Sonal, take it away.
Good morning, Prashant. Well, Prestige Estates will be in focus because their hospitality arm will be raising 3,000 crore rupees from CPPIB, where CPPIB will be investing 28% stake, so the equity valuation comes to around 10,700 crore rupees. This investment will come in multiple tranches and it involves primary and secondary investment as well. Now remember, the Prestige Hospitality Ventures, which is the hospitality arm, is 100% owned by Prestige Estates, and the transaction is subject to due diligence and regulatory approvals. This is an arm which is headed for an IPO. They had filed the draft papers, but there is no update on that one. And we had spoken to Mr. Razak, who spoke about how there will be different entities for each business going forward. So this could just be a start to that. So Prestige Estates will be on our radar today.
Got it. Okay, all right. Thanks a lot for that, Sonal. Well, let's go across to Vivek. Nimesh had given a heads up that Apar could be looking to raise some money. And Vivek, that's precisely what's happened, right? Give us more details.
Well, that's right. As Nimesh has pointed out quite a few weeks ago, in terms of a significant fundraising as far as Apar Industries is concerned, along the expectations, Apar Industries last evening went ahead and launched a QIP for a fundraise. The quantum of this particular fundraise is close to 2,500 crore rupees, and the indicative issue price is at almost 10% discount to yesterday's close at 14,800 rupees a share. Now, there is a lock-up period in terms of further stake sale or further issue of shares, and that will be around 45 days in terms of sale of shares once it is issued. So overall, going with red on Apar Industries, but it will be interesting to see how exactly the management goes ahead and uses these particular funds, whether it is for further capex.
Okay, thank you very much for that. And now let's go across to Manisha, who's going to fill us in with the latest in commodities and currencies. Manisha.
Thank you so much for that. I'll start with the crude oil prices because we have seen 5% of gains in the overnight markets and we are inching closer to $90 a barrel right now. There is a lot of uncertainty even now over the potential deal between the U.S. and Iran, with both the countries now demanding a compensation from war damages, and then U.S. also indicating an economic pressure on Iran that could be intensified going forward. So clearly the West Asia conflict continues to add on to the pressure. But as the crude oil prices are gaining, so is the case with the precious metal prices. You have gold, which is trading at a 10-week high, silver at a 7-week high, platinum at a 2-month high, and not just the precious metal prices. The base metal prices have been in favor as well. You have aluminum, which gained 1% yesterday. Copper, after hitting all-time highs in the previous week, seems to be holding around those levels. So commodities seem to be looking at some money rotating back here.
Okay, all right, Manisha, thank you very much. For that, we'll take a quick commercial break here. We're going to come back with the management of KEC on the other side. We talk about the quarter which has gone by. We'll also connect with Mayuresh Joshi of Mark Smith India for some fundamental stock conversation. Stay tuned, coming back.
Welcome back. Well, let's focus on a few stocks. Then we have Mayuresh Joshi, Director Research, MarketSmith India, who joins us on the show. Hi, Mayuresh. Good morning. Good to see you win. Let's talk about BSE. Yesterday, there was a bit of a run-up in anticipation that it could make it to the Nifty. And that's happened. There'll be some flows that will start coming in now because of, the readjustment, the realignment in September. What's your view on the stock? It's already been such a big multi-bagger. Just imagine the BSE and the NSE, fighting for market share. People are arguing about valuations. And then the BSE is part of the Nifty. And probably when the NSE lists, it could be part of the Sensex. So that's the way markets are. What's your view on the stock?
Good morning, Nigel. I think that's a very positive development for the BSE. And obviously, I think there are inflows expected into the stock. Our own take is that for exchanges in general, I think the dominance is going to continue between both these players, whether it's BSE or NSE, as it lists. And therefore, I think the base case scenario over the next 3 to 4 years that is probably getting put out in terms of the annuity part of the business that both these exchanges will probably have, will give a large part of the fixed flows that probably happen in terms of the P&L. In terms of the transactional revenues, I think the expectations in terms of the pie actually increasing every passing year in terms of more clients, more demat accounts being added, and therefore indirectly contributing in terms of exchange turnover is something to be watched out for as well. The MF platform that BSE has also shown a steady state performance. And let's not forget the depository part, which obviously is in a different subsidiary altogether. But I think the sum of parts in terms of business segments are all expected to probably do well. So it was part of our core holdings. However, Nigel, I think we've met our target price to a large extent. However, from a medium-term perspective, I think both the exchanges look very, very strong.
Okay, all right. We'll come back to you, Mayuresh, in just a bit. But we have our first management with us. KEC International is joining us. The impact of the West Asia situation continues to impact KEC. It was the situation in Q4, and I think that's been what has happened this time around as well. Mr. Vimal Kejriwal is MD and CEO of the company. Mr. Kejriwal, good morning, sir. Thank you for joining us. So revenue growth is a little muted. Margins have fallen sharply to about 5.8% from 7%, despite some moderation in raw material costs. I just want to ask you to describe what happened, because I remember when we spoke after Q4, and that conversation was in May. One of the things which stuck with me was that labor shortage. You said your requirement is 30,000 people, and you were working with 15,000 people. So there was a big labor gap. Has that persisted through this quarter, and has that been responsible for the muted set in Q1?
So, Prashant, good morning once again. I think there are a couple of factors. I think you have covered two of them. That's the West Asia, and second, obviously, is labor. So, as far as labor is concerned, I think throughout April and May, the labor shortage persisted significantly. Okay. June onwards, people started returning. So now we are, I'll say, almost at 90% of our requirement. So June, July, it's picked up significantly. We'll be still short of around 2,000 people or so, but I think that's manageable. I think those are the two major issues. And third one, which we have been discussing, is the payment issues in water, which continue. So that impacted water. So these are the three basic issues because of which we had a flat, revenue growth.
So April, May was bad. June, you got back to 90%, and now it is getting better and better. So July also. Yeah.
Yes.
So Q2, you should be in a much better shape, right? I mean, labor should not be a problem.
Yeah, on the labor front, so the civil business and to an extent in India, T&D, mainly I'll say the civil business is picking up now in terms of revenue.
Okay. And just talk to us a little bit about that margin drop as well. What caused it? I thought there was raw material costs eased up a little bit.
So raw material costs have started easing up. So you will start seeing some impact in Q2. I think April, May were pretty bad. Also, if you look at items like fuel and power, both in India as well as Middle East, now what's happening is that we are talking to clients, etc., but the costs are being incurred today. So all the costs are getting booked in the accounts today, and unless and until the client gives you a claim or something, they'll continue to hit your number. So I think the basic issue was raw material. I'll say also logistics. Logistics have gone up threefold. So that's another item which has hit the balance sheet or the P&L.
You mean shipping? Is that what you mean?
Shipping as well as inward logistics. If you take a trucking cost, etc., and shipping and the trucking cost in UAE and Saudi has gone up significantly because the fuel prices have almost, I'll say, doubled there in West Asia.
When will margins normalize, Mr. Kejriwal? If you can give us a sense.
I think, to me, one is we'll have to wait for West Asia crisis to settle. That to me, and how the logistics, etc., and the supply chain pans out. Because even today, the issue is not the execution on the ground. The issue is your supplies are not happening. Europe, China, even from India to that market. So once that starts normalizing, so I'll say Q3 probably.
Okay. And in Q3, margins get to 7-8% or even higher. When we talk about normalization, what are we looking at Q3?
I think we should be talking between 6.5% to 7%.
Okay. So what about the top line growth? 12 to 15% was the guidance that you had shared last year, with order inflows at 30,000 crore. Are these two on track?
Order inflow right now, we have got around 6,300. We have L1s of 3,000 crores. So I think order inflow should happen. Margin guidance, not margin, the revenue guidance, I think 12 to 15, we are still sticking to it. Maybe closer to 12, then to 15. But I think we'll wait and watch because as I've been maintaining in EPC business, the revenues just get deferred. So it will depend upon when the West Asia crisis settles. If it settles right now, then probably we can even go up to 15. But I think we are still okay with that guidance.
Got that. And sir, on debt, you had spoken about reducing your debt by 1,000 crore rupees. Now, considering so much uncertainty, is that on track? And what is your net working capital guidance by Q4 FY27?
So we are still on track for that. If you look at Q1, we have reduced by 150 crores. We expect to reduce it by at least 200, if not more, in Q2. So our 5,500, 600 crores guidance for March still remains there. Net working capital, I think, is around 134 days or something. So for the year end, we want to bring it down to 120. We have a couple of lumpy payments which have got deferred. We have got an Afghanistan large payment of 300 crores and odd, which is to come from multilaterals, which has not happened in Q1. I think it should happen in Q2. So I think we are pretty okay with our debt guidance.
Okay, all right. Hi, Mr. Kejriwal. Difficult quarter, nonetheless, on the operational front, order inflows, payments as well. You briefly mentioned about payments as well, right? How have things moved? Has July been better than June? If you could give us some clarity out there. What is the total outstanding payments? And are things improving gradually?
So you're talking about water, I presume, Nigel?
Yes, water.
Yeah, so water, Q1 was not that good, but in Q2 beginning, I think till now, from 1st July, we have got more than 100 crores of payment, which is quite significant considering they've been paying around 50, 60 crores per month. We have spoken to the government, all the powers, and they have said that, yes. Okay. So I think it's improving.
So 100 crores you received, and prior to that, what was the monthly run rate you were going at?
Monthly, we were getting roughly around 50 crores. So
it's improved. And the total outstanding is how much, sir?
So gross billing, I think, is around 800 or 900 crores, but what is actually billed would be around 400 crores. So we have to have a 400 crores outstanding.
And you mentioned that 300 crores is from where? It's pending from where?
Afghanistan.
No, Afghanistan, we had two projects where we have to get the money from ADB. We have got letters and all confirming they'll pay, but the payments have been getting deferred for whatever reason. So I think hopefully this quarter we should get that money. And there are no outflows. There are no outflows against it. So it goes straight to debt reduction.
Right. So 400 crores should come in. This is from the project in Afghanistan.
300. Yeah.
Sorry, 300 crores should come in.
Yeah.
And the 400 crore number is the water business, which is outstanding from the government here.
Outstanding today. Yeah.
Okay. So putting all of this together, when will I look at where the share price is trading? I mean, it's kind of sort of factoring in. If I look at FY28 numbers for a business like yours, a high quality business like yours, is trading at 14, 15, 16 times earnings. When will things start to turn in a meaningful way? When does all of this come together? You're looking at the bigger picture as well, right? There are all these pieces. There is the water bait, there is the labor bait, which now perhaps is falling into place. What's your guidance, sir? What's your message?
So, Prashant, what's happening is water, we are running down our unexit order book. So we should be close to around 1,200, 1,300 crore order book. So I don't think it's a a worry for FY28 or so. I think by end of FY27, we would have run down that. We need West Asia to normalize because what's happening, there's a large tender pipeline, I think almost 40,000 crores in West Asia. Tenders are happening, but they are still not getting awarded. So once the revenue start coming in, also we saw in last quarter, I'll say Q4, etc., there was a slowdown in the India T&D award, which has started now happening. So I think the biggest joker in this whole pack would be how quickly India T&D ramps up. How do we take care of ROW issues? If, as far as FY28 is concerned, we have talked about 12 to 15% in FY27. I presume that we'll do at least a 10% in FY28. So we should be around 30,000 or so in FY28.
I see. I see. Got that. So, but your guidance for 27 remains unchanged, right?
As of now, yes. Yes. I think we should be able to match it.
Right. And 28, you're saying that you see about 10% growth.
See, as of today, we are saying that let's see how the order book and all that happens. Depending upon that, 10 is, I think, given because today we have an order book plus L1 of more than 40,000 crores. So even if we do 26,000 now, we'll still have around 10,000 or whatever number is there of the order book available to us. So I don't think 28 should be a challenge at a 10% growth. No.
I see. Last time you were on, you were also talking about some 3,000 odd crores of orders, which you were kind of, participating in, which you were hoping to hear. Has anything moved there?
So we have got some of them. But as I said, that West Asia has been a slow in awarding of orders. So I think we have got around 1,000 crores or so L1 in West Asia for, I think, maybe 3-4 months. Hopefully, the discussions are now on. We should get them. But it's been a moving thing. So we keep on getting more orders and we keep on getting more L1s.
Got that. Mr. Kejriwal, thank you very much. Appreciate you joining us here on CNBC TV 18. And always a pleasure.
Thank you so much. Thank you for having me.
Okay, we'll take a quick commercial break here. We'll come back, some volume buzzers with Hormuz in terms of the price action that we saw yesterday. We'll also get you technical trading ideas. Sudarshan Sukhani is going to be with us and Vijay Rajani joins in along with him. So that's also up next.
Welcome back. Hormus joins in now to tell us about the big movers from yesterday, which saw heavy volumes and delivery data. Hormus.
Well, you know, Rima, yesterday's session as well on the closing auction bit, the turnovers continued to drop, and yesterday's turnover barely managed to cross 1,000 crore rupees, and that's evident from the top traded names as well. And today's is not the usual suspect; it's Mahindra and Mahindra that is the top spot on the most traded stocks during the closing auction session, and turnover was only 64 crore for that stock. And then, of course, it's followed by the usual names: ICICI Bank, Reliance Industries, HDFC Bank, and then, of course, Sun Pharma makes an appearance as well. And even then, the turnover here is only 21 crore among the top 5 names. It's the 5th highest, and the turnover is only 21 crore. To go beyond CAS, and then you would see plenty of other stock specific movers as well. Paytm was one of them. The stock was up 10% in yesterday's trade. 2 crore shares were traded on Paytm, almost 5x its 20-day average, and around about 40% of those were marked for delivery. So around close to 73 lakh shares were marked for delivery. That too was 5x its 20-day average, which is around about 13 lakhs, 14 lakh shares. PFC on the downside was the big loser yesterday. The stock was down well over 8%. Close to 3 crore shares were traded, the 20-day average being just over 57 lakh shares. On the delivery front, half of those were marked for delivery, so 52% of shares marked for delivery, so close to 1.5 crore, the 20-day average being 34 lakh shares. And Bharat Forge, of course, was the big earnings reaction of the afternoon. The stock was down 7% after its results, and well over 50 lakh shares were traded. The 20-day average is only 8 lakh shares, and despite the fall, a third of those were marked for delivery, so 15 lakh shares on the delivery front. That too was almost 3.5 times its 20-day average.
Got it. All right. Thanks a lot for that, Hormus. Well, let's go back to Mayuresh Joshi. Mayuresh, Bharat Forge, yesterday those numbers looked a little bit softish. We had Mr. Kalyani who joined on the show, and he said things are going to improve from here on, both in terms of profitability as well as in terms of growth. What's your view on the stock? Yesterday it ended down, I think, close to 6.5%. At one point of time, it was down close to around 8%. It was the earnings casualty of yesterday. But your view on it, I've seen this numerous times. Numbers are softish. The street wants to look ahead.
Absolutely, Nigel. And again, I think if you probably dissect the numbers, I think the European business and the American business, the US business rather, both disappointed in terms of the absolute EBIT and the margin performance as well. However, I think the expectations as things improve, both from a geopolitical perspective as well as an execution perspective, second half as a base case scenario might be relatively better. Let's not forget that Bharat Forge is getting into and has started executing a large part of their business also, particularly in defense, etc., which probably might also aid margins going forward. However, our take on the stock at this juncture is that we're still maintaining a neutral view. We'll still like to see how the company probably performs in the quarter to come. At least to say, I think the overseas businesses were very, very soft and disappointing.
Okay, that's Bharat Forge. Are you recommending Hitachi Energy to your clients?
Morning, very much. I think we already have that in our global portfolios. We've been holding that for a length of time. In fact, our global team has added on to the stock after the results. And therefore, I think as a clear bias and a disclaimer, I think a few of our global clients might be holding positions in these. Our own sense is that the kind of numbers that Hitachi has posted, the expectations in terms of the execution expected to continue at a very decent pace, and therefore margins expected to remain robust is a base case scenario. You can always argue that valuations are very, very expensive as we speak. But if they're expected to continue executing well with the visibility that they're probably seeing, I think there is still room for more is what we see.
No, absolutely. And, what we're going to do is, Mayuresh, we'll just take a quick commercial break here. And we'll come right back. We'll talk about more stocks. We'll also get you some trading ideas on the other side. Abneesh Roy, by the way, is also waiting from Nuvama when we focus on, a bunch of things. There's, of course, Z we'll talk about as well. There's the earnings trigger. There's the appeal to SAT against the SEBI order and more. Stay tuned. Okay, welcome back. Sudarshan Sukhani is with us, and so is Vinay Rajani with what they'd want you to do as far as trades go. There's about 16 minutes to go for pre-open session, for the market open to kick off, and there's about 2 minutes to go for the pre-open. Gentlemen, good morning. Good to have both of you here. Sudarshan, I mean, pretty flattish consolidation kind of trading for the last several days, and doesn't look like, I mean, given the overall picture, you're going to have a breakout or anything today. But what's the trade on the index to kick this off?
Yeah, good morning. Yes, you're right. See, but let's look at the background. We had a 1,000-point rally from 23,600 to 24,600. So after a rally, the market, the Nifty, normally consolidates, and there is no way to say how many days of consolidation will take place. That's something we cannot say. We have to accept it. It's happened earlier, and it will happen again. So we are in a process of consolidation. Since the previous trend was up, I'm assuming that whenever this ends, we will resume that uptrend. So buy on sharp dips. A definition of a sharp dip yesterday was about 24,400. That remains valid. If you see the Nifty around those levels, consider buying the dip. Otherwise, stay away.
Okay, got it. Let's get in Vinay as well. What's your take?
Yeah, so I also agree that Nifty is passing through the consolidation, and on dips one should consider 9 and 24,400 is a very strong support from the 200 days exponential moving average. So currently we can say that Nifty is oscillating between the exponential moving average of 200 days and simple moving average of 200 days. On the upside, 24,800 is a resistance. On the downside, 24,400 to 380 is a support. So overall, looking at the broader market indices, mid cap index, the Nifty 50 index, Nifty next 50 index, and small cap index, it looks like that breakout should come on the upside only. Buy on dip should be the view. Result season is going on this week. Can remain like this, but from next week we are expecting bullishness to resume. So 24,400 is the entry level for the Nifty for the ultimate target of 25,000 in next 1 to 2 weeks.
Got it. All right. What about you, Sudarshan? Could you tell us some trading ideas? As you said, we could be in a bit of a range. Those that have a little bit of a longer time horizon appears that they could get in. But individual stocks are doing a thing of their own. Give us a couple of ideas.
Sure. See, the ideas are mainly mid caps, and the idea is to look for consolidation or dips to buy. Now, let's hope they work out. Adani Green is a buy. It's come to a support level and standing there. Stop under 1340. CDSL has gone into a very narrow consolidation for days. Again, I'm giving you positional buys rather than for today. CDSL is a buy with a stop under 1305. TI India, that is Tube Investments, is a buy. 2760 is your stop loss here. It's gone through a very deep correction and hopefully is standing at support. So 3 buy positional trading ideas, and Nykaa is a sell with a stop above 330.
Got it. All right. Nykaa as well. Vinay, what about you?
Yeah, so from my side, Oberoi Realty remains a buy because after healthy correction, the stock seems to be resuming its uptrend. So primary trend of the majority of the real estate stocks are positive. So I think Oberoi Realty has posted also good results also, and now after correction, it is resuming uptrend. So around 17931 can go long. 1750 should be the trading stop loss. On the upside, I'm expecting an immediate target at 1850. Second stock is from the capital market space, that is MCX. So and along with the energy, now precious metals have started moving up. So that is going to augur well for the stock like MCX. So I think yesterday also it moved up and closed on a strong wicket. So around 2759 one can go long in MCX. 2680 should be the trading stop loss. On the upside, I'm expecting an immediate target at 2900.
Okay, all right. Just one, Sudarshan, I want to just ask you view on 2 names. If you can pull up, the pre-open is kicked off, by the way. Paytm was a big mover yesterday. I think ended about 8-9% in the green. And I don't think we have got a rate yet. And Pine Labs was the other one, which also was, by the end of it, was some 6% higher. And it's up another 0.5% or so. Any thoughts? Actually, you can throw in a Fino and a MobiKwik, etc. But that pack, Sudarshan, any thoughts?
Which one was the first?
Paytm, Pine.
Oh, yeah.
Yeah.
Yes. I track Paytm, and my algos have some small long positions in it. But Paytm and that entire pack looks ready for a significant uptrend. So I would suggest, and Paytm is the leader of that. So buy every day. I don't track Pine.
Okay. All right. Well, Thanks very much, Sudarshan, for that. Vinay, thank you very much for joining us with your respective trading ideas. Abnish is with us to talk to us about what's on his mind. And we'll start with Z. Abnish, good morning. Great to have you with us here. Thanks for joining in. So the Z bit, right? I mean, it was a bit of a shocker the Friday before last with the shareholder approval coming through, and then that SEBI order. We understand yesterday it was mentioned in SAT, so they've appealed to SAT, and I think there's a hearing which is scheduled for the 13th. What is your view now on Z, Abnish?
Yeah, thank you and good morning. Yes, we'll continue to prefer PVR and Saregama in the broader media space. On Z, you are absolutely right. There are two monitorables currently for the stock, which are both, frankly, a bit non-fundamental. One is, of course, the SAT hearing, which you just mentioned. Second, of course, is the arbitration, which is happening with Star on the sports event. So these two are big overhangs, and we'll get more clarity in the coming months. For example, the Star arbitration will get clarity in Q3. And on the SAT, clearly, that's something which will drive interest from a minority shareholder, because currently promoter stake at 4% is very low. And that obviously means that skin in the game perception is currently an issue. Coming to fundamentals, if you see clearly, the things are looking up. Z5 saw very strong numbers, 58% growth in revenue and profitable in terms of EBITDA also. And overall subscription also saw very impressive numbers, 16%. I think in Q2, this will further accelerate because most of the key matches of FIFA were in Q2, and generally the revenues will accrue more when the key matches are there, especially in terms of advertising. Second, of course, in Q2, we'll have the Bundesliga and Serie A also, and Z will get more time in terms of looking for advertising. In Q1 in FIFA, if you see, the time available for marketing was very, very limited, and very high ad spend Z had to bear to promote its 4 new sports channel and FIFA, which in Q2 won't be there. So I think fundamentally things are improving on a 9,000 crore market cap, 2,200 crore cash and equivalent is there in the company. But unless we have more clarity on the SEBI SAT issue, plus the Star arbitration, I think the stock will still underperform Saregama and PVR in our view.
So the SEBI SAT issue aside, purely on numbers for FY27, Abnish, what are you working with in terms of a revenue growth, EPS growth, margins, subscriber ads, and even on the advertising front?
So good question. If you see here, the main driver for Z is clearly subscription. Last 11 quarter, the advertising decline has been there. I think this is a broader theme where the legacy channels, TV channels are seeing shift away from their advertising towards the OTT and digital. So clearly that is something which will continue in the near term. Of course, from Iran crisis, there was a severe impact on all the TV channels in terms of FMCG cutting down on advertising. As the geopolitical issue gets resolved, that will come back. And definitely we do see that the subscription revenue growth will remain strong. So how we see FY27 is strong subscription growth will continue. If you see numbers, the stock is available very cheap, right? 11 times P multiple of FY27. And here, if we knock off the 2,200 crore cash, it will become even cheaper at say around 7 times. So we see that advertising decline 11 quarters has continued. Some more decline will continue, but subscription will more than make up for it. If you see overall revenue growth was 4.5% this quarter. So our sense is it is making up for it. But definitely this is a subscription revenue growth rather than advertising in the near term.
Abnish, you said you prefer PVR and the content cycle seems to be coming back, at least lately, right? With there's Odyssey and there's a few others as well. Is that the bet here? It's obviously cheap relative to where it used to trade at, but what's the basic thesis? And they're trying lots of things, lots of new formats, experiments, trying to penetrate tier 2, tier 3 cities, and they're a leader. No one is close, right, in terms of the scale that they have. But what's the basic bet here?
Absolutely, I think this stock is preferred stock in the media space along with Saregama. So definitely, if you see in terms of capex, they have gone low asset model, so that will improve the return ratio. If you see in terms of consistency, we are seeing the numbers. You're absolutely right. ODC and now Spider-Man also, the kind of ticket prices and the occupancy we are seeing, those are very good numbers. So, and we have seen consistency coming back. Investors, especially the institutional investors, still media is not something which they are still having a lot of conviction because of the disruption. But I will say that if you see the way Z charge for FIFA in terms of 7.99, Netflix, etc., the kind of pricing we are seeing, there is an uptrend. The consumer is also willing to pay. So overall consolidation is there in the market, and definitely PVR is getting now more sustainable viewership. Plus, they have definitely become more flexible in terms of pricing for the off-peak. So I will say that yes, PVR looks ripe for re-rating, but unfortunately, institutional investor interest is still quite low in the media space overall because of the disruption fear which is still there.
Just a short-term tactical kind of a view, because I mean it's possible these two movies are doing great, but you need content like this to get people in to cinema halls, right?
Absolutely.
And that we don't know. Hopefully it'll be good movies, but this is a short-term view on PVR, short-term kind of tactical kind of a call on PVR.
Yeah, it's a trading stock till we see the conviction come back from institutional investors. But you're absolutely right. We will see good numbers in Q2 and Q3 also, because pipeline of Hollywood is small. Regional is also doing well. Hindi also mostly it has stabilized. So I will say yes, it is a tactical buy call from our side. But ultimately here the compounding effect is still missing in the overall media space. So that's why we'll have to be more tactical here.
And very briefly, why Saregama?
Saregama clearly last 3 quarters has been good, and clearly they are seeing very strong growth in the core business. Even on the events business, they have deprioritized, which is again a good thing. So yes, Saregama again, strong numbers will continue. Q2 should be very strong. After Q3, the base becomes a bit unfavorable because last 3 quarters strong growth has been there. But again, valuation comfort is high. We have seen that overall there is more propensity to pay there. All the OTTs are becoming a bit more on the pricing bit higher. So we are positive on Saregama and PVR both, but Z will be lower in terms of pecking order. Yes.
And tomorrow, SAT will be hearing the matter about Z and Puneet Goenka trying to get a stay on the SEBI order, which prevented the company from going ahead and raising the 3,100 crores. So the SAT matter is listed tomorrow. So we'll watch.
Absolutely. The great conversation. Thank you very much, Abneesh, for that, and appreciate your time here on CNBC TV 18. Z, I think, is around about 5 this morning. Let's just take a quick look at where stocks are at. Some of the names we've put out from the morning. So BSE is about 0.6 higher. Vodafone is up about 2%. BSE, of course, was up 5 yesterday. So, there's that. Bosch is up about 1.3, 1.4%. And we have Lloyd's Metal is all quiet. Gland is the standout name. There is Goldman and others who are pointing to the strong numbers. Valuations are expensive, but numbers delivery has come through. Prestige is up about 1.1, 1.2. KEC is done about 3.33%. But the stock is not has had nothing in terms of a run over the last couple of quarters, so there's not very much there, and that's the reason why it's down only 3%. Idea Forge is down 5%. Apar Industries is down about 0.25%, and so on and so forth. So that's the list of names at this point. Let's just look at MCX if we can, right? There's some information which NSE has put out with regards to the crude oil futures on the NSE gaining market share, etc. We'll try and see. We'll try and explain that in terms of what has happened. But MCX, of course, is the commodities leader, and it's not a bad environment. I mean, gold is jumping, silver is back in action, oil prices, trading, etc. is once again up and down, and large moves on both sides. And that's typically a decent environment for MCX. So, keep an eye on this one as well. Okay, well, let's just run you through the NSE. Okay, I think we have the 9-10 calls right now. Sudarshan is with us. Sudarshan, take it away.
Well, Adani Green, buy Adani Green with a stop under 1340.
Adani Green with a stop under 1340. Stocks at about 14.15 right now, but it's starting about 50 rupees higher. Sudarshan, thanks very much for that. NSE index changes once again. The spotlight there. Vivek has got this one. Vivek, take it away.
Well, that's right. We'll focus on the Nifty 50 as well as the Nifty 100. BSE will replace Wipro effective September 30th. BSE expects inflows of a little over $600 million, close to 6 days worth of buying as per the current ADTV. Wipro can see outflows of a little over $150 million. Expect a lot of action, especially as far as the Nifty 100 inclusions and exclusions are concerned. BSE also makes its way into the Nifty 100. Hitachi Energy India expect $80 million worth of flows there. Polycab, Vedanta Aluminium Metal, remember flows there are quite strong, almost $155 million. And Vodafone Idea also comes into Nifty 100 over $68 million. Which are the stocks that will make way for these 5 inclusions? Indian Hotels, over $100 million worth of outflow. Lodha Developers, REC, Shree Cement, as well as United Spirits. United Spirits expects the outflows of a little over $80 million. So again, all of these stocks expect them to see reactions, up till the effective date of the implementation.
Okay, thanks Vivek for that. Gland Pharma with Winnie. Winnie, you've got 30 seconds.
Hi, so Gland Pharma, good numbers. US and Europe, this side of the business is doing well for the company. India a bit subdued versus US, Europe. New product launches that supported the growth. Volume growth over there in existing products has supported the growth for the company. They've given a guidance of 15-16% YOY FY27 CC terms growth. And from FY28 onwards, they're expecting a 20% CAGR growth over the next 4 years. Jefferies has upgraded the stock to a buy, target price of 3,350, while Goldman Sachs also has maintained the sell rating, raised the target price to 2,125 rupees.
We need 29.5 cents.
Any on the ball.
Thanks very much for that. So that's, a quick run through, a really quick run through on Gland. Stocks jumping, as Vinny pointed out, there are upgrades and, it's done well. Okay, first rates starting to come up, 24,575. And the Nifty Bank is at about 57,600 something. We'll look at the first index rates and then we'll drill down into individual names. So 24,540 on the Nifty. The first rates are on your screen now. Small cap index is starting about 1/3% higher. So the large caps are not doing, they're all lower. But the small cap index and the mid cap index, mid cap's nothing. 20-point change on a 60,000 index, but the small cap is more pronounced. You got about 1/3% bump coming in on the small cap index right now. 40 points lower on the Nifty. So this is, flat and sideways, nothing more. Take a look at the heat map, the 50 stocks and how they're starting before we go any further. We have Adani Enterprises, Adani Ports. I mean, the all clear coming in from the US court system with regards to those cases. So, it's showing up in stocks as they open up. And I think, the Adani stocks outside of the Nifty also will look at those. Those should also be up and about. Apollo Hospitals, ONGC, SBI Life are some of the others. On the other side, Bajaj Finance is down once again. Day before, on Friday, stocks down 6. Yesterday was, I think, flat to slightly higher even. But this morning it's down. Shriram Finance, Bharti, Kotak, Tata Motors Passenger Vehicle, Asian Paints are some of the losers. But, it's now down 60, but just still finding its feet, at least the indices, that is. Rima.
Well, some more stocks. Prestige is moving well. So Prestige Estates has a gain of about 3% to begin trade with. You've got strength coming through in ONGC. ONGC is up 0.8% with the rise in crude prices. Oil marketing companies under pressure. Gland Pharma is your big winner of the day. Straight away, stock has opened about 7%. The company is confident of at least a 15% revenue growth in the current year. Jefferies has upgraded the stock 28.50 on Gland Pharma, and this is a stock which has moved up 65% since the start of the year. So more power today. In terms of the NSE changes, BSE is in, but the stock is down today, seeing profit bookings 1% lower, while Wipro is going to be out of the Nifty effective 30th of September, but the stock today is up in the green. Z Entertainment is seeing a little bit of a correction, so that's a stock which is under pressure. And then you've got softness coming through in some other names like Shivalik Biometallics. This is a stock which has seen a huge run-up over the last couple of days. Under pressure, Websol Energy, All Cargo, HDFC Bank, we can trade. Pine Labs, Paytm will come up after yesterday's big up move. We'll wait to see if there is any sort of profit booking visible there. Pine Labs opens soft but with a negative bias.
Well, that's right. A few more stocks actually that should be on your radar. KSH, I think this is a newly listed company, KSH International. I think they're the manufacturer of winding wires as well as transpose cables. That stock is up close to around 10%. Just reading a quick couple of details, the revenues appear to have doubled on a year-on-year basis. The profitability number is up by close to 80%, and the working capital is down. The reason the stock has come on the radar is because volumes are very, very high. So that's one stock that's up and about. Specialty restaurants, after a while, that stock is up close to 10%. So big move is what we're seeing on that particular name. Gland Pharma, I think you'll mention, stock has opened up, gap up. India Swift Labs, that stock is now up close to 15%. And the volumes are very, very high on that particular name. So in Swift Labs should come up for you on the screen. Websol, the problem is that the margins have tapered down. And that explains why that stock is under pressure just to kickstart trade. It's down close to around 5% as we speak. And another name, HLE Glasscoat. It's been all over the place with regard to its numbers. One good quarter, one bad quarter. I'm not sure whether they came out with this set of numbers, but that stock is down close to around 20% as we speak. Volumes not very, very high. The revenues have moved up by only around 6% on a year-on-year basis. You have on a sequential basis, it's down by close to around 23%. And the EBITDA margin number has come down to around 7%, which compares with around 13% year-on-year. I think that's where the disappointment is. That one down 20%. Add to the list another name, which is Anthony Waste Handling, down another 8%.
Okay, all right. So lots of stuff moving, and we're taking note of some of the big movers that we have coming through right now. So let's just look at the Nifty down 75. So settling down at this point in time. So the number one volume-led gainer is Gland. It's up 6.5% on the NSE. Aarti Pharma is jumping up for the second day running. I mean, it's a huge gap. I mean, on Friday, it closed at 685. Stock's at 900 now. Almost 900, right? So 2 days in a row. Big move is what we've seen on Aarti Pharma. Adani Energy Solutions is coming up with a 2% jump. It's got large volumes on it. There is Ather, which is coming up with a 2.25% pop. Stock's at almost 1,500. Kolte Patil, the real estate developer, is up 11%. And it's got large volumes on it for now. There is Lumax Tech, which is starting with a 8.5% bounce. And again, I mean, all these have got volumes, and that's why sort of I'm mentioning, because there's lots of stuff without volume, so we don't go there. Info Edge is up about 3%. So that is looking good. Chennai Petro with a 4.5% gain is coming up with gains. I think Chennai was down a little bit, so it's basically back to where it was on Friday after the pop right now. There's Shelly Engineering, which is up about 3.25%. Zentech, Universal Cables was up 20% yesterday, I think, after numbers. And that's up another 4.5% right now. Sundaram Fasteners is up 6.5%. You go down the list, I mean, volumes start to thin out a little bit. So we'll, I guess, wait for, but this is a long enough list that we're looking at this point in time.
Just one more stock, LIC, that comes out of the F&O ban. So that's moved to the high point of the day. After many trading sessions, that's come out. Currently at the day's high, we pull up an intraday chart. Volumes are very, very high. And Tejas Networks as well, the stock is seeing a bit of a spike with volumes quite high for the first few days, because reports are indicating that BSNL is proposing a massive capex for 4G as well as 5G. Normally, we do see the stock see some kind of movement. Remember, a stock, even after the big rally, is still half of what it was at its peak. So maybe that's another stock that could be on the radar.
Okay, well, this burst of excitement once in a while in Tejas, and then it sort of promptly goes the other way. So that's Tejas for you. But lots and lots of individual names is where we are seeing action coming through. Trideep Bhattacharya is with us, CIO Equities at Edelweiss Asset Management Company. Trideep, good to have you with us here. Thanks for joining in. Good morning. So yeah, I mean, numbers have been, and I think everyone who's come on over the last few days, as we've got a fuller picture of what the quarter has panned out like, has been pretty appreciative of the fact that numbers, especially in mid and small caps, has been pretty solid, very strong, Trideep. And, of course, that's the part of the market which has done exceedingly well. Any pocket which stands out, which to your mind, where you're kind of sort of focused on, where there is valuation comfort, numbers are strong, in that part? I mean, market cap agnostic question, but go on, Pradeep.
So three opening comments I would make. First of all, I think the India-specific negatives are broadly behind us, which is why you are seeing broad-based strength across mid and small caps. I think as we go towards the back half of this year, you would see economic momentum broaden, which was quite narrow in the first half of this year. So that's one. Reflective of that, if you look at two sectors, in my opinion, where growth will even further do better from here, one is mid-cap private sector banks, and second, I would put consumer discretionary. These two segments, in my opinion, whether it's new age consumers or even for that matter, the normal ones, we would see, as long as it's consumer discretionary, we would see a good amount of pickup that we get through the back half of this year, including autos and the likes of it. The final catalyst in the name of consumption that we would probably see in the next 3 to 6 months would be this pay commission. Whenever that announcement comes through, the implementation would be next year, but I think the stocks would start to build in. So what last year GST cuts did, I think in about 3-5 months' time, the pay commission announcement could do the same for consumption as well for the few more quarters.
But this whole auto or mid-cap private sector banks where we have earnings visibility, these are all structural. I mean, the structural earnings growth in these is quite well discovered. We've spoken about it. So it's not a new idea. So do you have the valuation comfort? In many of the banks' cases, it's even a fairly crowded trade in terms of investor allocation.
Mid-cap private sector banks, I would probably not say it is still crowded trade. I think the large-cap banks or the bounce back that people have talked about quite a bit. But if you go further down, some of the regional banks which have been impacted by the West Asian conflict, almost 2 to 3 months ago, were kind of trading at close to 1.2 times price to book. So they're probably slightly higher from where they were then, but they still make a good case going forward. I do think, though, that it's not that at current levels you would find totally unloved sectors barring IT, but the extent of credit expansion that we are likely to see from 10 to 12% last year, and if it reaches about 18 to 20% at a system level, some of the mid-cap private sector banks could have a higher beta to that, could outgrow that, and that would mean better alpha generation potential in that context. And I don't think that part is yet factored in the share prices as we speak.
So the only sector which is unloved right now, according to you, is IT. Is there an opportunity here, or you still want to stay away?
No, actually, we have a calibrated stance in that. We think that if you sub-aggregate into two parts, PE multiples and earnings, I think PE multiples, in my opinion, have bottomed out. Earnings will take 2 to 3 more quarters to sort of come through. So we are broadly neutral in this segment. We want to wait away the time when this earnings decline are kind of behind us, not to get caught up in some of the earnings jerks that might stand to come through because customers might allocate budgets from one place to another. But multiples where they are, I think that, and if you look at the share price reaction to even worse results, that tells you that valuation-wise, we are there or thereabouts.
All right. Hi, Trideep. Good to see you in. You briefly mentioned discretionary, right? Could you elaborate a little bit more? What are you looking at? Autos, luxury, liquor, food, what is it?
You name it, all parts of it. So starting with, I've been positive on autos for a good while and continue to remain so. I think as we go towards the back half of this year, there's a bit of a scare that as the base goes higher from last year, the growth might taper down. It might, but net still growth will probably surprise on the positive. That's one. High-end and luxury consumption has been there and thereabouts for a good while. Even the middle part of the retail will actually, mass retail will also start to make a comeback towards the back half of this year. Hotels is a third area that we like. We think that as part of discretionary consumption, that will also make a comeback. The segments which particularly benefit from pay commissions, a pickup in demand, the public sector demand that might come through, which could be luggage and areas like that, could be another area that one could be looked at from a hunting perspective over the next 6 to 12 months.
Got it. All right. Let's talk about, the exchanges then. You have BSE that's going to be part of the Nifty. You'll have NSE that's coming about. And you have MCX as well. That's been a big value creator over the last few years. Those are the few exchanges that I'm talking about. But otherwise, there are many plays when you want to talk about stock market plays. How do you approach this theme?
So this is where I would concur with what you said earlier. It's a very well-discovered theme. Stocks have done phenomenally well. I think at best I would probably expect compounding from here rather than further acceleration. I do think that a lot of positive catalysts, particularly in this exchanges and themes, names, are well captured. Not to say that they will go away. They'll continue to do well, but I do see them as compounding machines. I think within that, overall financials, if I were to look at capital markets, wealth management segment, some of the stocks that are listed there do present a decent value, if you ask me, given that they've seen a good bit of upheaval in the last few years, particularly some names, because of people departures. I think if they make a comeback, that'll be a good segment to follow.
What about precision manufacturing? Names like a Sansera Engineering, Craftsman Automation. These companies are now increasingly diversifying away from pure autos into other sectors. So whether it's semiconductors or aerospace or defense. And the numbers have been pretty strong now for the last couple of quarters. Is there an opportunity here?
Auto ancillaries is one of my biggest overweights across funds. I do think that overall, as the exports opportunity opens up, you would see that along with currency depreciation, the competitiveness of Indian auto ancillary companies in the global markets have improved. And so is their capability as in some of the newer areas that you talked about, which are domestic as well as in exports. So I do think over the next 2 to 3 years, can't of course get into stock names, but certain elements which do have exports as well are very well positioned for wealth creation within auto ancillaries.
No, you're absolutely right. Let's just take a look at the market, which has actually taken a bit of a dive once again from where we started. We're down about 95 points now. So 24,490 is the index level. And just to highlight a few other names, right, which have come into the mix from the time that we started. So Bosch has now got a 3% gain, and it's picked up quite a bit of volumes for a share, which is trading at 45,000 odd. I mean, it's got third largest volumes on the NSE. So this is the value traded, beg your pardon, not volumes, it's value traded. I mean, I guess as a result, consequence of the share price itself. But yeah, I mean, it's got volumes on it as well. Decent volumes for, size. It's for a stock its size. Sudeep Pharma is another one, 6% gain at about 1,116 and coming up with decent sized volumes. Bluestone has had a remarkable run, and that is coming up with a 2.33% kind of a gain. Had a one-way move after numbers, I guess, and now is settling down. Policy Bazaar is up about 1.33% at this point in time. Hindustan Zinc is another one, 1.25% gain. And actually look at all the Vedanta Group stocks. Yesterday they were all jumping up. So oil and gas, iron and steel, they were the two which were up over 10% each. I think Vedanta Aluminum was a little quieter. That's oil and gas for you. Vedanta iron and steel is up 5%. So there is still that momentum which is coming through. And aluminum, the biggest of the lot, that's up about 1% at about 476. So that's the picture right now. Trideep, great conversation. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. Well, Nigel, the mining bill, which is in focus.
Well, that's right. Just a word with regard to Vedanta, the smaller companies, interesting to see where this delivery-based buying is happening. But on aluminium, I wonder at some point of time, the promoter entity could say, if I want to take some money off the table, then that's the largest value out there. So we'll have to keep an eye out on that. For the time being, it's getting included in other indices. And obviously, that's the biggest, the best business, so to call it, from the demerged entities, the largest aluminium player here in India. Well, let's move on and stick to the metals theme then. The Centre has introduced the MMDRA amendment bill in Parliament, proposing conditions for state levies on mining rights. The bill also aims to ensure a more uniform, stable mineral sector. To discuss this, we're now joined by Vikas Singh, the VP at ICICI Securities, and Rakesh Arora founder at GoIndiaStocks.com. Hi, gentlemen. Good morning. Good to see you, Bin. We have seen a lot of flip-flop in the last couple of years with regard to what the center wants to do. Then suddenly you'll have a state that's not part of the ruling regiment at the center that comes out with a rule of their own. And in turn, the companies take the hit and then the shareholders as well. So let's get a couple of factors out of the way. Vikas, I'll come to you first. Well, in a state like Karnataka, could you help us out? What is the current state duty breakup, if you could help us out with that, over and above the royalty that's collected by the center? This is important for NBC, so let's get that out of the way.
Hi, Nigel. Thank you. So currently, the states are getting 150% of the royalty, which is basically uniform across all the states. Karnataka wanted to get another 40% of the duty, which was not enacted because the bill was held back by the governor and sent it to the president. So currently, they are not getting anything additional over and above the prescribed levies.
So 150% of the royalty rate. Is that correct?
Yeah. So royalty, NMET, DMET, everything combined would be closer to 19.5% and 22.5% on the premiums, which was uniform across most of the states.
And the
last together 42% ballpark.
42% is what companies have to pay. Just purely, every cost of production is over and above that. Because just to finish the point on this, since they're paying 42% right now, but I think they wanted another 40%, right? At least in Karnataka?
Yeah, that's what I was saying, that they wanted to get this, but needed the governor approval. Governor didn't get the approval and the file went to the president. So they could not actually extract anything extra at this point of time.
Okay, all right. Let's come across to you, Rakesh. How do you read this? Do you think this is going to be some relief, or is it basically that now, since there's going to be some kind of amendment, at least these rates going up will be prevented and there'll be some kind of uniformity? Your first reaction?
So, Nigel, this relates to, one of the Supreme Court judgment, and there's a little bit of gray area in Constitution, because Constitution allows state government to, levy any kind of duty on the land. But they also allow state governments to levy any duty on the mineral, but within the limit set by the central government. So what central government is trying to do is put that limit over here. And there are other aspects to this legislative move. That retrospective levy from 2005, which Supreme Court had allowed, that is also being done with. Now, so there are 2-3 aspects one need to understand. One is the royalty rate. India has already moved to, an auction-based this thing, and royalty rates are determined by auction. So that's anywhere between 90 to 110% people are bidding. So that is one different matter. It's over and above, what the state governments were charging and the retrospective. So these are the 2 things which legislative move is going to correct. I don't think market was building in that 2005 onwards, retrospective rate, because that amount was between 1 lakh to 2 lakh crore.
Correct.
I don't think that was being built in. It's only that, some of the levies, now what is the cap which central government puts in is what really matters. If they put in a cap which is okay, around 42%, maybe these levies continue. So we don't know for sure. We have to wait and see what cap the central government puts in. But obviously, yes, the beneficiaries would be, companies who are holding older mining leases where they were paying lower royalty rates. Correct. And NBC is one of the, forefront on that.
All right. So Rakesh, basically, these new mines that are auctioned, the premium is anyway so high. So that's why those guys actually, they won't be impacted too much. But the ones that were allocated earlier, they will come in for either a bit of a relief right now, and earlier they were getting a bit of a hit. If you have gone through the list, Rakesh, from the cement pack, yesterday we were highlighting Ramco could be a potential beneficiary because of the 160 rupees per ton on limestone that they're mining from Tamil Nadu. Are the top 2-3 beneficiaries, since you track both the cement as well as the metal pack?
So, Nigel, as I said, Tamil Nadu had put in these kind of high royalty rates on limestone. But as I said, we need to see the limits being set by the central government. So maybe central government, as a gesture to get this bill passed, might offer state governments a little bit higher limits. So that is what we need to see before we can really quantify what would be the benefit.
How much are they sharing with, the state government will be interesting to see. But Rakesh, irrespective of what happens with the amendment, if the state government doesn't get their share which they want, they will come out with some levy or the other, right? I mean, there will be some kind of bypassing. So I don't think the game ends over there. We'll have to keep an eye out and see how things progress from there on, particularly in these states, Tamil Nadu, Karnataka. In the past, we had Chhattisgarh, but now it's a BJP-ruled state, so I think that's okay.
Yeah, Nigel, so the metal has to go out of that mining lease also. So there's a lot of road travel to be traveled. So
exactly.
There are other levies which could come in. So let's not jump the gun. But in any case, market was not really building in any kind of those levies. And so, it's kind of a neutralish, I would say.
Yeah, interesting. There's roadways, there is transportation, something can come out of anywhere. Vikas, coming across to you, what are you building in now, say for a company like NMDC? First, NMDC will be the biggest beneficiary, right, Vikas?
So financially, nothing has changed. The overhang would go because NMDC has a sizable mining in Karnataka, and there was the overhang that Karnataka, if anything, that kind of levy comes in, then the entire Karnataka mining would have become unviable for NMDC. So sentimental positive, yes. I would like to point out on the Jharkhand side, because Jharkhand government has started charging levy of 100 rupees per ton of iron ore, and later on it has been increased to 400. So currently we are not sure about the levies which are charged at 400 rupees per ton, whether after this bill this would be revised and Jharkhand government has to pay back because central approval would be required, or it would be enacted from a day of this. So there's still some gray area. If there is some rollback, then sale would also get benefited from out of it.
All right, this is in Jharkhand, right? Because Jharkhand, 100 rupees, they have increased it to 400 rupees.
They were charging 100 rupees, and last year it was increased to 400 rupees per ton, and this has been charged. Now the state government would require central's approval for anything which has been charged. So we are not sure that since last 1.5 years, this amount which has been charged to the mining in Jharkhand, what happens to that? Whether it would be returned or this would enacted from a day zero and previous would be foregone. Let's see how that pans out.
So if there's a rollback, Vikas, if there is a rollback, then sale stands to benefit, right?
It stands to benefit.
Okay, and in Karnataka, is there any kind of rollback that you're factoring in, or what has been paid, that's done and dusted? Now we have to look ahead.
Yeah. So what has been paid, done and dusted, because additional levies have never been enacted. So not even a single rupee has been gone for the additional levy. So there's no point of rolling back.
Okay, and any other beneficiaries? So NMDC and SAIL would be the two companies that we're looking at. Any of the other miners?
So effectively in Karnataka, like Rakesh said, that those who are into the new mining leases, like JSW, they were anyway paying the higher premium. So there's no impact on those.
Okay, got it. All right, Rakesh, closing comments from you then. Besides what's going on this front, there has been some interest that's been creeping in back into some of these ferrous, non-ferrous names as well. I think the last time you joined us, you were saying that at this point of time, you were tempted to take some money off the table. Currently, what is your view on, both the ferrous and non-ferrous space?
So Nigel, it's playing as per the script. We expected that there'll be some rebound because results are going to be good. But, I don't think we are going back to the, previous highs on aluminum or copper for that matter, or even gold and silver.
Okay.
So this is a little bit of a trading bounce. I think they will be remaining in this range. I'll be very excited if aluminum falls to 2600 to really go long. But at this juncture, neutralish.
Okay, all right. So as of now, but if you had some stock, you would rather be a seller rather than a buyer at current prices.
Yeah, I would try to book some profits on these rallies.
And what about the cement guys? Ramco Cement, what a beautiful stock. We used to talk about it many years ago. It was a big multi-bagger, and from last few years, no returns whatsoever. New player coming into the market. Suddenly this limestone royalty issue as well hit them. What's on the pecking order with regard to cement?
So Nigel, there's only one winner out there, which is Ultratech. And, they are constantly gaining market share as well as maintaining high EBITDA margin.
Okay.
Others have kind of, remained in the shadow. And because of this tussle going between Adani and Ultratech, the sector itself is under a little bit of, I would say, out of flavor at the moment.
Yes.
So we'll, review it in October once the busy season restarts.
Okay. All right. Got that, Rakesh. Thanks for that. Vikas, closing comments from you. Top buys?
So we remain positive on the flat steel players. Tata Steel is among them. We have recently upgraded SEL as well. So we think that the monsoon is in a month or two would complete, and of course that there would be a price increase which would happen in the steel sector. So steel players, basically, we remain positive on that,
And what
especially
about
the flat guys.
What about the Vedanta group? You were the contra positive one, I think, around 3.5, 4 years ago. Any view on those names? Now they're all separated?
We are still positive on aluminium business. Like you know that our estimates are still factoring in 3150 and 2950 kind of the LME realizations,
Okay.
while the LME currently hovers around 3200 to 3300.
Okay.
So, and rupee depreciation also benefiting them. So positive on these names. Vedanta Aluminium more because it has a backward integration benefit as well.
Got
So
it.
the stock would continue to do well in the near future.
Appreciate you all gentlemen joining in and giving us color on this. So yes, this would be a benefit if there is an amendment on the MMDR bill. Then it'll be a benefit, but it basically prevents any kind of hikes coming in from the states, which irons out the system, which is good for some of these players. NMDC as well as SAIL could be potential beneficiaries once this goes through. Time to slip into a short break. On the other side, we got the management of Healthcare Global who's waiting for us. Stay tuned.
Welcome back. We've got the management of Healthcare Global joining us to talk to us about the first quarter numbers. So lots to discuss there, and the company and the business has done quite well. We have Manish Mattu, Executive Director and CEO at the company now with us. Mr. Mattu, good morning. Good to have you with us here. I'll get to the numbers, etc., in just a bit. But every few years there is this, fears around regulating what hospitals charge, which comes back. Go back the last 10 years, every few years it does come back. Now, there's a parliamentary committee on health, Mr. Mattu, which has officially recommended a 3-star cap on hospital room rent. Basically, it says that the room charges for a hospital should not exceed the average room tariffs prevailing in 3-star hotels nearby, basically in the vicinity of the hospital. I just wanted to start by asking you, this is of course a recommendation, but this is very much official, but this is still in the nature of a recommendation. How will this impact hospitals and Healthcare Global in particular if this were to be firmed up?
I think a large part of the revenues in the hospitals still come from the procedures, the pharmacy, and the consumables. And the room rent is a small fragment of the overall revenue. Today also, I think realistically the price optimization happens from time to time. So I don't think the room rents are way off that mark still, particularly for Healthcare Global. So I don't think it will impact Healthcare Global per se. But overall, I don't think it's going to have a major impact on the hospital revenues.
What is typically, how much is give us a Healthcare Global's example, sir. How much comes from procedures? How much comes from the room tariff?
I would say, I don't have that exact number today, But I think the procedures, consumables, and pharma constitute about 70 to 80% of the revenue overall. The room rent, maybe about 4 to 5%. But I mean, I don't have an exact number right now.
Yeah, but those are also linked, right, together, Mr. Matu. I mean, depending on the room tariff, I mean, cost of procedure, etc., is different. I mean, you want a sharing room, you want a single room, you want a premium room, cost of surgery, etc. Everything is linked to the tariff, the room tariff. So can we really differentiate that? Well, room tariff is only responsible for this much, and the rest is surgeries and procedures, etc.
See, over the last few years, we have seen the laddering between room categories has come down, and there's not a big differentiator between, say, a double twin sharing and a private room. But however, of course, it does exist. But I'm sure there will be a way to navigate this as well. I mean, we've navigated many things in the past, overall as an industry and healthcare global in particular, and this should also be manageable in the foreseeable future if this were to be a reality.
What would be the average, because Bangalore is the biggest center of operations for you, although you're present in other states as well. For the flagship hospital, what would be the, for a single room, what would be the average tariff?
See, the room rents for single room vary between, 7,000 to, 6,000 to 8,000 rupees. I think that's the laddering we have in our system in the Bangalore cluster particularly.
Okay.
Got that. And you would have various categories, right, of room rents. There would be premium rooms as well. So on an average for your hospitals, what percentage of the overall revenue that you get from room rents would be on an average higher than the 3-star hotels?
I don't have that data right now, so honestly, because I'm also not aware of frankly what's the variation or what's the average 3-star room tariff in the city, right?
But do you think it's practical to benchmark a hospital room rent to a 3-star hotel?
I mean, the committee must have given it some thought. I mean, I personally may or may not agree with it. But let's see. I mean, I'm not even, let me see what the content of that recommendation is and before I can comment on.
Okay. The intent, of course, is to make hospital procedures all affordable. In fact, even in the recent conference call, you spoke that you could have done better on revenues, maybe by 1.5% if it weren't for headwinds like price capping. So tell us more about that and what the impact of this price capping is going to be on various drugs that are linked to oncology.
I think oncology has seen a couple of price capping in the last couple of years. And while in the short term, it has impacted our revenue achievement, but I think in the medium to long term, we've found ways to substitute that growth through other channels by increasing complexity, by increasing clinical density or the quality of work that we're doing. So I think that will continue. But the good thing is that despite the fact that we had a short-term impact of 1.5% on the overall revenue, our margins continue to expand. I think that's something we are very happy about. The growth has been broad-based. Our non-institutional business has grown by 17%. So I think there are many pluses also that we've seen in this quarter. But I'm sure these headwinds will continue to navigate quite successfully in future as well.
You're also guiding for a 14 to 17% revenue growth, top-line growth, and even on margins. Current margins are 17.5%, but you're talking about 21 to 22% margins by FY28. So that's a fairly big bridge that you have to, cross over. What is going to lead to that, and how confident are you about this 21-22% margin range for next year?
So if you look at our adjusted EBITDA margins, they actually stood at around 19% in Q1 if you adjust for the loss coming from the North Bangalore facility. So I think we're already trending close to that number. Going forward, there is expansion of capacity that we will be undertaking this year. We'll be adding about 180 beds this year alone. There is work that's happening on track as far as recruitment is concerned. Investing in technology, be the surgical robots or the MR that we ran in the North Bangalore facility. And there's, of course, the work that's happening on the payer mix optimization, which has really yielded us tremendous benefits in the last couple of quarters. So I think all these things will continue to propel our margin expansion story.
You spoke about how margins would have been 19% if you exclude the North Bangalore facility. Is that correct? The adjusted margins?
Yes, the adjusted margins. Yeah, that's right.
Okay, so this North Bangalore facility, I believe, reported an EBITDA loss of 7 crore in Q1 FY27. So from here on, for this facility, North Bangalore, what will be the losses in Q2, Q3? Do they shrink? When do you turn EBITDA positive?
See, the North Bangalore facility has started really well. It's ramping up quite nicely. We've got some fantastic clinicians on board, really cutting edge technology. And as insurance empanelments come in and as clinician practices ramp up, I think the losses will definitely come down in the subsequent quarters. I may not be able to quantify the exact number, but definitely I think we've had peak loss in Q1 and the losses will narrow down in the subsequent quarters.
And EBITDA positive in FY27, say Q3, Q4? Since 7 is already peak loss.
Yes, yes. I mean, we are targeting EBITDA positive within 12 months of the commencement of operations of this hospital.
Okay.
Okay, now Mr. Mattu, I was looking at, it's a big document actually, right? I was just trying to put this through to and distill some of this. And I'm sure, I'm sorry, I'm sort of, you know, and you want to look at this document as well. I don't know if you have already, you know, but basically it's overarching. It basically says affordability and the report is called the report on affordability and accessibility of healthcare facilities in public and the private sector. That is essentially what it says. And, you know, you were talking about how, you know, bulk of the revenues is from procedures and that kind of thing and not room rates. I started with room rates, but, you know, the committee is proposing, and this is from the document, create a statutory body to set rigid caps on essential procedures and diagnostics and require hospitals to publish a unified schedule of charges. So this is, you know, this is not just about room tariffs as well, Mr. Mattu. You want to respond to this?
See, I'm not particular to this, but, you know, in the last so many years, we've had caps on implants, stents, drugs, consumables. I think that's happened from time to time. But I think the overall demand in this sector is so big and untapped. There'll be many avenues for hospitals to continue to grow at healthy rates without impacting, you know, regulation. I mean, while at the same time being compliant with these regulations. So I don't think this is necessarily a big challenge, but I mean, that's all I have to say about this today.
There's lots of stuff here. You know, the recommendation is that IRDAI should explicitly prohibit dual pricing between insured and uninsured patients. Hospitals will have to integrate their billing desks with you know, we'll have to integrate the billing desks for this to be able to be done. Yeah.
All I can say right now is that whatever the regulations be, I mean, we will, Healthcare Global will comply with all of them. And I'm sure the rest of the industry too. I don't think there are any clues about.
There's also, Mr. Mattu, the committee suggesting incentives for hospitals setting aside at least 20% of beds for subsidized or free treatment.
That's right. That's right. I know. I think it's a step in the right direction overall, because I think the larger goal of the industry also should be to balance profitability with social good. And I think the industry has done quite a bit in the last couple of years, and there's no reason why we shouldn't continue to move forward with the government on this.
Mr. Mattu, have you had, you know, this was a report which was submitted to the, presented to the Rajya Sabha on the 7th of August, laid on the table of the Lok Sabha on the 7th of August, right? So this is a couple of days back. Have you had discussions at a hospital level, at an industry level, in terms of back and forth on around all of these issues recently? I mean, prior to this report being prepared?
So we've had multiple discussions in the last couple of months on this one. And we have, you know, I think there are bodies which are representing the interests of the hospitals. And we leave it to the office bearers of that body to handle this at an appropriate time.
Okay. You know, maybe we can talk more, but this is a big one, big report. But thank you for being a sport and sort of, you know, taking some of these questions apart from the first quarter numbers as well. I think stock has seen a bit of a spike. It was down and now it's back in the green. That is Healthcare Global. There you go, on your screen now. Thank you, Mr. Mattu, for joining us. Just look at the other names as well. Look at Max Healthcare. I think Max was coming off the last I checked. We should also look at maybe Fortis. They're all coming back up from the lows. I mean, they all sold off and they are coming back up. Max was down 2.5%. There's Fortis, which has also seen a recovery. So something interesting is going on with some of this stuff. They're all recovering after selling off on the report. There is a bit of a rebound which is taking place. Narayana Health perhaps is the other one which is in focus out there as well. So Apollo Hospitals, of course, I mean the big one.
Jupiter Life, smaller one, but Jupiter Life as well.
Jupiter Life is there. So they're all actually, they were all down sharply and they're all coming back up. I'm not sure if there's something in the report here. I read out some of the recommendations. These are recommendations, but and we'll try and get more and more responses from hospitals, but of course also try and reach the government and the Ministry of Health, which has put these recommendations together with regards to affordability for treatment at hospitals. So that's a picture with that story as of now. We'll take another quick commercial break here.
The markets are selling off, Prashant.
Yeah.
We're now down about 0.5% on the Nifty and the Sensex. Look at the Nifty Bank. That's been the drag today. Axis Bank down over 1%. HDFC Bank, Kotak Mahindra Bank, all will come up for you on your screen. So after a subdued start, I think markets have taken a turn for the worse. The advanced decline ratio also in favor of the losing side. A couple of other names which deserve mention in the large cap screen. Tata Consumer Products, We Can Trade, Apollo Hospitals, we spoke about, but Nestle, Interglobe Aviation down over 1%, SBI, Bajaj Finance, Bharti Airtel, Eternal, all down over 1%. But let's go across to Ria now. She joins in with more on Idea Forge.
Well, yes, Idea Forge has tanked 5% today, hitting a lower circuit after reporting a weak set of numbers for Q1. This time around, the execution was impacted by supply chain disruptions, especially in a quarter which is seasonally weak for defense companies. The revenue, although increased by 437% on a year-on-year basis, but it fell nearly 50% sequentially. EBITDA turned positive at nearly 2.5 to 3 crores versus a loss of 19 crores that we saw in Q1 of last year. But margins have fallen off sharply to just 4% compared to nearly 44% that we saw in Q4 of FY26. Net loss has also narrowed to nearly 3 crores versus a loss of nearly 24 crores that we saw on a year-on-year basis. But remember, on a sequential basis, last quarter we saw a net profit of nearly 60 crores. Gross margins have also fallen off sharply to nearly 49% in this quarter versus 62% that we saw compared to the previous year. The order book has also moderated to nearly 257 crores versus nearly 314 crores of an opening order book that we saw for FY27, and the management has said that they've executed 20% of the FY27 opening order book in Q1 itself, and by Q3 of this year they are targeting the completion of the entire opening order book. So going forward, this will remain key to watch what the guidance is for the order inflow for the year ahead. And apart from this, the company has said that they are expecting defense procurement activity to accelerate in Q3 and Q4. So overall, the second half of the year is expected to be better for them, but nonetheless the performance remains weak for them and the stock is down resultantly today.
Okay, all right. Thanks very much, Ria, for that. What we're going to do is get in Chandan now to talk about the markets, which are around about 100 points. Chandan Tapari is with us. Chandan, what's your recommendation? How are you looking at things?
Good morning, Prasant. Thanks for having me. So the Nifty got stuck in a range. However, major trend is intact, but we have seen some consolidation. So for me, the important is to hold near 24,400. If after the small dip, if manages to hold 24,400, I believe again buy on decline could be seen towards 24,650 to 24,750. Looking at the Bank Nifty, again range bound bias is clearly visible. 56,750 is the support. On upside, multiple barriers are visible near 57,750 to 58,000 marks.
Any stocks, Chandan?
Yeah, so Rima, first trade will be buy on Eicher Motor. We are quite positive on the Nifty Auto, which recently gave a breakout similar to triangle formation on the weekly and the monthly chart. Eicher Motor is one of the strongest name which has been making high top, high bottom on the weekly chart, given a consolidation breakout on the daily. So with support of 79.50, looking for an upside move towards 83.50 to 8400 level. Second trading idea, there is buy on Naukri. Counter has recently bottomed out 2 months back and now has given a consolidation breakout. It has given a decisive hold above 1275 and further momentum can extend. So one can buy with support of 1310 for an upside target towards 1390 to 1400 level. And apart from that, I'll focus on selective IT name. And here I would go for SCL Tech with support of 1350. SCL Tech can head towards 1420 to 1450 marks.
Thank you very much for that. In Swift Laboratories, that's one of the big movers today, 16% up, came out with numbers. There is a 180% surge in the company's net income. Stock is rising. Kolde Patil reported a profit versus a loss in the comparable quarter. Collections for the company are up nearly 30%. So that too has moved well. Get into a break. We'll come back with more on commodities. Stay tuned. Welcome back. It's time now to talk commodities, precious metals in particular. They're sparkling today. Manisha joins in with more.
Oh, well, absolutely. Last week was a strong one as well when we saw 7 to 10% of gains come in for the precious metal prices. And there is extended gains that we are seeing in this week right now. So whether it's about gold, silver, platinum, palladium, even some of the base metal prices have been doing quite well. So there you have gold prices trading at a 10-week high, silver at a 7-week highs, platinum and palladium both are trading at a 2-month highs as well. And when you look at the week-on-week and a month-on-month gains for many of these, that has been on the stronger side as well. So you have gold prices, which has gained up by 8% in the matter of last 1 week. It is also 12% up in last 1 month itself. Silver clearly outperforming the overall pack here with 11% gains in the last week and 14.5% up in matter of last 1 month itself. And there you have platinum, palladium, 10 to 11% gains in matter of last 1 month. So it has been a good going. You've seen money come back in case of precious metal prices. The correction that we saw in the last 3 months almost seems to be getting over. And especially for the gold prices, $4,000 an ounce has been a psychological strong support level, which the markets have respected, even defended. And we have seen gains come back from that one. The gold prices did try to break $4,000 an ounce on the lower side a couple of times, but clearly were not successful doing that. And there are various reasons on why the gold and silver prices are back in favor. One, it has to do with the U.S. non-farm payroll data that shocked the markets clearly because the street was anticipating an 80,000 increase in sense of jobs. What you saw was a contraction of 23,000 jobs there, and that is what led to safe haven buying coming in for gold and silver. And then the complex geopolitical negotiations in West Asia, where U.S., Iran are still coming out with various statements. Markets do not believe that you could be looking at an easy resolution out of this, is what has been supportive as well. On top of that, there is strong buying momentum that we have seen come in for investments, institutions, investor demand as well. The ETFs have started to come back as well, and online gold buying has been on the stronger side. And then China, within the central bank buying has been the strongest one. 20 months of strong straight buying for the month of July as well. Clearly is a strong streak that China seems to be putting out. China is, of course, one country, but when you look at various Asian countries, European countries, even some newer countries, the central banks are now buying gold, adding into their reserves. The short covering and the speculative buying has been strong as well. And when you look at the silver bullish positions, well, they are the highest in last 2 months. So that tells you on the kind of money that seems to be coming in. And then to top it all, it is the India festival and wedding season, and the latest exhibition and the kind of pre-bookings that the markets are reporting does seem on the stronger side, also supportive in sentiment for gold and silver, both of that. Take a look at the forecast then on what the major Wall Street banks and brokerages believe on where the gold prices could be headed. The most bullish one comes in from JP Morgan at $6,000 an ounce. Goldman Sachs is talking about 5,400 as a level by the end of this year. You have Metal Focus talking about 5,000. And then various banks like Deutsche Bank, HSBC and ING are putting gold prices anywhere between 4,600 to 4,900 by the fourth quarter of this calendar year. Currently, the gold prices are trading at $4,400 an ounce, so clearly bullish cues coming in for this one. And finally, you have the US CPI and PPI inflation numbers coming in on Wednesday. That is where the markets will take further cues from.
All right. Well, Manisha, thanks very much for that. Commodities in focus. Well, on the other side, we have Lata, who will take you through the next conversation with the Macquarie Capital, Suresh Ganpati, on how the different financial sectors fared in the first quarter of FY27. Different sectors, different segments basically fared. So that should be an interesting one. Stay tuned, coming up.
welcome to Corporate Radar. State Bank's results signal the end of the earnings season always, especially for financials, and it's time to look at the report card. Look for winners and losers in the Q1 earnings season. I have with me a person who's absolutely adept at it, Suresh Garpati, Managing Director and Head of Financial Services at Macquarie. Suresh, good morning and thank you very much for joining us. Well, first up, how has your ordering of stocks changed? What are your winners and demoters?
Yeah, I mean, clearly perhaps the smaller and the mid-sized private sector banks seem to have done well compared to the larger ones. Most of them, barring ICICI, has actually faced margin pressures going into the quarter. So purely from a very near-term quarter perspective, and in fact, even taking into account the next quarter, the margin pressures for the sector broadly continue. The smaller ones are relatively in a better position because they are able to lend faster. They're growing the retail loan book faster compared to bulk of the corporate loans going to the large private sector entities and to some extent even PSUs. So while the money which is being raised through the FCNR route is positive over the longer run, near term you'll see across the board tough times for the banks and better times for the NBFCs is how you should look at it going into the near term.
Oh, okay, that's interesting. Well, let me start with the one that was of the last State Bank. It was quite a stunning set. Have you upgraded it in terms of price and rating? Your concerns, if any?
No, so we haven't changed our rating or outlook. We, of course, have an outperform or a buy rating on SBI. It's one of the better PSU banks to own. Valuations are attractive. In fact, they did a better job on the margins front. And I think where the stock, of course, has taken some kind of a pullback or a breather is the fact that the deposit growth, Lata, has been pretty weak, right? So if you look at the new LCR ratios, it should disclose oppose the new April 1st guidelines of the Reserve Bank of India. The LCR numbers never necessarily went up for SBI by a wide margin. So net, what has happened here is that your deposit growth is weak. Your LCR numbers have not necessarily gone up, which means that at some point in time, your loan growth will have to come down because your deposit growth is not catching pace. And to that extent, of course, the market has taken it negatively. And the guidance also from the chairman, sir, is from loan growth coming down from 18 to 19%, more down to 14 to 15%, which is a more realistic outlook considering where the deposit growth is. And the deposit growth is sub 10%, Lata, right? So the FCNR money can push it up, but it is not going to push it up to 18%, right? Which is where the challenge has been for SBI. Yeah.
Okay. Well, now that SBI is done, let me get back to your earlier answer. You said the NBFCs are the ones that stand out for you as better prospects. Clearly, the numbers were stunning. Almost all of them are growing over 20% in loans. But now you have this, revolving credit draft rules on their head as an overhang. How do you assess that? Will that dampen NBFCs to some extent, especially the king of them all, Bajaj Finance?
Yeah, look, I think that going into the first quarter itself, if you look at the numbers, they were very strong, and the pipeline is also pretty strong in terms of the credit growth outlook. So on the contrary, the NBFCs were running at a level higher than the earlier expectations, and it looks like El Nino or the war is now less of a concern. At least it doesn't seem to be going by the situation on the ground with respect to overall demand. So where you could have landed up being a slightly higher number, now the new revolving credit guidelines will act like a small dampener. But having said that, it all really depends upon interpretation. So where I see the bigger impact is if at all inventory funding or supply chain credit also comes under revolving credit definition. Now, if the RBI puts that, then of course most of the NBFCs would be at risk with respect to a slightly slower loan growth compared to what we had earlier envisaged. The only person whom I do believe the NBFC, which is a larger proportion of retail revolving credit, possibly could be BAF versus some of the other NBFCs. But supply chain, everybody do, Lata. So if that also, everybody does, sorry. So if that also comes into the purview of revolving credit, then there can be some downside to the NBFC growth estimates. Otherwise, the overall growth number should look very strong. And this I'm talking more about on the AUM growth. But if I were to really look at on the earnings growth, the fact that the RBI policy itself was quite dovish, which means margin numbers are still going to be relatively okay. Credit cost continues to be very low, and all of them are controlling their OPEX. So net at the earnings level, things will still be very strong, even if you have a slightly lower loan growth.
Okay. Actually, the extreme interpretation is that anything other than term loan is not allowed to NBFCs. Now, if you go that far, then even margin funding loan against shares will have to be cancelled, disallowed. My sense is the Reserve Bank is worried about evergreening. It will hardly come down and kill a sector which is doing so well and which is needed. So maybe we shouldn't go down that over-interpretation path and wait for the final guidelines. But Bajaj Finance itself will remain the king of the pack, which is what is the ordering within NBFCs?
Yeah, so we do prefer, as we have been saying, we do prefer slightly the lower valuation NBFCs, which are offering reasonable growth, both AUM as well as earnings growth, and the downside is relatively limited, coming from some of these guidelines, right? So if I were to take a view that supply chain inventory funding is not going to get affected, and this is going to be the retail flexi loan where there is a greater issue at this point in time. You have seen various reports talking about the fact that the non-household credit in India, non-housing sector retail credit in India is higher than as a proportion of GDP than some of the developed countries, right? So, I don't really find that interpretation correct, because a lot of these loans are gold loans, which are quite secured in nature, and none of the other countries have a concept of gold loan. But having said that, I do believe that RBI may take the retail flexi loans approach. If that indeed is the case, then likes of Shriram or AB Capital are better picks to hold in the current environment. Yeah.
Okay, that's an interesting interpretation. We will have to see whether RBI has any concern. Let me come to the ordering within private banks. The large private banks used to be the cynosure of the market, not the favorites anymore. What's the ordering over there?
Yeah, right now, Lata, the biggest challenges, apart from ICICI Bank, every bank has its own set of challenges if you were to really look at the top names. And unless and until we get clarity, the near-term performance can remain pretty much sideways, right? So, ICICI only becomes the very clear pick, because what's happened here is both HDFC and Kotak, unless and until there is a clarity on the CEO succession, the investors don't want to get into stock when there is an uncertainty about management transition, right? So that's a challenge. Axis, the performance has been a little bit volatile over the quarters, and there have been worries about margin pressures there and their ability to scale up the retail portfolio. And finally, you boil down with IndusInd Bank, where very clearly, to reach 1% ROA itself is a Herculean task, and to move beyond that is going to be even more difficult, right? And the stock is already trading at booked one-time price to book. So there are a whole lot of challenges in each of the other names, barring ICICI at this point in time. So the smaller ones like City Union have done very well, and those would be where my preferences and my pick would be.
Okay, it's only City Union. I was coming to the mid-cap private banks anyway as my next question. City Union, you've already said. Is there anything else that impressed you, say, Federal or any other?
Yeah, so Federal numbers have been strong. We don't cover the stock, so we don't have an official view or a recommendation on the name. But some of these smaller entities have been growing faster, have been improving their margins, have been improving their ROA. So as a sector, what is happening here, Lata, here is where markets or investors are willing to give higher premium or multiples to companies where they can see a decisive change in fundamentals. So be it in terms of margins coming up, or credit costs, or costs coming down, and very clearly all of them manifesting in terms of ROA improvement, though the absolute level of ROA could still be lower than that of any of the frontline private sector banks, the markets are willing to give a higher multiple. So the rate of change here is more important, where the markets are willing to give higher multiples.
No, fair point, fair point. Let me come to the insurance sector. Mind-boggling numbers from LIC. 60% growth. Is that your pick of the pack? And what about the pack itself?
Yeah, unfortunately the sector is in quite a tough spot, barring LIC. HDFC Life numbers were not very encouraging. If you look at the latest numbers which are being reported, many of the others are facing some kind of margin pressures. There is a regulatory overhang which is coming in terms of commission caps. So we'll have to see how that shapes up. Interestingly, what happens in case of LIC here is that because the EV, the embedded value, is so large a number, even when you report a 60% growth in VNB, doesn't move the EV, because the contribution of VNB, value of new business, to the overall outstanding EV is just 1% or 2%, right? So the EV doesn't necessarily move, and the EV largely consists of market stocks, right? Liquid stocks like Infosys or TCS, all these liquid stocks. So while while we do believe that the VNB numbers are very strong, the market doesn't look at that way. So you have to look at more in terms of price to EV. That also is cheap. I mean, 0.5 is also cheap, 0.8 it is also cheap. So the way we are arguing here is that I think a 0.7 and a 0.8 times is far more realistic and a reasonable outcome for LIC to give a 25% discount to EV. And that itself gives you a good 25% upside from current levels. And a good that the major overhang is over. I think the stock didn't do well at all because the markets were clearly anticipating this IPO, this FPO coming at a significant discount, which indeed happened. Now, once that overhang is over for the next 2-3 years, we're now going to see the government hopefully coming and doing an OFS because they've already met the SEBI norms of minimum public shareholding. LIC remains a much better pick in the current environment than any of the other life insurance companies, especially going into an environment when you're waiting for the commission cap regulations of the IRDA.
I never imagined I'll be doing an interview at the end of a results season where the expert will tell me that LIC and SBI have done extraordinarily well and HDFC Bank is not among the buys.
And HDFC
I mean, how
Life,
things
right?
change.
Yeah. And HDFC Life also, right? So both of them have actually not done well for the quarter. Yeah.
Okay. Well, finally, we have to come to the fintechs. PV fintechs numbers were like absolutely superb, despite the fact that, you know, insurance sales itself is slowing.
Yep.
So, I mean, actually compare all the fintechs. We have to put Paytm and PB Fintech, all of them in the same basket.
Yeah.
What would the ordering be?
Yeah, so look, right now, and we do have a neutral rating on Paytm, but you know, this UPI thing, stock has already rallied so much in the last 1 week or so that I think a lot of this is already getting priced in. You know, I mean, the UPI MDR is also going to be on select transactions above perhaps 2,000 rupees and stuff. The way I look at it, this Lata, is like this, right? I mean, Paytm, for example, I'm just giving Paytm as an example because that's the stock that we used to cover. They used to get about 280 to 300 crores incentive annually from the government. Okay. Now the incentive which they're getting annually from the government, because the allocation under the UPI and budget itself has come down, that number has come down to 80 crores. Now what this MDR and UPI will do here is that effectively that additional 200 crores which you're getting from the government will now be compensated by allowing you to charge an MDR on UPI.
Yeah.
So you just go back to the original level, and that's how the entire structuring would be done, right? So now to get too bullish on this is something I find it difficult to digest, especially the fact that the stocks have already rallied.
Yep.
And also what has happened here is that PB Fintech unfortunately is also getting affected because of the commission cap regulations. Now, while the current numbers are very strong, the worry here is that you know, these guys have an 18.5% take rate, right? Insurance commissions divided by insurance mobilization that they do, the premiums. Now, if I change that by 1 percentage point because of a cap which comes through, the EBITDA goes away by 25 to 30%. So it's very highly levered to that because it's a high operating leverage business, right? So slight dip in volume and commission take rate can take away 25% of your EBITDA. So it is a tricky situation there. So then you go to a cleaner bet where very clearly Paytm is doing well, numbers are good. And on top of that, you get this UPI, it directly adds to your EBITDA line item, right? And that's where the market has been crazy about this and some of the other fintechs like Pine Labs and other companies, right? Yeah.
Absolutely. Out of time, Suresh, but if you notice, for once, it is not just how good the companies have been in their performance, but it is how the regulations will shape up. Whether it is insurance, whether it is NBFC, even whether it is banks, the MDR and other issues of fintechs. So watch this space. We reporters and analysts will continue to be somewhat important. Thank you very much indeed for joining us.
Thank you.
Well, that's it on this edition of Corporate Radar. Thanks for watching. After a break, Chartbusters.
Crude prices spike about 5% overnight as the United States and Iran harden their stance over the Strait of Hormuz. ONGC and Oil India trade higher. Refiners and aviation stocks slip. Bosch delivers a solid showing in the first quarter with strong EBITDA growth and margin expansion. The management says that the higher demand in passenger vehicles drove growth. The stock is up close to around 3.5%. Gland Pharma also reacts to a stellar set post its first quarter numbers, where profits grew nearly 50% year on year. The management raises growth guidance for FY27 from 12 to 13% to 15% earlier. Stock up 7.5%. Hospital stocks dip but recover from lows as the Parliamentary Committee on Healthcare recommends capping hospital room rates to 3-star hotels. The management of HCG tells CNBC TV18 that the room rent only forms a fragment of their revenue. Idea Forge is a stock which is lower by about 5% as supply chain disruption hits the execution of the company. The stock down 5% in lower circuit. Well, hello and welcome to Chartbusters. We're coming to you live from CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets have started off a little bit on the back foot. Uncertainty with regard to the globe. The Nifty Bank is well under some pressure. That's underperforming in today's trading session, which explains why we're a little bit lower rather than higher as we speak. Mangalam? Take that point, Nigel. Let's see whether there is some supply coming in at higher levels once again, given that we are down about 100 points. But at the same time, we'll monitor whether there is support or not, because it is Tuesday, weekly options expiry. Market expected to be in a bit of a range with a fair amount of volatility. Though a couple of stocks doing extremely well this morning. We have Kolte Patil, which has seen a surge of almost 15%. Chennai Petro is up around 9%, direct beneficiary of higher crude prices. We have Gland Pharma on the back of numbers. Amara Raja, that's the one which is surging about 7% right now. And for the second day running, we have InfoEdge. Post its numbers, the stock was up 5% yesterday, follows it up with a near 6-7% gain today as well. So the management fairly positive on the prospects of the company. InfoEdge is the one that comes up around 6.5%. Good time to get in Rajesh Palvia for a quick technical check on the market. Rajesh, it's a down day so far. The Nifty Bank is below the important levels of 20 and 200-day moving averages as well. Do you think it's about time before we recover, or this one looks like it may be a little more weak than better?
Yeah, hi, good morning, Mangalam. So in the previous trading session, we have seen the major call writers were confident at 24,600 strike. But since today's opening, the major call writing activity has been witnessed at 24,500, 24,550 strike also. So which creates some more pressure on the market. On the downside, put writers are shifted their position at 24,400. So there is pressure in the market. The range has shifted slightly lower compared to previous trading sessions. So now range has shifted to 24,400 to 24,550 for near-term play. But broader market is showing different behavior. We have seen a lot of stock-specific activity in the market. Buying interest is there in mid-cap, small-cap space. And some of the sector where, continuity of uptrend is there, where, buyers are still confident and they are buying and riding the stocks and sector where strength is there. Bank Nifty is under pressure. It's not able to take out the major supply zone. Bank Nifty attempted to cross 58,000 but failed multiple times to cross those level on a decisive manner. And we have seen some more pressure from call writers front in the Bank Nifty, and they've shifted their position at slightly lower strike. So here it's a dragger for market at this moment. So 57,000 is the crucial level for Bank Nifty for near-term perspective. If it's break, then we may see some more pressure to come in from the Bank Nifty and banking stocks in the near-term structure. But the stocks from the automobile, pharma, new age companies, metal, these all pockets are showing sign of strength and mixed behavior in the IT space also. So I think these are all pockets where one can focus on, and here are opportunity to remain on the long side of trade, and continuity of uptrend would be there.
All right, a quick word with regard to LIC. Rajesh, that's been a big underperformer. The government came in there, sold some stake. The numbers are quite good. It's come out of the F&O ban and the bulls are latching onto it. But is it good for more?
Yeah, Nigel. So I believe that, the kind of pressure which we have seen because of OFS pricing, I think again, this stock has again came out from the main, and buying interest is clearly there in this counter. And looking at the open interest in today's session, we believe that, furthermore upward momentum towards 415, 425, we could see in the coming days. So LIC, yes, risk to reward is in favor. One can look to buy here also with stop loss of 400.
All right, you speak about LIC up 4%, stock to buy from a technical standpoint, but does it have fundamental legs or not? We go across to our special segment. We get you ideas for profit, and one of the ideas for profit today is LIC. Neha Dave of Money Control Pro joins in.
Today's stock idea is LIC. The stock of the insurance giant has been languishing ever since its IPO. While the stock gained traction recently after strong FY26 results, the offer for sale by the government at 10% demands. Consequently, in terms of valuation, LIC is currently trading at just 0.6 times its embedded value as of March 26, which is at a steep discount to listed private peers. However, the distressed valuation is not the only reason to consider LIC. The margin story for LIC has been gaining traction. LIC's value of new business margin improved to 23% in Q1 FY27, an expansion of 750 basis points YOY. This was mainly due to better product mix. While maintaining healthy top-line growth, LIC has been focusing on growing high-yielding product segment ever since its listing. This is reflected in the share of non-participating business, which has improved to or increased to over 32% of annualized premium equivalent in Q1 FY27 compared to just 9% in FY23. Management is expecting the margin improvement to continue further. The government's stake gets reduced to 90% following the OFS, and further stake reduction is unlikely over the next 2 to 3 years. A rich product mix, expanding VNB margins, and distressed valuation has finally set the stage for the long-awaited re-rating, which, along with the growth or increase in embedded value, can lead to a meaningful upside for the stock.
Okay, got it, Neha. Well, Rajesh, coming back to you, we got your view on LIC, but you have a couple of more picks, so let's get that out of the way.
Yeah, sure. So the stocks where we are focusing on the long side of trade is from the pharma space, that is Divi's Lab. After a brief profit taking, again, stock is attracting buying interest, and looking at the strength across all time frame, we believe that, Divi's Lab has potential to again regain its all-time high trajectory. So we are projecting target of 8600 to 8650 for near-term trade. On the downside, 8300 needs to keep as a stop loss. Another stock where we are focusing is APL Apollo Tubes. Stock managed to give breakout of falling channel on a weekly chart, and looking at the buying interest since last couple of weeks, we believe that, this stock has potential to extend gain, projecting target of 2070 to 2090. On the downside, one can place stop loss around 1990.
All right, take that point. Thanks a lot, Rajesh. Always a pleasure speaking with you. We take a short break. Come back on the other side. We have the management of TVS Supply Chain joining in to discuss their first quarter numbers. Stay with us. Welcome back. The pharmaceutical pack is actually doing quite well. We have Divi's Labs, which has now moved to the high point of trade as well. And across the board, we are seeing gains in that sector. So the pharmaceutical index also comes up for you, currently at the high point of trade, led higher by some of the heavyweights. And alongside that, we had good results also, which have some positive tailwinds for the sector. That index comes up for you. But the stock on our radar is TVS Supply Chain. Reported a good set, a 29% revenue growth led by a lot of the new businesses, which accounted for nearly a fifth of their revenue this time around. And the company is confident of achieving mid-teens growth in FY27 as well. We do have with us Vikas Chadda, who's the managing director of the company, who joins us now. Thanks a lot, Vikas, for joining in. And congratulations, it's a strong set. The only question that begets asking is, you've given a mid-teens growth guidance. Is that not conservative, given that you've grown at 28% in the first quarter already, with your industry typically doing better in the second half of the year? So is a more realistic number between 20 and 25% as against mid-teens?
So first of all, thank you for having me on this call. Look, in terms of our aspiration, we are a firm believer that we should promise less and deliver more. I completely agree that the quarter one performance has been spectacular. We have achieved 28%, 29% growth. And with that, the aspiration that we are setting for the full year mid-teens may sound a little conservative, but we also have to remember that quarter three and quarter four of last year, we had tremendous performance. So we are on a growth momentum, and hence we would like to keep this as our guidance, but definitely I'm very confident that we'll do better than this.
Okay, all right. Hi, Mr. Chadda. Welcome to the show. This is Nigel on this side. Let's talk about your GFS segment. Oh, there the growth is close to around 50% and the margins have improved a little bit, close to around 4% or thereabouts. What is the trajectory you're looking at with regard to this business? What kind of growth number? And where is the margin headed?
Yeah, so our freight business had a spectacular quarter one. As you mentioned, we grew 50%. The margin grew actually almost 200%. The growth was in acquiring a lot of new customers. India drove a lot of the growth. And I would say that I would like to congratulate the GFS team for such a stupendous quarter one. I see that we have already reached a number of 4% in terms of 4.1% in terms of the EBITDA. I would like to say that this will continue on an improving trajectory, and at some point of time, we should be able to achieve 4.5 and maybe even up to 5%.
All right.
In terms of the growth, some of the quarters may not see such growth that we saw in this particular quarter, because given again the same point, Q3, Q4 of last year, we had a strong performance. However, this business will also be able to deliver. If I look at the current volumes that July and August are presenting, I think it makes me very confident that GFS will have a good year.
All right, makes you confident that GFS will have a good year. Let's get two numbers out of the way then. Your India revenue share from 27% last year is now up to 30%. And it's led by GFS, which also in your overall mix has increased from 24% up to 28%. So on both these fronts, what is the ideal contribution? How much faster than the overall business will these numbers grow?
Look, in a 3-year time frame, with a lot of the other strategic initiatives that we are doing in terms of partnership with the ALA Group, acquisition that we did of Swamy and Sons, and maybe some more announcements to come in terms of further partnerships, I would say that in a 3-year time frame, I would look at a 40% turnover coming from India, and that's the goal towards which we are working. Not to say that the other geographies are not going to grow. Like this particular quarter, all the other geographies will also continue to grow. In terms of GFS being almost growing faster than the ISCS business, I would say that this growth was also, I would say, very difficult to repeat it like this kind of a growth number, 50%. But again, our focus business is ISCS, which is more profitable. And ISCS also in India grew tremendously this particular quarter. So we will continue to see both growth in ISCS and GFS. And as I said, India is a very, very focused geography for us. And our aspiration in 3 years would be to achieve 40% of our revenue from India.
In an absolute number, would you have a target? Because basis what you've been speaking, if we just back calculate, India could actually be anywhere between 7,500 to 8,000 crores over the next 3 years. Is that a possibility?
Definitely. So, as you look at it, one is the organic growth that we are doing. Second is the acquisition of Swamy and Sons, which is a very small number in these financials because it was acquired only 40 days of numbers are there. There is a lot of potential there to grow the business. We also have mentioned earlier about the joint venture that we will form with ALA Group, which will be for the defense and aerospace sector. That is a completely new sector for us, and there are a lot of established contracts that exist with ALA Group has with Boeing and Dassault and Airbus. And once our warehouse is certified here, Indian customers, large customers will consume those products. So I'm very bullish about that joint venture as well. So I would say if you put the organic growth potential that we have on the existing business, which is growing so fast, 40% this particular quarter, plus you add on top of it the ALA JV opportunity, plus you add the incremental that we are going to get from Swamy and Sons, I would say that this is an aspiration. If we don't get to 40, maybe we'll be 35, 36, but that is something that we aspire to reach. And I has also said that we're also looking at more collaborations in certain other value stream of the supply chain where today we are not present. And some of that will also have an incremental impact on the Indian revenue.
All right. Mr. Chadha, moving a little bit away from the operational performance, 32% of the promoters' holding appears to be pledged. Could you give us some rationale why? And what's the plan with regard to this pledge?
Well, the plan is definitely to reduce it. And I think we're looking at a time frame within this particular year itself to bring it down. And you will see as and when we make progress on that, bringing the pledging down. Definitely, it is a topic which is discussed, and this is something that our promoters are committed to.
So in this year, the promoter pledge will come down, right?
Yes.
Okay.
Will it be entire promoter pledge or would it be part of it?
Oh, no. It will be in partial steps, but it will come down in this.
Okay. And what about your return ratios, ROE, ROCE? You're talking about scaling up business. You're giving us the business mix as well. Return ratios is what gets you the multiple. Where is that headed?
Yeah, we have room for improvement in terms of our return ratios, definitely on the ROCE front as well. Over the last couple of quarters, we have, and even the last full year, we have invested into a lot of the projects in US and including in India, which over a period of time will scale far more. So the return on some of these projects will become even better going forward. So I'm fairly confident that this number will only keep on growing north. And also, when we are picking up the new projects, we are being very, calculative about picking up only accretive projects at this moment. So I would say a combination of some of the investments that we have done last year, bringing further fruit, and the further projects that we are winning, they delivering better returns. So I would say the returns will only improve throughout the year.
Do you have a North Star here? Do you have a North Star here, Mr. Chadha?
In terms of the
aspirational ROE or ROCE?
Well, we need to get to 15% and beyond, and that is what I would say.
That is on the ROE or ROCE?
Yeah.
Okay, I'll take that as 15% for both ROE and ROCE. Thank you so much for joining in. Wish you good luck for the remainder of this year. And you've promised that you will be mid-teens, but you're confident of beating that this year as well with 4.5 to 5% margins in the GFS business. Over the next 3 years, India accounting for nearly 40%. The stock, which was about 2% lower when we started this conversation, has seen a smidge higher. So let's see where this goes from here on as well. Take a short break, come back, get you more on the markets. A lot of stock-specific action. Stay with us.
Welcome back. Well, keep an eye on a couple of stocks in the broader markets. Astra Micro, that one in the con call has said that they're looking at revenue growth of around 15 to around 20%. In the press release, they had mentioned close to around 10 to around 15%. It seems that could be one of the reasons why the stock that had dipped to below 1700 odd is now at the high point of the day. We'll try to pull in the management and get an interview going. But that appears to be the stock that has perked up in the last few minutes. That said, the other one that's doing very, very well is Bosch. Hormuz joins us to help us out with a breakdown of those numbers. Hormuz?
Bosch has a strong operating performance this quarter for Bosch. If you look at the top line number as well, revenue growth of over 20% this time around compared to last year. And the profitability figure, of course, optically it will come across as if the numbers are down on a year-on-year basis. But that is, of course, because of the fact that the base quarter had an exceptional gain of around 550 crore. And that has impacted the bottom line this time around. But look at the operational performance. EBITDA is up 28% from last year to over 800 crore. Margins too have expanded from last year as well, from 13.5% to well over 14% this time around. So it's continuing with that trend of a lot of these auto ancillary companies reporting strong results this time around. We saw that from Samvardhana Motherson as well last week, and now we're seeing this from Bosch. Now they've mentioned the fact that growth was driven by higher demand in the passenger cars and the off-highway segment, and they're saying that the Indian passenger vehicle industry is transitioning to more cleaner, personalized vehicles, and they are well positioned to cater to this transition. And they've also said that the two-wheeler business, which in fact was the fastest growing business among all of them this time around, a 41% growth compared to last year, led by strong traction in the EMS products and increased sales to premium motorcycle platforms. So doing well for itself. Bosch 4% higher at record high levels is the stock, and in top gear today.
Oh, indeed, in top gear today. Thanks a lot for that, Hormuz. What we'll do is we'll go forward and look at the way the market's doing as well. 100 points lower for the frontline index. The mid-cap index actually has recovered a fair bit from the lows and now just about on the verge of breaking into the green, down by just 25 points. Paytm, that's a stock. This is the stock of the week, in fact, was up around 8-9% yesterday and following it up with a gain of almost 3.5% right now at the high point for Paytm. With that, we'll take your leave on this edition of Chartbusters. You stay tuned, don't go anywhere. The team of Trading Hour comes up next. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam, with me Hormaz and Ritu. We start off on the back foot largely on account of higher crude oil prices. They're now at 88 and the rupee also weakened a tad, and as a result of which the Nifty at the low point of trade with a cut of almost 120 points. We've seen the Sensex down 400 points and the Nifty Bank has broken below important levels of both the 20 and the 200-day moving average. The only thing that's holding the market right now are a bunch of good earnings that continue and good news for a bunch of stocks as well. Case in point, something like Bosch, decent commentary, decent earnings. We have 197, Paytm, which has been doing well yesterday, continues to do well today as well. And alongside that, we have names like, InfoEdge, which were big gainers in yesterday's trading session post numbers, continue to surge right now as well. So barring earnings, there is a sense of subdued moves in the markets. Hi, Ritu.
Good morning, Mangalam. It is subdued on the markets, looking pretty red across the screen with some exceptions here and there, but all the actions very much in the individual names. The IT pack is holding up, flattish though, at the moment, trading with gains of about 0.13% as we speak. The small cap index as well, trading with gains of about 0.4%. The mid cap index is very much in the red. The bank Nifty pulling the frontline index down. That's trading with cuts of more than 400 points as we speak. And, the advanced decline ratio shows you where the lines are. I mean, you have more stocks that are declining than the ones that are advancing, about 1523 stocks on the decline versus about 1480 that are on the rise. What's holding up relatively better today in trade is the pharma, realty, and of course the IT and auto pack, but pretty much everywhere else, it's a sea of red. So let's go across to Hormaz as he puts a spotlight on the top movers and shakers. Hormaz.
Well, we are supposed to defend 24,500 on the downside. That has not happened, at least as of now. 24,450 is where the index is. The next level comes in at around 24,400 on the downside. So 130 points lower at the lows of the day. The futures, again, are about a 70-point difference between the spot and the futures price. We're around about 24,520 on the Nifty futures as of now. You look at the Nifty Bank, that's the principal culprit as to why the Nifty is down today over 100 points. So 400-point cut on the Nifty Bank, and that has after near about a 100-point recovery from the lows of the day. So it's managing to defend the 57,000 mark, at least as of now. Was close to defending 57,500 over the last few trading sessions. At least it has not happened for the first couple of hours of today's trading session. Here too, a 250-point difference between the spot and the futures price. The futures right now exactly at 57,500 is the level that we were mentioning. As Mangalam was highlighting, there are plenty of positive result reactions that are keeping the broader markets afloat, as keeping the advanced decline even. Stevens Kolte Patil is now up 16%, and this month of August has already turned out to be the best month it has had since April of 2020. And Gland Pharma too, another positive result reaction for it, 8% higher on the stock. Bosch, of course, record highs now well above 45,000 rupees for the stock, 4% higher as well. On the flip side, Triveni Turbine has not had a very good day today after its results, 6% lower on the stock, the top loser on the Nifty 500 today. Jubilant Pharmova is down 4%, Idea Forge is in a lower circuit, and Antony Waste as well, 6.5% lower after its numbers. Godavari Biorefinery is among the newsmakers today. It has received a patent for a very important drug, 13% higher now on the stock. In fact, Aarti Pharma Labs, after its results, was up 20% yesterday, adding another 12% to that list. Amara Raja came out with numbers yesterday. That's another 7% in today's session. And LIC out of the F&O ban in today's session and seeing gains of well over 4%. And lastly, you look at stocks at record highs. Chennai Petro is steaming ahead now, 9.5% higher on the stock at record high levels. Ather Energy, another day, another record for the stock, 4% added to this one as well. Lumax Auto is now up 19%, well over 2,000 rupees now and at record highs. And Shaley Engineering too, 3% higher at record high levels, Mangalam.
Indeed, we take that point, Hormaz. Thanks a lot for that. Since you're speaking about a bunch of stocks which are moving around on the back of numbers, most of them on the way up. One which is lower and locked in a lower circuit is Idea Forge after reporting a weak performance. Ria joins in with a bunch of the number crunching. Ria.
Well, weak quarter for Idea Forge indeed, which is why the stock is locked in a lower circuit of 5% today. This time around, the execution for the company has been impacted by supply chain disruptions in a quarter that is already seasonally weak for defense companies as a whole. The revenue this time around has gone up by 437% compared to the previous year, but on a sequential basis, it has come down by 50%. EBITDA has turned positive at nearly 2.5 to 3 crores versus a loss that we saw of 19 crores on a year-on-year basis. But margins margins have fallen sharply to nearly 4% versus around 44% margins that we saw in Q4 of FY26. Net loss has also narrowed to nearly 2.5 crores versus a loss of 24 crores that we saw in Q1. But remember, in the previous quarter, in Q4, we have seen a profit of nearly 60 crores for the company. Gross margins have also fallen off sharply to just 49% versus 62% that we saw in Q1 of last year. The current order book has also moderated to nearly 257 crores versus a 314 crore opening order book for FY27. And the company has come out and said that they have executed nearly 20% of the FY27 opening order book in Q1 itself, and they are targeting to complete the execution of the remaining opening order book by Q3 of this year. So going forward, it will remain key to watch what the order inflow guidance is for the full year ahead. And apart from this, the company also expects defense procurement activity to accelerate in Q3 and Q4. So overall, H2 is expected to be stronger for the company, but results remain weak for the first quarter.
Ria, thanks very much. The second half is expected to be better, but a weak set there from Idea Forge. We'll move on to some other earnings we're focusing on. And again, it was a weak show in the June quarter, which tracked the shares of Triveni Turbine. Let's bring in Vinny Motiwala to do the number crunching for us in this one. Vinny, I know you're standing by for the mutual fund data, but quickly fill us in on Triveni Turbine.
Triveni Turbine, like you said, it's a weak set of numbers that's come in Q1 FY27. It's a miss versus what the analysts were expecting on the street, right? Revenue, though, is seeing a growth of 19.3%, approximately 442 crores is what the revenue is coming at. Margin is where the big miss is, right? 11.6% versus 19.8%. So around a 600-700 basis point contraction in terms of margins versus last year. Overall, this time in terms of the profits of the company, that's seen a decline of 20% as well. Now, order inflow stands with a growth of around 6% on a year-on-year basis. Domestic revenues managed to see a growth. Export revenues managed to see around 11% growth this time as well. Margins, where we saw that contraction coming in, what impacted the margins? It was unfavorable mix, the price escalations that came in, as well as delivery phasing for some of the strategic orders. That is the reason why we're seeing a subdued performance in terms of the margins. Management commentary indicates that because of these geopolitical tensions and uncertainties in West Asia region, near-term fluctuations are still something that could keep the pressure in the near term. They are confident that the second half of the year could be better, and one will start seeing improvement in terms of margins as well as in terms of the revenue growth of the company as well. But today, as of now, because of the weak set of numbers, the fall in the stock price.
Vinny, thank you for that update there. 6% lower on Triveni Turbines. Take a short break. On the other side, put the spotlight on the bond markets with Manisha Gupta.
watching Trading Hour, and as we promised, let's get you all of the action that's coming in from the bond market. And who else than Manisha Gupta to fill us in. Manisha.
Well, thank you so much for that. When you look at the international markets, we are looking at the crude oil prices trading higher. The U.S. Treasury yields are slightly on the higher side. And then, of course, it is also about the dollar index, which is trading on a firmer note right now. For the Indian markets, we're looking at a very range-bound trading here. It actually is a decline that you're looking at in sense of bond yields on corporate markets. This is because of the weekend flows that we have seen via FCNR deposits, which have not actually translated into corporate bond market. The government bond market, of course, has seen a huge inflow coming in, but corporate bond market hasn't been able to make use of that. The volumes in the secondary market also have seen a decline on Monday vis-a-vis what we saw on Friday, but the most active trades within the secondary market seems to be coming in for Bajaj Finance, Telangana State Industrial Infrastructure, IFL Finance, and also Bajaj Housing Finance, Cholamandalam Investment and Finance Company. These are some of the companies which actually have been quite actively traded in the secondary market. Take a look at the primary market then, and the private bond issuances for the day today stack up to nearly 16 billion. Within this, the three major companies which are looking at major amount of chunk of that money is Tata Capital Housing Finance, which is looking to raise 7.5 billion, and they're doing it via reissuances of 7.86% September 2029 bonds. Second on my list is SK Finance, and they are looking to seek bids for 5 billion, and they are doing it via issuances of 3-year bonds there. And then you have IKF Finance, which is also planning to raise nearly 2 billion, and they're doing it via issuances of bonds which are maturing in September 2028. And finally, there also are various merchant banker reports. Official confirmation from SBI is yet to come, but they seem to be in the market, and they're looking to tap the dollar debt market through the public reissue. They are planning to raise nearly sale of 5-year bonds and likely to raise nearly 50 crores via this. Remember, SBI also had planned nearly $1 billion that was in the month of June but was deferred, and markets do believe that SBI perhaps could be coming into the market in smaller chunks at this point in time, and this is as per the merchant banker reports, which suggests that 50 crores is what SBI is looking at to tap into markets right now.
Manisha, thank you for that update there. The market's now around about the 24,450 mark as we speak. Take a short break. On the other side, talking technicals with Dharmesh Shah of ICICI Securities. Some trading ideas as well on today's weekly options expiry. Stay tuned. Welcome back. Here's some other broader market movers on the downside today. Now, Aditya Birla Fashion was down after its results yesterday. Is extending those losses, down another 4% in today's session. Castrol is down 3.5%. Jubilant Pharmova too is down around 3.5%. And Max Financial coming out with numbers later is also down close to 3%. Numbers from KPI Green as well at the bottom of your screens. 18% drop in profit. To see the operating performance, that'll be more important to watch. Good time to get in Dharmesh Shah from ICICI Securities for a quick chart check and some trading ideas as well. Dharmesh, good morning. Thank you for taking out time. Well, we're still around about that 24,400, 24,500 range on the index. How important is it for the index to defend 24,400 today first? And of course, your trading ideas for the morning.
So good morning, Hormuz. Absolutely, I think so. If you look at the Nifty for last few trading sessions, we have been trading in this range of 24,300, 24,600, 700 on the higher side. But it looks like, I think so, the way that formation or the way the technical setup seems to be forming for the Nifty, it looks like market should hold on to this 200-day moving average. It is placed at around 24,300 levels. So yes, in the near term, we have seen almost the 1,100 points rallies from the bottom of 23,600. So market was some bit of a overbought, and I think so that is what the market seems to be digesting those gains. Going forward, what important and interesting point to look out will be, I think, so the market breadth. I think so. If you look at the percentage of the stocks which are trading about the total CNX 500, about 200-day moving average, it is currently at around 58%, compared to the April swing high of 2026 was around 41%. So it clearly shows, I think, so the massive improvement in the market breadth, more of a broad-based rally, supported by, if you look at the mid cap, small caps, I think so. The ratio chart of Nifty small cap versus Nifty has witnessed 8 years of falling trend line breakout, indicating, I think so, going forward, mid caps and small caps should relatively outperform the Nifty. So yes, the near term, we see some bit of a consolidation, but looking at the market breadth and looking at this broad-based rally, we expect Nifty to head towards 25,000 by the month in the coming month, with strong support placed at around 24,000. So buy the dip should be the strategy, with strong support placed at around 24,000. As far as stock strategies are concerned, yes, definitely the way the things are panning out in the mid caps, small caps, we remain to be constructive, positive for Nifty mid caps and small caps, where BEML remains to be a topic inside the mid cap space, where again, if you look at the stock, I think so, has done nothing for a long period of time, has been consolidating in this range of 2,000 to 1,800 levels. But post results, we have witnessed a strong sets of volumes, which on the weekly chart seems to be on the verge of a breakout above 1930. We expect, I think, the stock to head towards 2012, keeping a stop loss of around 1974. So BM is one which we like in the near the mid-cap space. Apart from BML, again, Gujarat Mineral Development, I think so. GMDC on the metal space, I think so. The one, again, the stock has witnessed a falling trend line breakout. So, and forming a strong base above 52-week EMA post such corrections, indicating, I think so, the good days are likely to going forward for the GMDC. We expect stock to head towards 640, keeping a stop loss of 569. So again, BML and GMDC remains to be a topic at the current market price.
Or sparing time and joining us with your views on the index and on your stock trading ideas as well. The index still around 24,450, but being the weekly expiry today, Mangalam, what's the FNO data indicating right now?
The FNO data is indicating that important support on the Nifty bank has been broken, but at the same time, we aren't expecting much in terms of a big move on either side. Where we are seeing the market position right now. We have the Nifty, which is lower, and a large part of that decline has been led by the financials. We have the Nifty Bank, which is lower by almost 400 points. The mid-cap index hasn't fallen as much. It's down only 0.25%. The advanced decline tells you that it's still split right down the middle, so not as bad as the frontline indices would have you believe. But the important part is, after some underperformance, the Nifty Bank is broken below levels which it was holding on to with a fair amount of strength. So the 20 and the 200-day moving average on both the Nifty Bank, both these levels have been broken today. 20-day moving average is 57,518. We have the 200-day moving average 57,480. So because they're two ends of the barbell of moving average, and both of them were pretty close to each other, this was an important support. Now that this is broken, conquering this will be extremely crucial. However, the option writers on the Nifty, they are fairly active. The 24,400 put, that's the one that should come up for you. That has a premium of almost 25, 26 odd rupees. That tells you that levels below 24,400, specifically around 24,375, 24,350, would see some support. But on the way up, you will have resistance upwards of 24,500. So the 24,400 put is up for you, and we now have the 24,500 put as well, call as well up for you. That has a premium of 30 rupees. So as we move towards 24,530 thereabouts, we will see some resistance. As you look at both of them, then the street is playing for a range of 24,350 to about 24,550 itself. That's a 200-point range. But we have important support levels as well, which are a lot lower than where we are currently, but they're support nevertheless. The Nifty Bank, 57,000 is the next important support. That's the 50-day moving average. And for the Nifty, the 20-day moving average at just under 24,300 comes in. So those are important levels to track as well. But amidst all of this, two stocks seeing a lot of long positions being added. LIC, as soon as it's out of F&O band, the street's rushing towards it. And we have MCX as well, which is seeing some long positions being added.
All right, so that's the F&O setup. Thanks very much, Mangalam, for getting us that update. Let's shift focus to the hospital and healthcare space. Now, these stocks are in the spotlight after a parliamentary panel's findings, which suggested private hospitals are charging almost 5 to 10 times more compared to the government-owned ones. Not just that, the parliamentary panel has now recommended a 3-star hotel tariff cap on hospital room charges and surgery rates. My colleague Ekta Batra is here to break it down for us. Ekta.
Thanks for that. Well, it's definitely a long report which has come out from the Parliamentary Standing Committee. So I'll just give you a brief in terms of what the differences are in terms of what they've highlighted. So hospitalization costs on an average is at around 6,631 rupees in the government versus over 50,500 odd rupees in private hospitals, and hence it's 7 times higher. Government health expenditure is 1.43% of GDP. Committee wants to increase this to around 5% over the next 5 years. Now, FDI in hospitals. This is one particular thing which has in fact been flagged in the report. The committee flags over 51% for foreign ownership or operational management in hospitals. The report points out consolidation and a monopolistic acquisition of mid-sized hospitals and recommends reviewing, rationalizing FDI limits for hospital acquisitions and management. Now, coming to hospital pricing, they've said that or they've recommended a framework to standardize and cap essential procedures, diagnostics, routine treatment. Hospital room tariffs should not exceed the average tariff of a 3-star hotel in the vicinity. Hospital systems, according to them, should be linked directly to approved rate schedules. Standardized, auto-generated, non-manipulable bills is basically what they are focusing on. Incentives for hospitals that earmark at least 20% of their beds for highly subsidized free treatment. Now, they've also recommended a pool procurement model which can be scaled across public and impaneled private hospitals so that procurement of medicines can then be cheaper. A PPP model or private-public partnership model for MRI, CTs at capped rates and shared access to expensive equipment. Ceiling prices proposed for PET, CT, MRI and genetic profiling, especially for cancer care. Now, insurance, 40+ crore people are identified as the missing middle in insurance. They've proposed for 4,000 to 6,000 rupees family per year. Cover with OPD benefits as well as which would possibly be a new insurance product. So overall, what they have focused on is basically FDI in hospitals. They have, come out with quite an indicative view on that, as well as hospital pricing to possibly be standardized.
Ekta, thanks very much for bringing us that update. Important for consumers as far as private hospitals are concerned. But also let's hear out from the management of Healthcare Global, who believes that the cap on room rents, that is a step in the right direction. Here's a word from their ED and CEO, Manish Mattu.
See, over the last few years, we have seen the laddering between room categories has come down, and there's not a big differentiator between, say, a double twin sharing at a private room. But however, of course, it does exist. But I'm sure, there will be a way to navigate this as well. I mean, we've navigated many things in the past, overall as an industry and Healthcare Global in particular. And this should, also be manageable in the foreseeable future if this were to be reality. I mean, the committee must have given it some thought. I mean, I personally may or may not agree with it. But let's see. I mean, I'm not even, let me see what the content of that recommendation is and before I can comment on. all I can say right now is that whatever the regulations be, Healthcare Global will comply with all of them. And I'm sure the rest of the industry too. I don't think there are any clues about. And I think it's a step in the right direction overall, because I think the larger goal of the industry also should be to balance profitability with social good. And I think the industry has done quite a bit in the last couple of years, and there's no reason why we shouldn't continue to move forward with the government on this.
Well, the hospital stocks and the reason why they are in the spotlight. Take a short break. On the other side, continue our conversation on the markets with Ashi Anand from IME Capital.
Welcome back. We have Ashi Anand from IME Capital, who's joining us now to talk about market fundamentals and his top sectoral picks. Ashi, always a pleasure having you here on CNBC TV 18. I just wanted to start with the financial space and more specifically this chatter about MDR on UPI. It hasn't been officially notified. We don't really know what the rate is really going to be. But upgrades have started to come in for some of these names. I mean, your thoughts, Paytm, Pine Labs, MobiKwik, some of the listed players in the space, and also, of course, the remitter and acquiring banks. Does your view change over the next couple of years simply on account of this MDR potentially coming in?
Yes, hi. Firstly, thanks for having me on the channel. And yes, this clearly is a big positive for anyone in the payment space. If you look at any of the kind of global counterparts in payments, there is substantial money and substantial margins they actually make on the payments business. So far, the view across a lot of the kind of payment platforms that we've been investing in and looking at, payments was at some level a kind of a low margin loss leader, trying to attract clients, but you were kind of going to make money by actually cross-selling financial services to these consumers. Now with MDR kind of coming in, and it's still obviously very, very early days, we don't yet know the rates, we don't know exact applicability, we don't know whether it'll be accepted, so it's still early. But the moment MDR comes in, it actually can make the core payments business, highly profitable on its own. So yes, there can be quite substantial earning upgrades. The overall outlook for these companies does improve quite substantially. So we've always been quite positive about payment platforms. You are kind of not only do they kind of have the ability to make money on payments, and this could actually get quite substantially boosted with MDR, but the whole financial services that you can kind of add on to the same set of customer base, that is very, very interesting. I think another point that makes us quite positive about this entire space is that UPI is clearly a path-breaking kind of an innovation and incredibly attractive from a payment solution, not just in India, but globally. So if you can kind of take this offering and kind of expand into other global markets, markets which are kind of dominated by the Visa, MasterCards, PayPal, etc., this is a superior technology. Would love to see kind of a very interesting financial technology from India actually expand into global markets. So yes, multiple drivers that make us positive across these payment platforms.
All right, you're positive on payment platforms. Ashi, good morning. I'm looking at a couple of these QSR names, and these in particular, Devyani and Sapphire, big movers all through this month. There is an impending merger there as well. And we've seen decent traction pick up in at least the chicken sandwich business, the KFC business for both of them, Yum Brands. If you pull up, both the monthly chart of Devyani and Sapphire, they move in tandem up around 25% this month. That's the traditional quick service restaurant business. And alongside that, we are constantly seeing some traction in the urban discretionary consumption names from the new age businesses as well, be it something like an urban company, or we've seen, the kind of growth that we've seen in quick commerce, etc. as well. So how do you play this? Do you play it via traditional QSR, which is doing better and is relatively cheaper when it comes to valuations, or do you play it via high growth, fairly well established quick commerce and food delivery players, which are more expensive in price? There you have both Devyani and Sapphire up 26 and 28% this month.
Yeah, sure. So I think if you're looking at kind of our view, and especially in terms of the longer term outlook, right? While Devyani and Sapphire are kind of doing quite well now, and they are interesting plays in terms of the longer term discretionary spends increasing in India, as most QSRs would be. I think we have a very clear preference towards digital platforms. QSR is ultimately a brick and mortar business. As you need to expand, you need to kind of keep increasing your store counts. That does come in with depreciation, interest, and other fixed costs. The kind of operating leverage that new age digital platforms actually provide you is actually very, very remarkable. And from the start of the launch of our digital PMS strategy, we've always been indicating that markets are underestimating just how profitable these platforms are over the longer term. A very large amount of their costs are actually associated with actually going in and getting consumers onto the platform, incentivizing them to actually transact. But once that behavior becomes entrenched, costs can reduce quite significantly, and the cost of incremental revenue is actually very, very marginal, and which is where the kind of longer-term profitability outlook and the longer-term growth outlook for us on digital platforms is clearly a lot more interesting. You kind of mentioned food delivery and quick commerce. Now, I think food delivery is the segment which may have matured a bit. When I'm saying matured, it still kind of has the capability of growing in the medium term well over 20% CAGR. But quick commerce is really something which can multiply quite significantly. I think we are still at early stages in terms of even understanding what the quick commerce opportunity is. It is kind of revolutionizing organized retail in India. And therefore, when it comes to kind of QSR versus food delivery, come quick commerce kind of a play, I think very clearly we find quick commerce and food delivery a more interesting longer term structural play.
Is a similar long-term structural play in store for the two-wheeler electric vehicle companies as well? There is one that is scaling new highs almost every single day. The other one, its peer is scraping at the bottom of the barrel right now. But within this two-wheeler or / electric vehicle space, actually, for that matter, do you stick to the company that's doing well, or do you prefer the legacy players who are still expanding slowly but steadily into the electric vehicle space, Ashi?
So actually, two-wheelers and electric vehicles is a space we are not that comfortable with. We are longer-term kind of buy and hold investors. What is very important, especially when you are talking about buying into companies where profitability may still be lower or even loss-making in the case of some of these EV kind of two-wheelers, is you need to have a clear level of conviction about 5 years, 7 years, 8 years down the line. What are the market share dynamics likely to be? Now, when it comes to kind of food delivery, when it comes to payments, when it comes to some of the digital platforms, these have kind of matured into what are quite strong duopoly, very tight oligopoly kind of market scenarios where it becomes a lot easier projecting 4, 5, 7 years down the line and having a good sense of what kind of market shares are likely to be. Our biggest issue in electric vehicles and say EV two-wheelers, but also arguably even in the PV space, is that taking that same call 5 years, 7 years, 8 years from now, is Ather, which is currently doing very well, is it going to continue to be dominant? Is Ola, which is currently kind of struggling, will they come back in a big way? These answers are not yet very clear. And with every new launch, market shares can move around, which is where we're not as positive here as we are on the digital platforms.
Fair point, Ashi. Thank you for sparing time and joining us on the show today. A short but insightful conversation as always. Take a short break. On the other side, get you all the big takeaways from the banking sector from the quarter gone by. Stay tuned.
130 points lower on the Nifty, but the banking report card from Q1. Ritu joins in with the details of that one. The Nifty Bank down 400 points. Ritu, take it away.
Well, the big takeaway from the first quarter banking report card is pretty straightforward. PSU banks, they continue to dominate on scale, but it is private banks that are winning on profitability. The top 5 PSU banks are sitting on 122 lakh crore rupees in deposits versus just 74 lakh crores for the top 5 private banking peers. That's almost twice the size. And PSUs also have 1.5 times the advances of their private banking peers. Yet, when it comes to the bottom line, the picture flips. The top 5 private sector banks reported roughly 22% higher profit than their PSU counterparts during this quarter. And there is also an interesting contradiction when you look at the net interest income. Now, because PSU banks actually generated higher combined net interest income, the question is, how are private banks generating more profit despite a lower top line? Now, one important part of that answer is margins. Look at that. The average reported margins for the top 5 private sector banks was about 3.8% compared to just 2.7% for the PSU banks. Kotak led the bank here, followed by ICICI Bank, and among the PSUs, State Bank of India was with the highest. Now, private banks are also deploying more of their deposits into loans, which means the credit deposit ratio is also higher, around 90% for private banks compared to about 82% for the PSU banks. HDFC Bank has the highest ratio here, nearly 96%, followed by Axis and Kotak. Now, of course, that supports growth, but with deposits lagging credit, the funding cost and margin sustainability, that is going to be an important watch point. On asset quality as well, it's good all round, but the large private sector banks look relatively cleaner. HDFC is the best in class overall, and SBI among the public sector banking peers. The outliers again, IndusInd Bank on the private side, PNB and Union Bank with higher ratios on the PSU side. Now, within the public sector universe, State Bank of India is the clear powerhouse. It alone reported almost 56% of the combined profit pool of the top 5 public sector banks. And why just talk PSU banks? With nearly 60 lakh crores of deposits and 50 lakh crores of loans, roughly 1 in every 4 rupees that is deposited or lent across India's entire banking system is on State Bank of India's books. Now, there's also a significant concentration within the private banking profit pool. So you have HDFC Bank and ICICI Bank that together generated nearly 73% of the combined profit of the top 5 private sector banks. So PSUs have the scale and the higher net interest income, but private banks have the edge when it comes to margins, credit deployment and profitability. And now the key watch point for the rest of the year is going to be whether strong loan growth can continue without putting any pressure on the funding cost and margins.
Ritu, thank you for that comprehensive wrap of the banking sector for the first quarter. Take a short break, back with more on the markets on the other side.
Welcome back. You're watching us here on Trading Hour. Let's talk about the primary market action. Milky Mist, the dairy food IPO, has opened today for subscription. The issue dates August 11 to August 13. The issue size of almost 1,553 crores, price band of between 133 to 140 crore rupees, of which there would be fresh issue of almost 1,428 crores. And the post-issue market cap that the company is seeking at a higher end is closer to 11,000 crores. It's India's leading value-added dairy companies rather than just a plain milk company. Specializes in paneer, high-margin products like cheese, curd, among others. And at the same time, they have direct procurement. The objects of the issue pretty simple. 500 crore goes towards repayment, prepayment of borrowings. About 500 crores goes towards capex, and then you have 155 crores that goes towards marketing and distribution, the likes of Visi coolers, ice cream freezers, and chocolate coolers. The company's revenues have been growing fairly fast, from 1,800 crores in FY24 to about 3,100 crores in FY26, with margins at around 14%, much higher than peers, and the net profit also 127 crores. The only fly in the ointment, you got to watch for the valuations. At 11,000 crore rupees, the company is valued at over 70 times FY26 price to earnings. It's the fastest growing food packaging company with a good compounding growth rate and category leadership in a lot of things. But at the same time, if you look at the risks, there is geographic concentration. They do have debt on their books despite the payment. And the return on net worth as compared to peers is a lot higher, but so is the valuation. So, doodh, but at what price is the question.
Indeed, and that's the new IPO on the block today. There are plenty lined up, by the way, on the rest of the month, but we take a leave on this edition of Trading Hour. From Ritu Manglam and me, thank you for watching. Halftime report on the other side.
Stocks slide after crude surges following a US-Iran deadlock. Traders stay wary of the FNO expiry-led volatility. Financial, cement and FMCG are the big drags, while pharma and consumer durables not some gains.
The Bombay Stock Exchange is set to make its debut in the top Indian equity benchmark Nifty 50 index from September 30th, displacing Wipro. Analysts expect inflows of over $600 million into the stock following its inclusion.
Vodafone Idea has recorded its first quarter of subscriber additions since 2018, drawing in 3 lakh subscribers in Q1 FY27. The feed accompanies a quarter-on-quarter revenue growth of 3%. The stock ticks up.
Prestige Estates inks a 3,000 crore rupee deal to offload 28% equity in its hospitality arm to Canadian pension fund CPPIB, while Apar Industries floats a QIP to mop up 2,500 crore rupees. Both stocks trade in green.
The Parliamentary Committee on Healthcare aims to cap hospital room rates at local 3-star hospital room rates. It also proposes caps on prices of other items and bidding costs. Estimates before procedures will also come in, and whether this will roll out remains a big question.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vinny Motiwala. Vinny, good afternoon. Well, it's the West Asia developments which are back on the table yet again. Crude oil prices, they have surged overnight at that $88 per barrel mark, which continues to be a worry. We do have the weekly expiry as well. The Nifty at the day's low, below the 24,450 mark for now. We do have the private banking index, which is putting a lot of pressure on the Nifty. There is FMCG, which is under pressure too, and metals index, that's also under pressure for now. So we do have the likes of JSW Steel, Tata Steel, all these stocks at the day's low. The broader markets, they are falling less. Yes, they continue to fall, but the fall is not that much, but it's across the board, right? And almost towards the end of the earnings season, so now maybe the focus is back again on what's happening on a geopolitical level.
Hi, Sonal. Absolutely. The focus again comes back on what's happening on the geopolitical front as well. And just to pull up the small cap, right, like we mentioned as well, that's the only one that's managing to hold on to green. Mid cap is trading in the red. Obviously, Nifty also, like we saw, is trading in the red as well. So advance decline ratio a bit more skewed towards the declines versus advances as of now in the trading session as well. Watch out for that. Nifty IT, keep an eye out on that one as well. Today also it's managing to hold on to gains in the trading session. While obviously in the last 3 weeks, we've seen Nifty IT manage to close with gains. So it'll be interesting to see, whether this run-up that we've seen in the first 2 trading sessions of this week as well, whether that continues. And obviously today is going to be expiry, so that'll be key to watch out for. But let's move on and talk about what's on the show for you all today. We'll connect with the management of RateGain to discuss their Q1 FY27 numbers as well as the road ahead for the company. We'll have Vivek, who will join us to take us through the stocks that are moving around in the trading session, as well as we'll be putting the spotlight on big movers in the trading session. Kolte Patil, Prestige Estates, Gland Pharma and Fortis. All of these are in focus. Why? Whether it's key earnings or news updates, we'll take you through all of that. Manisha Gupta will be in conversation with ETO Markets Jonathan Barrett and discussing the sharp surge in crude oil prices and what's driving the rally. So we'll discuss all of this on the show. And let's move on to the first segment for today and start up with Vivek, who's here to tell us which are the important stocks that are moving around in the trading session. Good afternoon, Vivek.
Well, good afternoon. What a volatile trading session we are currently dealing with. Advance decline ratio very much mixed at this point of time, especially when you're looking at the broad end of the market. So in terms of individual names, have a look at Bosch. Very, very strong set of numbers coming in as far as Q1 is concerned. Much about what the street was anticipating. Positive commentary as well. Stock high by 4%. Kolte Patil, a clear standout performer as far as the realty pack is concerned. Strong launch pipeline is what the management has highlighted in the Mumbai metropolitan region. Stock high by almost 18%. KSH, a recently listed entity, winding company, that particular stock high by 7%. Very strong volumes today. Gland Pharma, again, after the positive news flow yesterday on the CDMO contract win, again, almost 7% higher for this particular name after a very strong Q1. And Naukri or Info Edge, good set of numbers. Billings growth yesterday was quite strong. And the management highlighted that this particular trend is expected to continue. Another 7% uptick for Info Edge after the results. On the other hand, quite a few drags as well. Triveni Turbine, from the capital goods space, one of the underperformers as far as Q1 was concerned, stock down by 6%. The entire hospitality, the hospital space, most of the stocks, especially listed names, under quite a bit of pressure. Price capping worries once again comes to the fore. Have a look at a name like KC International, significant margin erosion in Q1, stock down by 4%. Jubilant Pharmova, again, this particular stock flattered to deceive, down 3%. The Montreal facility uptick has still not come about in that particular stock. And HLE Glasgow, this particular name from the broad end of the market, is a low circuit. Heat transfer deliveries have been delayed, is something that the management has called out, and that particular worry has ensured that the stock hits the low circuit today.
Okay, take that point. So some of these buzzing names on our radar. Thank you so much, Avik, for joining us as always with that list. For now, we'll do one thing, slip into a short break. When we come back, we'll get to more on the markets, stock-specific action, and get our movers and shakers segment as well. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. While the market is holding from where we started the show, it is at a similar level, slight bit of a decline from there, 24,430 around. That is what the Nifty is trading at. But apart industries, that's also something that you should watch out for. We have seen a sharp fall coming in the stock in just the last few minutes. So let's watch out for there. What is coming in here from the day's highest point? We've seen that fall coming in. So we'll be key if there's any update that's coming here. But let's move on and talk about updates that are coming in, right? Hospital and healthcare stocks. That's something that we're putting the spotlight on. A parliamentary panel's findings suggest that private hospitals are charging almost 5 to 10 times more versus government-owned ones. Now, not just that, the panel recommends 3-star cap on hospital room charges, surgery rates, as well as more details on that one that have come in through as well. Ekta has joined us and she's broken down this report as well that's come in. Ekta, over to you. What's the update?
Well, yes, it is a long report which has come through and a couple of important takeaways. I'll just set the context in terms of what the report indicates. Hospitalization costs average around 6,631 odd rupees in the government versus 50,508 rupees in private hospitals. That's 7 times higher. Government health expenditure is currently 1.43% of GDP expenditure, and the committee wants the health expenditure raised to 5% over 5 years. Now, one of the key things that they've highlighted is FDI in hospitals. They've said that the committee has basically flagged the 51% foreign ownership operational management. The report points out consolidation and monopolistic acquisition of mid-sized hospitals and recommends reviewing, rationalizing FDI limits for hospital acquisitions and management. This is, remember, only particularly to hospitals that they've indicated that the FDI is concerning. Now, in terms of hospital pricing, the framework to standardize and cap essential procedures, diagnostics, routine treatment, hospital room tariffs should not exceed the average tariff of a 3-star hotel in the vicinity. Hospital systems to link directly to approved rate schedules, which is they should then be standardized, auto-generated, and hence they cannot be manipulated. Incentives for hospitals that earmark at least 20% of beds for highly subsidized free treatment. Pool procurement model, which could be scaled across public and private impaneled hospitals. So basically, they get costs of medicines cheaper than if there is basically pooled procurement. PPP model, a public-private model for MRI and CT scans, which is capped at certain rates. Ceilings proposed for PET, CT, MRI and genetic profiling when it comes to cancer care. Insurance, 40+ crore people are identified as the missing middle when it comes to insurance. They've proposed 4,000 to 6,000 rupees per family per year cover with OPD benefits as well as new insurance products. So this is basically a new type of insurance which they're proposing. And employers are encouraged to contribute around 100 to 200 rupees per month, particularly for informal and gig workers. This is just a part of the recommendations, but what really stands out is basically what they are saying in terms of FDI floating into the sector, as well as hospital pricing and what kind of caps they've proposed within that.
Okay, all right. Thank you so much for joining us with all those important details, Ekta. In fact, earlier today, we caught up with the management of Healthcare Global. They believe cap on room rent is a step in the right direction. Here's a word from the ED and CEO Manish Mattu.
See, over the last few years, we have seen the laddering between room categories has come down, and there's not a big differentiator between, say, a double twin sharing at a private room. But however, of course, it does exist. But I'm sure, there will be a way to navigate this as well. I mean, we've navigated many things in the past, overall as an industry and Healthcare Global in particular. And this should, also be manageable in the foreseeable future if this were to be reality. I mean, the committee must have given it some thought. I mean, personally may or may not agree with it. But let's see. I mean, I'm not even, let me see what the content of that recommendation is and before I can comment on.
Okay, on that note, we're going to slip into a very short break. After the break, we'll have Shrikant Chauhan of Kotak Securities who will join in with some trading strategies. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Right now we have the data that's come in from AMFI, the mutual fund data for the month of July. Now, what we're seeing in terms of equity inflows, they have come in at 24,685 for the month of July. That is a decline versus last year as well. And on a month-on-month basis, you are seeing a decline in terms of the equity inflows. Large cap, that has actually seen an outflow that has come in this time. We are seeing 1,321 crores of outflow for large cap funds. Moving on to the mid and small cap side, mid cap on a month-on-month basis, we're seeing an inflow for mid cap as well as small cap as well. Mid cap numbers come in at 6,192 versus last month of 6,090 crores is what the number was. Small cap has seen more of an inflow that has come in this time as well. Now, in terms of sector as well as thematic funds, stable, just slight bit of a decline versus last month. So not much of a worry on that front. Let's look at the hybrid side of the category, right? Hybrid overall has come in at 11,490, a bit of a decline on that front as well. So that is important to watch out for in terms of hybrid category. And especially in that, a category which is important is going to be multi-asset allocation funds, which sees a good amount of traction that's coming in, or where interest is building up as well. That has also seen a decline versus last month. 3,753 approximately, that's what it's coming at, which is a decline on a year-on-year basis and on a month-on-month basis in terms of the numbers. So as of now, Sonal, we'll watch out for data that comes in from the SIP contribution fund as well, but a bit more subdued in terms of the data that we've seen coming in. Gold ETFs are also at around a bit of an improvement versus last month, but I think the large cap not doing well, small cap is managing to do well, mid cap, that's also a bit muted. So that will be key to watch out for also.
So, we did see an improvement in June versus the month of May. So there was some positive data that we saw. But the outflow that we are seeing in large caps this time around is something that requires a bigger analysis on what's happening here. What are the kind of, bets all these fund managers are taking when it comes to large cap funds. With small cap and mid cap, there have been a lot of conversations around how there could be a mid cap and small cap rally from here on, but that doesn't show in the numbers as well. For equity funds, the July data will just come up here on the screen instead of that cross. But of course, it's a fall again that we have seen. But again, if you remember from the levels of 40,000 crore rupees that we saw earlier, it's a sharp fall. The numbers have been declining, and we do have, in fact, some of our experts joining in. Suranjana Borthakur, the head of distribution and strategic alliances, Mirae Asset Management Investment Managers, is joining us now. Suranjana, your first take, especially on the large caps, it's an outflow this time, something that we've not seen in ages, right? The outflow, especially on such an important category. Yes, equity flows are lower. They are almost at a 5-month low as well. What's your take?
Yeah, hi. Good afternoon. I think, as you're rightly mentioning, even that's the number that stood out for me. I think 1,300 crore negative in large cap is definitely a number that we've not seen in a while. But if we look at the overall number, I think if we see the June number, it was around 28,000. But as you rightly mentioned, I think the March number of 40,000 was the peak, but in the last few months, it has only, cooled off a little. In fact, June was better than May numbers. But I would think within the categories, what is happening is probably also the flexi cap. If you see, that's a category which had been in the last few months getting a very fair inflow, and last month the flows had come down quite a bit, and this month it has come down even further to about 4,700 is what I see. I think mid and small continue. In fact, small has gained in terms of amount that has come in. I think it's about 7,700 is what I see, which from last month's number of about 5,600, I think that's a category where inflows have increased substantially compared to all other segments in spite of the overall numbers falling. I feel that even it's obviously to do with the fact that, markets have also been stronger. I think there's whenever we've seen a dip in the market, we've seen these numbers going up substantially, which was the case in March. But I think when you see the numbers now, it is probably cooled off because, there has been a sharp comeback of the market because of the IT stocks coming back, as well as the FIs returning after a while and probably also encouraging June quarter numbers.
Absolutely. Let's also bring on what Santosh Joseph, founder and partner at Germinate Investor Services, joining us right now as well. Santosh, good afternoon. Thank you so much for joining us on the show. Just a quick take in terms of overall the performance you're seeing. We spoke about large cap, but what is the outlook in terms of mid and small cap and flexi cap? That's continuing to see a bit more of a traction as well. Even this time, even last month, we've seen good traction. What's your view on both these?
Hi, good afternoon. Good to be here. And if you look at the way FlexiCap is standing, it's becoming now the bedrock of all fresh diversified equity allocation, and that's why those numbers are standing rock steady. But I think the industry is gravitating towards where the returns are, and post 1st April, when the markets kind of in the near term bottomed out in the month of March, you've seen strong flows in both of the mid and small cap, and that's why I think the large cap is getting punished, because you even go back over the last 3 to 4 months and look at the returns, the large caps have actually underperformed and led the overall broader market to come down, whereas the small and mid caps have outperformed the broader markets, and therefore the flows are in line with that performance. So the port of call is that they like the mid and small cap. In the event of not wanting to put all the money in the mid and small cap, flexi cap is taking the lion's share of fresh equity allocation, and that's becoming a dominant segment for people to go to.
So flexi caps continue to do really well. Gold ETF fund flows have also come off on a month-on-month basis. And I know the action from the new fund offers has been reducing, but this month there's a big uptick. There were 25 NFOs this month, which raised around 2,022 crore rupees. And if you look at the trajectory, the last time we saw that 25 figure was way back. So November was around 24 NFOs. We had July 2025 with 30 NFOs. So we've not seen that 25 number in a long time. So NFOs are something that have seen a big surge this time around, but of course the amount raised is not so huge, but still there's an uptick that we are seeing here as well. SIP number continues to be the focal point here. Even arbitrage funds, for that matter, Saranjana, has seen an uptick on a month-on-month basis. We're seeing a lot of action in arbitrage funds now because of CAS. Of course, with that STT tax that came by, the spreads reduced a little bit. But do you think this is where people are parking their short-term money because it does have a tax advantage over liquid funds?
Yeah, I think arbitrage as a category has been continuing to get flows in the last few months. Also, if you see, there's been a decent amount of flow, about 5,000-6,000 crores, and this month also it's been 5,000. So around, I think I think around 6,000. That's the number which has been steady, I would say. There's not been a large change that has happened. What I do see is, like you had mentioned, I think the gold ETF, flows have tapered down a little. I think that's to do with probably the buying, the too much of buying that happened in the category. What I also see is the other ETF number. That number has also, it's not a large uptick or anything. It's actually cooled off to a certain extent, but still it's about 9,500. So this is a category where last month we saw that, in the domestic ETF part, around 8,500 crores came in, but around 4,200 crores came in silver. So I would think, again, people are probably using this as an opportunity because of the silver prices cooling off to probably also buy additional there. So we'll have to wait for the split there. But that's an interesting part also, which is evolving, I would think.
Okay, absolutely. We have to keep an eye out on that other ETF part as well. That's evolving as well. And they normally do give that silver ETF number as well in the con call. So maybe we'll wait out for those details as well. We've seen an increase versus last month in other ETFs. So let's watch out for that. But Saranjana as well as Joseph, Santosh, thank you so much for joining us on the show. And a quick take in terms of the Amphi data that has come in. But on that note, we're going to slip into a very short break. We'll come back after the break and we'll have Manisha Gupta, who will be in conversation with Jonathan Barrett of CIO at ETO Markets. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. While some numbers coming in, MRF is the one on our radar. Margins have declined on a YY basis. Of course, this is because of energy prices rising and because of commodity inflation as well. The stock has seen a sharp fall from the highs of the day. The profits are also lower by 6.5%, while the revenues are higher by 9.5%. So earnings continue to come in thick and fast, but we do have a lot of stocks in the broader markets which are surging in trade. Kolte Patil is one of them, which is up around 14.5% on the back of good numbers. Chennai Petro is also adding on to gains, 10.5% higher, and there is MRPL as well. So standalone refiners continue to do really well. So while we are talking about some commodities, this is our commodity conversation. Jonathan Barrett, CIO, ETO Markets, is joining us now, and Manisha is here to take the conversation forward. Manisha.
Well, thank you so much for that. And Jonathan, thank you for joining in as well. Well, let's start with the gold and silver prices first, because that is where we're looking at most action in. We are trading at a 10-week highs in case of gold, 7-week highs in case of silver, and we've seen 10 to 12% of increase per piece in the previous 1 week itself. From where we stand, what are you watching, Jonathan, and where are you looking at the prices heading?
Manisha, good afternoon. Look, at the end of the day, I think gold and silver are something that have had such a large correction. They're now coming back into form as those macros are all shifting, particularly on interest rates in the States, and also some very good demand scenarios coming out of China for silver. So when I do look at them, I think that silver, once again, is something we've talked about in the past. It does remain sort of one of those focuses for me, because I do think it's got a lot more legs in it going from where it is at the moment.
Are you looking at 5,000, 5,500, those kind of levels coming back yet again for gold?
Look, it's only a heartbeat away. And I think when you do look at it, we've had that significant sort of pullback from those highs of 5,500. And when I do look at that, I can see the current macro feel at the moment, particularly where interest rates are at the moment and what the Fed's going to be doing with them going forward. Remember, we did have some terrible employment number out of the States on Friday, and that suggests there's a change in interest rate rhetoric. And I think with the fact that we're going into more of a dovish tone on interest rates, certainly sets the scene for repositioning in the bullion market, and particularly gold. And yes, I do see 4,500 is an important level, but I do see it moving higher as long as that rhetoric stays in play.
Point taken. How are you also looking at silver? Because the gains have been quite strong. As always, silver does tend to outperform gold on either side there. So with the kind of gains that we're looking at onto this one, 64, 65 odd, where are you looking at prices moving from here?
Look, I'd like to see silver back up as we know where it can get to, up to around that 100, 110. Now, I think there is a structural change in the silver market where we're seeing the demand for silver, or silver oil, particularly into China, is becoming such a relevant factor. China is the lead, in so many different areas where silver is a main input. And as a result of that, they don't have that sufficient silver. Now, you look at the imports of silver, silver ore up 62% on the year going into China. And I think that's a trend that's going to continue. It'll be a theme that'll underwrite the movement in silver a lot higher. And I do suggest that it sort of moves on to that, back to 100 and back even test that 120.
Jonathan, how are you also looking at the dollar index? Because we're looking at it trading between that 9,900 mark. Most reports suggesting that gains perhaps are done onto this one.
Look, the gains in the metals are certainly there. I would actually, the gains in the metals as a result of the weaker dollar are certainly there. I actually want to think that the US dollar will remain relatively weak to help stimulate their export side of it. And I also think that if we move into more of a dovish phase from the Fed, although they haven't said it yet, and let's see what happens this week, that I do think that moving from a neutral bias in interest rates to a dovish rate, certainly that's what Donald Trump wants, sort of will see that dollar under pressure. So I would intend to think that the US dollar, yes, it's in a reasonable range, but I think it will trade to the downside.
How are you also looking at the crude oil prices from where they stand? Because last week was a week of profit taking. This is a week that has started with gains, almost $90 nudging now.
I think we've got to really ask ourselves what is actually happening in, between Iran and the US. What are the discussions that are happening? And we've also got to focus on the fact that whilst there is limited shipping going through the Straits of Hormuz and through the Red Sea, or where there's concerns in the Red Sea, that's still sort of putting a restraint on supply. And I think that's factoring out into the market, regardless of what we're seeing out of the US and Iran. They both say they're doing something, but nothing's really happening. So I think that's a premium, or more of a premium starting to be factored in there that says we've got a bit of uncertainty there. And I think that's what's keeping prices up. And yes, 90 is something there. I don't want to see it much higher than that, because that's going to have other implications to the economy.
Oh, absolutely. A final quick question on the copper prices then. And we did see US hitting an all-time highs in the previous week, slightly off those kind of levels right now, but with no clarity on tariffs from US and, of course, stronger demand, supply concerns from various mines. How would you look at copper performing?
Look, copper is one of those commodity plays that we know it's always been a structural deficit. Always see that demand. I think the only thing that's going to stop it from continuing to move higher is the fact that the global economy is going to slow down. It's fine. I find this copper in a similar situation to silver, where it's just one of those commodities that we need more of if we're going to move into environmentally friendly economics. And as a result of that, when you do see supply restrictions from a few mines come to play, that only enforces where copper will move. So look, a commodity that's trading a record high doesn't mean it's going to stop there. It just means that more people want it, and as a result of that, you can probably see prices continue to trade higher.
Okay, all right. Jonathan, thank you so much for joining us today. Manisha, thank you for taking us through that conversation. So that's about the commodity markets. We will, of course, keep talking about the AMFI data as well, because it's an outflow in large cap funds since October 2023. This is what Vinny found out as well. So the numbers, at least in large caps, look like there's a big fall there. But we do have the SIP numbers, which will be out in just a bit. So we're just waiting by for that. SIP numbers will be important to track because they have been quite flattish in the last couple of months. So what happens there? They continue to be at record high, but flattish trends is what we're seeing.
Around that 31,000, it's just been around the 31,000. It's been about that. It'll be key to watch whether, this number is sustaining this time. Let's just wait out for their number, for the SIP number. But okay, as of now, we're going to slip into a very short break. We'll come back with the SIP contribution number as well. And we'll be also connecting with the management of rate gain. So stay tuned in for the discussion.
Welcome back. You're still tuned into Halftime Report. We do have the SIP numbers for the mutual fund data for the month of July. 31,961 crore rupees, which compares with 31,781 crore rupees. So it's around a 200 crore rupee uptick. So it's absolutely flat, basically. Let's put it that way. Yes, continues to be a number which is going higher, but on a month-on-month basis, there's a wee bit improvement, 200 crore rupees in the SIP figure. We'll keep tracking the mutual fund data for you and analyzing it as well, but it's back to earnings now. RateGain reported a good set of Q1 numbers. Revenue jumped multi-fold to 785 crore rupees. What is the outlook going forward? Bhanu Chopra, the founder and managing director of the company, is joining us now. Mr. Chopra, good afternoon. Thank you so much for joining us. You said your FY27 revenue guidance of 3,100 crore rupees is a number you should definitely beat. How much upside do you currently see in this guidance? What would lead to that definite beat on your own guidance?
So hi, good afternoon, and thanks for having me. So as you saw our numbers for this quarter, we did about 785 crores, and if you just annualize that, it comes closer to about 3140 crores. So that's the run rate ARR that we are having. We did disclose that we had some issues in Middle East, and we had some uplift in revenue as a result of FIFA. So even if after you balance both the positive and negative, we feel very, very good about exceeding that 3,100 crore number. In fact, in terms of the order bookings, etc., it's the pipeline is quite robust, and there's lots of goods in the business in terms of the investments we made in sales and marketing in our APAC region. Our booking numbers are up like 200% there. I've talked about how we have built a number of products and are shipping at insane speed because of AI. So there's combination of building out our sales infrastructure as well as new product capabilities and faster integration with the Sojourn acquisition.
How much would that beat be, Mr. Chopra, because of the reasons that you're mentioning? Is there the upside that you're talking about? Is there a range that you're looking at?
So we guided for 3,000 to 3,100 crores, and like I said, we should come on top of that guidance. And as things progress, I'll be able to give a better outlook on how the remainder of the year is. Given the fact that we live in a very, very volatile world, you don't want to go out too aggressive because there is some amount of uncertainty, but at RateGain level, things are looking very, very strong and good.
Okay, so looking strong and good, you will beat the guidance. Maybe next quarter you could help us with a number at what you're looking at also for the year end. Hi, good afternoon. This is Vinny joining in the conversation as well, Mr. Chopra. You've also raised your margin guidance as well. It's coming at 22.5 to 23.5 is what you've raised the guidance to. Could you help us understand, is this upside also coming in because of the pricing power as well overall? What are the factors that you would say are supporting it? And also in terms of the acquisitions that you all have made as well, are those synergies? That is something that is playing out now as well.
Yeah. So, hi Vinny, on the margins uplift, it's largely result of the acquisition synergies that have played out. So we had guided the market for about 12 million in cost synergies. So we've come on top of that about 14 to 15 million. That has helped us lift the margin. Also, there is operating leverage now playing out as we add more customers. Our gross margins across different product lines is about 70%. So most of the new revenue actually now flows into the EBITDA. And overall cost of R&D and investment into R&D given AI has really benefited in terms of experimentation and R&D that we are doing now. We're able to extract a lot more out of that $1 of investment because of AI, and we are shipping at some insane speed and building out new capabilities at an insane speed thanks to AI. So we don't see significant new investments into R&D because we're able to do a lot more than what we were able to do before. And in terms of the pricing power, especially on the destination side, we do think that we will begin to gain some pricing confidence there, but it's yet to play out. Similarly, our ability to integrate and offer one integrated tech stack to the hotel, from demand generation, conversion of those bookings on the booking engine, like that full stack offering that we have, that should also enable us to upsize the annual contract value and should also help our margins.
Okay.
So I think, like I said earlier, there's lots of strong indicators for both growth and margin upliftment, but we want to continue to reinvest largely in continuing to build out our sales and marketing capability. My vision for the company is that we have sales reps in every district of the world.
All right, take that point, Mr. Chopra. Thank you so much for joining us. So that's RateGain in focus, good set of numbers, and they expect the performance to continue as well. We'll do one thing, we'll slip into a short break now. When we come back, we'll get you more on the market and stock-specific action on the other side. Welcome back. The markets continue to be below the 24,450 mark, just at that level actually. We do have some stocks in the Nifty pack which are at the day's low. ITC, for instance, is at the day's low. We do have Bharti Airtel, which is joining that particular name as well. Wipro is the other one. We do have M&M Power Grid. Some of these metal names are also not doing so well. But with that, it's a wrap on this Power Pack session of Halftime Report. But stay tuned. Business Lunch will take all the action ahead.
slide, after crude surges following a US-Iran deadlock, traders stay wary of F&O expiry-led volatility. Financial, cement and FMCG are the big drags, while pharma and consumer durables notch gains.
The Bombay Stock Exchange is set to make its debut in the top Indian equity benchmark, the Nifty 50, from the 30th of September, displacing Wipro. Analysts expect inflows of over $600 million into the stock following its inclusion.
Vodafone Idea has recorded its first quarter of subscriber addition since 2018, drawing in 3 lakh subscribers in Q1. The feat accompanies a quarter-on-quarter revenue growth of 3%. The stock ticks up.
Prestige Estates inks a 3,000 crore rupee deal to offload 28% equity in its hospitality arm to the Canadian pension fund CPPIB, while Apar Industries has floated a QIP to mop up 2,500 crore rupees. Both stocks trade in the green.
The Parliamentary Committee on Healthcare aims to cap hospital room rates at local 3-star hotel room rates. It also proposes caps on prices of other items and binding cost estimates before procedures. Whether this will roll out remains the big question. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramlin, and with me as always is Harmaz Patakia. Harmaz, good afternoon. You know the market's in the red today. The Nifty down 0.5%. Climbing oil prices, expiry weighing on the markets today.
The climax is yet to unfold because the weekly expiry session is when the action will actually begin, the last 60 minutes of the trading session. But yes, we were supposed to hold on to 24,500 at least for the bulls. They were trying to do so for a better part of the last week and at the start of this one as well. Today is not the case, but they are holding on to 24,400, if not 24,500. And we've been meandering around the day's lows for a better part of the last, 60 to 120 minutes now for the last couple of hours. We've been in that same 24,400, 24,450 range on the Nifty. The principal culprit behind this has been the Nifty Bank, and that is the reason why the index is below the 24,500 mark today. The Nifty Bank has broken below its 20-day moving average, seeing some support at lower levels around the 57,000 mark, so up around 150 points from those levels, yes, but still down around 350 points in today's trading session is the principal reason why the index is down in today's session. But a couple of results that have come in just a few minutes ago. MRF was one of them, and weak operating performance coming in this time around. EBITDA is down, margins were down because of the higher input costs. The stock down 2.5%, and Hind Rectifiers came out with numbers just a few minutes ago, and that has taken a bigger knock in comparison, as the stock is down 8% as we speak after its results are nothing.
Absolutely. And if you take a look at the sectoral performance, we've got those IT names that are doing well, right? That index is the top gainer today, about 0.5% higher. We've got Infosys, TCS, HCL Tech, all of them 0.5% in the green. We've got those pharma names that are doing well as well. We've got Nifty Pharma about 0.4% in the green. Divi's Lab up over 2%. Dr. Reddy's up over 3%. And Gland Pharma nearly 7% higher on the back of a good set of numbers. Now, the top losers, that's the private banks. As Harmaz pointed out, financials are seeing pressure. Private bank index about 0.8% in the red. We've got ICICI Bank, Axis Bank, Kotak Mahindra Bank, all of them between 0.5% and 1.5% in the red. And we've also got that metal pack that's feeling the pressure, 0.7% in the red. JSW Steel and Jindal Steel, all of them seeing cuts of over 1.5%. Jindal Steel, they're now over 2% in the red. And that's how the markets are shaping up this afternoon. But hospital and healthcare stocks are in the spotlight. A parliamentary panel's findings suggest that private hospitals are charging almost 5 to 10 times more versus the government-owned ones. Not just that, the panel recommends 3-star cap on hospital room charges, surgery rates. My colleague Ekta Batra is here to break it all down for us. Ekta?
Well, yes, I'll start with basically the difference in terms of what the committee recommendations have been when it comes to the private as well as the public sector. So hospitalization costs, they've pointed out, average at around 6,631 rupees in terms of the government versus 50,500 odd rupees in private hospitals, which is 7 times higher. The government health expenditure is 1.43% of GDP. Committee wants this to rise to around 5% over the next 5 years. Now, coming to one of the key things which is brought up in this particular report is the FDI in hospitals. The committee has flagged 51% foreign ownership or operational management in hospitals, and the report points out consolidation and monopolistic acquisition of mid-sized hospitals. It recommends reviewing, rationalizing FDI limits for hospital acquisition and management going forward. Now, hospital pricing. Framework to standardize and cap essential procedures, diagnostics, routine treatment. Hospital room tariffs should not exceed the average tariff of a 3-star hotel in the vicinity. That is one of the things which has been widely circulated about this particular report. Now, hospital systems are expected to link directly to approved rate schedules. So what this will do is that it will standardize, auto-generate, and not be able to manipulate any kind of bills going forward. Incentives for hospitals that earmark at least 20% of beds for highly subsidized free treatment. And they've also spoken about pooled procurement as well as a PPP model for MRI and CTs at cap rates, which should also help in terms of shared access to expensive equipment. Ceiling prices proposed for PET CT, MRI and genetic profiling when it comes to cancer care, because the out-of-patient costs they've mentioned when it comes to cancer care is much higher than what was earlier the case. Now, quickly, they've also spoken about insurance. 40+ crore people are identified as the missing middle in insurance. They proposed 4,000 to 6,000 rupees per family per year to cover with OPD benefits, as well as this would be a new insurance product. They've also encouraged employers to contribute around 100 to 200 rupees per month per worker, particularly for informal and gig workers. As of now, these are recommendations, but it's important to note that the noise with regards to any kind of regulation on private hospitals just keeps getting louder.
It does, and it's showing up in the stock price of most of these companies as well. Ekta, thank you for explaining that to us. Well, the other big talking point over the last hour or so has been the mutual fund data for the month of July that has been released. Vinny is here with the entire breakdown of how the numbers were for the month of July. Vinny.
Hi, thanks so much for that. So for the numbers this time, equity fund inflows overall that has come in at around 28,961, which is an increase on a month-on-month basis. Obviously, we have come off those peaks that we saw coming in March 2026 of around 40,000 crores for equity inflows. From that, we have come off, but versus last month, we're seeing an increase coming in terms of the numbers as well this time. Now, apart from that, a slight bit of a decrease, I beg your pardon, versus the numbers in June. Now, large cap flows, that is the fund that has seen a bit of a miss coming in. That is an outflow that we're seeing this time. This is the first time we're seeing an outflow coming in for large cap funds since December 2023. So first time we're seeing the large cap funds are seeing an outflow coming in. 1,322 crores is what the outflow came in at. Now, in the equity category, what did well? Mid cap did well, small cap did well. What is the small cap number that's come in here as well? And the mid cap number. Mid cap number is at 6,192 crores, which is an increase of 2% on a month-on-month basis, stable at that about that 6,000 mark in the last couple of months. Small cap too, the flows have come in at 7,767 crores in the month of July, which is the highest level that at least, since I'm tracking in the last couple of years, it's been the highest levels in the small cap category. So that is interesting to watch out for, that the broader end of the market is where the interest still continues for investors as well. Apart from that, when you look at the flexi cap category, do not forget that that's a category that's piqued the interest of investors, retail investors, especially in the last 7-8 months. Specifically, we've seen that increase in terms of interest. Now, on a month-on-month basis, flexi cap has seen a decline coming in, but still, that is one of those categories, top drawing categories in terms of inflows for the equity side. Apart from that, SIP number has been quite stable. When you look at it, it's come in at around 31,961 crores. So stable at the 31,000 above that mark. When you look at NFOs also, we are seeing 25 new NFO launches that have come in, and the numbers come in at 2,022 crores. There are those life cycle funds that have been launched. So it's interesting to see that NFO also is seeing a bit of an increase in terms of the traction there. Not high as the past that we've seen coming in of around 30,000 crores in July 2025, but that NFO interest still continues, and SIP contribution managing to do well. Hybrid category managing to see a bit of a stable growth or stable performance on a month-on-month basis. Multi-asset allocation in that also continues to draw a lot of inflows. But yes, that's the update in the mutual fund data.
All right, Vinny, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned. A U.S. federal judge permanently dismissed securities fraud charges against the Adani Group chairman Gautam Adani and his nephew Sagar Adani, ending a legal fight that began in 2024. Hormuz, you've been tracking that, so take us through the details.
It's a big development indeed. And it was, you can say that the U.S. District Judge Nicholas Garofis has dismissed the conspiracy, securities and wire fraud charges against both Gautam Adani and his nephew Sagar Adani, and these charges related to allegations over them paying more than $250 million in bribes to Indian government officials for solar energy contracts, charges that the Adani Group has denied consistently, and it was this case that resulted in an indictment as well for them towards the last days of the Joe Biden presidency towards the end of 2024. But there have been steps taken to resolve this matter right from the start of this year as well, because earlier in the year Adani Enterprises had paid $275 million to settle the Office of Foreign Assets Control, which is the OFAC probe that is under the US Treasury's Department with pertaining to sanctions with regards to Iran. Then there was this US SEC, the Securities and Exchange Commission. There was this settlement that was done by both Gautam Adani and Sagar Adani, where they paid a combined $18 million to settle the issue with regarding to misleading statements pertaining to a bond issuance in 2021. So legal matters have at least for now come to an end for the Adani Group, and JP Morgan is viewing this as a positive for the entire complex, and they say in their note that they have already demonstrated, the Adani Group has demonstrated that they have enough and more diversified funding sources, and this full resolution could further broaden their funding avenues, and which may also include a US dollar bond issuance. You've seen a couple of Adani Group companies coming out with their QIPs as well very recently, and they say further that the group is likely to step up capex and pursue M&A across companies for the group, and therefore they continue to remain overweight across the Adani Group companies. Of course, there's not much in terms of price action today, and all of these companies have mostly recovered everything that they lost during this period and a lot more. So a positive development nonetheless, but of course the stocks have already moved in anticipation of this.
Absolutely a positive development there for that company. Now moving on, NVIDIA has teamed up with some of Wall Street's largest banks and investors to raise $500 billion in capital for artificial intelligence infrastructure. Speaking to CNBC, Jensen Huang, founder and CEO of NVIDIA, says that these partnerships are going to pull together independent long-term capital to fund and support AI infrastructure build-out. Take a look.
We're announcing 6 partnerships today. These partnerships are going to pull together independent long-term capital to fund and support AI infrastructure build-out. This is an extraordinary time, as you know, because this is the first time in some 60 years that the computing industry is going through a fundamental platform shift from the way that software was done before to the way that it's going to be done in the future, called artificial intelligence. Fundamentally, what's different about this industry and this way of doing computing is that the computer is now part of the infrastructure, like electricity, like the internet. But now, NVIDIA's AI factory platform is really an investable asset, an infrastructure asset. And the reason for that is because it's productive, it's revenue generating, it is fungible, it's used by just about every cloud service provider, it runs every AI model, it runs algorithms of all different types.
Let's now also hear out what the representatives of the Wall Street Consortium had to say on the potential scope of the AI infra build-out that's currently underway.
I think one of the things Goldman Sachs brings to the table is we have an extraordinary distribution network. So we bring capital, but we also bring a very, very unique distribution network. But Jensen came, approached us with the idea, and we said, you know, we'd love to talk to you about it. We have a deep belief in the direction of travel and the opportunity set over the course of the next 3, 5, 7, 10 years.
And I applaud what NVIDIA has done, bringing all these firms together and saying, we have a common goal. We need to raise $500 billion. Obviously, that's an unprecedented amount of money, but we're going to have to raise trillions of dollars over the coming years. And I do believe this is going to be representing a fantastic investment. In fact, I think it's going to be such a large investment. Over time, you're going to see more and more allocation into this asset class.
So today at our companies, we've seen a 7-fold increase in demand for LLMs in the last 6 months. And yet the amount of compute is not keeping up. The data centers, the power, the chips. And so what you're going to see here is people are going to begin to recognize that this is a financeable asset class.
On that note, it's time for us to head into another short break. News and updates follow on the other side. Stay tuned.
Welcome back. On to an exclusive then. Sources are telling CNBC TV 18 that some promoter stake reshuffling may be on the cards in the Vedanta group companies. Yash is joining in to tell us more on that. Yash.
Well, Ormas, that's correct. Very interesting reshuffling is what we've been given to understand from our sources as far as the Vedanta group is concerned. What we've been told from our sources is that the promoters of Vedanta may, buy or increase their stake in certain group companies and reduce the stake in certain group companies. As far as the companies where the stake is expected to be increased or is being looked to be increased are Vedanta Oil and Gas and Vedanta Iron and Steel, the two recently listed arms as far as the Vedanta is concerned. There is where the government could, the promoters of Vedanta could increase their stake through creeping acquisition. Remember, here, as far as creeping acquisition is concerned, SEBI's defined limit stands at 5% in each financial year. So, of course, here are the two entities where they could increase the stake. What also we've been given to understand is that the promoters of Vedanta could look to sell part of their stake or pledge and raise funds which will be used to increase the stake in the oil and the steel subsidiaries by selling their stake in Vedanta Aluminium as well as Vedanta Limited. So Vedanta Limited and Vedanta Aluminium is where we could see promoter stake to be reduced, either in the form of being sold or being pledged, and the money or the funds being used to increase the stake in oil and gas and the steel arms. As far as the funds which are expected to be raised are concerned, sources tell us that that could be between about 2,000 to 3,000 crore rupees, which would be used to increase the stake of the promoter in the oil and the steel arms. We've written to Vedanta on this particular query. A response from the company is still awaited.
All right, Yash, many thanks for taking us through those details. But with that, it is a wrap on this edition of Business Lunch. From Hermas and me, goodbye and many thanks for watching. Mid-Cap Radar will take all that market action forward.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. Vivek, good afternoon. Wee bit of recovery from the lows. Major one in the mid caps is the geopolitical worries which are back on the table. And of course, it's the weekly expiry as well.
That's right, weekly expiry. So much that we're processing in terms of news flow, in terms of results, and especially, we're coming towards the later of the earnings season where, earnings are coming in thick and fast. But we have a lot lined up on the show, some important corporate conversations. So let's start off with the top headlines. Market continues to trade near the low point of the day, with the Nifty trading around the 24,500 range. Auto, FMCG, metals are the top drags, while pharma and IT outperform.
Hospital stocks dip but recover from lows after the Parliamentary Committee on Healthcare aims to cap hospital room rates at local 3-star hotel room rates. It also proposes caps on prices of other items and binding cost estimates before procedures. Whether this will roll out remains the big question.
Gland Pharma also reacts to a stellar first quarter where profit grew 47% on a year-on-year basis. The management also raises growth guidance for FY27 to 15% from 12 to 13% earlier. The stock is up 6%.
Shares of Colte Patil gain over 14% following a strong set of June quarter earnings. The company reported 30% uptick in collections, while realizations also rise nearly 30%.
And shares of KEC International falls over 4% in trade as the company posts a weak set of Q1 result. The management tells CNBC TV 18 they expect margins to normalize once supply stabilizes.
Okay, all right. Those are the top headlines that we are tracking. The bigger one being that there is a recovery which is underway. Nifty is above the 24,450 mark for now. Whether that sustains or not, or whether we build onto that or not, is the big question. The mid-cap space is the one where we are seeing a big recovery which is coming by as well. So the mid-cap index is closer to the day's high as we speak, just at the flat line for now. The small-cap index too, which has been in the green for a greater part of the trading day, is also on our radar, because right now, if we get that particular index or the chart, that is seeing a recovery as well. A lot of earnings and a lot of numbers, but we'll talk about mid caps now.
That's right. We'll talk about mid caps, and Ria is standing by the big wall. This is our special segment, Mid Cap Movers. Ria, take us through all of the mid caps that are moving around in the session.
Well, yes, a lot of stocks moving around in today's trading session. Let's start off with the gainers. First, we have Amara Raja Energy reacting to its Q1 numbers, up nearly 8% today. Lumax Auto, again reacting to its Q1 numbers. This stock, in fact, has nearly doubled in the last 1 year. We have Sundaram Fasteners as well, also reacting to its Q1 numbers, up nearly 8%. Again, Zen Technologies are reacting to an order win today, nearly 300 crores of an order win for the company. And Devyani International also performing well today, up nearly 6.5%. Also looking at some of the stocks which have hit their 52-week highs as well as their all-time highs today. We have Chennai Petro, Reddington, Anthem Bio, Ather Energy as well as Bosch, all seeing strong gains in today's trading session. And on the flip side, looking at the losers in today's trading session, all of these stocks reacting to their respective Q1 numbers. We have Triveni Turbine taking a big hit today. There's also KEC, which the stock is also down nearly 40% in the last 1 year. Castrol also taking a cut in today's trading session, as well as HLE Glasscoat, which has hit a lower circuit of 20% today, and IdeaForge also hitting a 5% lower circuit on the back of weak Q1 results. But this stock has doubled just in the last 4 months.
Okay, all right. Thank you so much for joining us with all those details. Ria, with that, let's move on. MBC Developments is the first management of the show. The company reported a good set of numbers on a YY basis, although the performance was weak on a sequential basis. Bookings surged 340%, while collections rose 54%. This is on a YY basis. To discuss the quarter gone by and the road ahead, we have Rajesh Kemal, who is the Chief Financial Officer of MBC Developments, joining us now. Mr. Rajesh, good afternoon. Thank you so much for joining us. Well, you maintain your bookings guidance for FY27, which is at 6,000 crore rupees, 2,000 crore rupees from DM projects as well. But if we look at the Q1 numbers, it's at around 900 crore rupees. What makes you confident of achieving that 6,000 crore number? Because now the run rate required will be much higher. What is the launch pipeline like? Give us more details on that.
Thank you, Sonal, for having me on your show today. Yes, we started our quarter on a very, very strong note, 900 crores of pre-sales and 500 crores of collection, which is, if you see 900 crores vis-a-vis the same time last year, it's almost 3.5 times of what we achieved last year. And collections at 500 crores is almost 54% more than last year what we achieved. We have a very good launch pipeline in Q2, Q3 and Q4. That's around 19,500 crores of launch pipeline that we have planned for. and we see a very good demand in the market, and that's the conviction that we have to achieve this pre-sale numbers of 8,000 odd crores and 3,000 crores in collection.
Okay, so you've given a very strong guidance. Almost 3,000 crore in collection is what you're anticipating. 9,500 crores worth of launch pipeline. Which are the key markets that you're currently focusing on? And in terms of the response there, what is the on-ground demand trend currently that we're witnessing?
Hi, Vivek. Our key market continues to be Bangalore, and we have made a lot of inroads into Mumbai as well. 50% or 55% of my collection is from Bangalore markets, 45% is from MMR, and about 5% from NCR. Bombay market is particularly interesting because we have launched our entry into South Bombay through our project Citadel is very unique, and we are seeing very robust demand. What's unique about Citadel is we've got the entire 81 floors approved, unlike the trend in Mumbai markets where the approvals are in phases. We have launched the entire 81 floors. So if a customer wants to choose the 81st floor, he can choose it today rather than have an option to buy it at a later point in time. So we are seeing a very good demand from our Mumbai market as well, although we are new entrants over there. But that's the conviction on our pre-sales and collection guidelines.
Okay, so it continues to be strong in the Mumbai market. Let's talk about balance sheet as well, because your operating cash flows were negative 285 crore rupees despite collections being very strong. I understand a lot of capex is happening in the company right now and you are looking at launches. How can one look at cash generation now? What about debt as well going forward? Because you do have a preferential issue as well. So just give us a sense of what the balance sheet will look like going forward.
So Sonal, we had 16,000 crores of inventory that we launched in Q3 and Q4 of last financial year. In a typical project cycle, the collections start kicking in 8 to 12 months post the launch, because that's when the slab cycle starts and we start collecting from our customers. So you will see a very robust collection from Q2 onwards of the projects that we have launched in the last financial year. And the projects that we are going to launch in this financial year will start seeing collections in Q3 and Q4. The Q1 of this financial year, we concentrated on execution of the project that we launched last year, and that's the conviction on a very strong collection guidance that we have given. And debt perspective, we have 3,300 crores of net debt, and that's a very comfortable position. We are at 0.35x to debt to equity. We are at a very comfortable level as far as debt to equity is concerned.
Well, that gives a lot of confidence. The last question, a little over 64% of the promoter shareholding is pledged. What is the plan that you have in order to go ahead and reduce this number?
So the promoter debt that we have, the promoters have against the shares will gradually see a downturn as we progress over the next few years. The promoters have assured us that they will bring down this pledge over the next 2 to 3 years, and we can see that trending.
Okay, next 2 to 3 years, the promoter pledge will come down to zero. A lot more questions, but we are right out of time. But thank you so much for joining us today. So that's the strong performance coming in from Embassy Developments, and they continue to guide for higher numbers, something that they had maintained earlier. Collections and their pre-sales will continue to grow higher. Slip into a short break now. Up next, we'll connect with the management of NAC Packaging to discuss their Q1 numbers and the road ahead. Stay tuned.
Welcome back to Mid-Cap Radar. Well, as promised, we have another management for you on the show. NAC Packaging, remember, reported a strong set of Q1 numbers with robust growth across top line and profitability. The revenues went up almost 41%, driven by higher sales volumes and improving capacity utilization. To discuss this and more, we are joined by Alpesh Patel, Chairman and Managing Director of NAC Packaging. Good afternoon, Mr. Patel, and thank you so much for joining us. Well, you've started off the year on a very strong note. Can this particular momentum be sustained? Can you end the year with the top line growth of over 40%? And start off by giving us the FY27 guidance for top line, EBITDA margins, profitability, and also market share, where you currently stand at 10.1%.
Namaskar, sir. Thank you. Thanks for giving the time. Sir, first of all, thanks to all my investors and all the members. They trust on NAC Packaging, and we continue our journey with them, new journey. So, sir, just I give you brief one-minute introduction about the company, because the company is started in 1994 as a packaging company.
During the IPO, sir, we are very short on time. We may miss out on the numbers.
Okay.
Yes.
So, sir, to be very honest, 2026, comparing to Q1, revenue we grow like one. Last year we 187, first quarter this year 264 crores.
Yes, Mr. Patel, we do understand that. We all have these numbers and they're flashing for you on the screen. So yes, it has been a strong growth, revenue up 41%, EBITDA up 64%. Do you think you will continue this performance in FY27? If you can give some guidance for the investors, because that helps them understand the future of the business as well. So go ahead and give us the guidance. What are you expecting in FY27?
Yes, ma'am. See, company have a very good order book today as well, 130 crores, as well as the same line of product like PLWPP plus pinch bottom bags. There is a two machines we installed last quarterly, and that is the main growth driven for the company. And currently we are using just small portion of it, and again it is a continuous journey. Even one more plant we rented outside the company, next to company, because we have a more demand and supply is less. So just after IPO we added one more plant to adding the company, as well as today we have a 2,000 customer plus 13,400 SKU. Even last quarter we added 3 more countries and reaching to 74 countries our footprint.
Yes, so we are aware of that. So what is the outlook with the capacity additions that you've made? What will it mean for your revenues, EBITDA margins and profit growth for FY27, sir?
We are working very hard on our product and our development and incremental growth. The same way we are trying our best to continue that journey to further level as well. So trying our best to continue same path.
Okay, so we get that, sir. You're not being committal, especially in terms of giving us absolute numbers in terms of the FY27 guidance. So give us a sense of how raw material price fluctuation has impacted you, especially as far as EBITDA margins are concerned. What is the current, especially in the packaging industry, we understand that there has been quite a bit of turmoil that's transpired. Are things back now on track, and going forward, can margins inch up?
Sir, see, last quarter we have a very much problem for the crude and polymers industries. But we have a very good relation with the Indian refineries, all the refineries, like 30 years experience, very good forecasting in the company. So we are not facing any big issue, and that results we are continue our EBITDA margin like 38 crore to 59 crore, 53% growth. So as per the revenue concern, we have not faced any problem. Even we can get the conversion from the customer as well. So company have a very good relation with the supplier as well as the customer. So we are not that much impacted on polymers and crude pricing.
All right, Mr. Patel, thank you so much for joining us today. So that's the word coming in from NAC Packaging. Strong set of numbers in Q1. They expect this momentum to continue. However, he did not give us an exact number on guidance that they're expecting for FY27. We'll slip into a short break now. When we come back, we'll talk about specific stocks and market moves on the other side.
Welcome back to Mid-Cap Radar. Well, a few stocks that are hitting fresh highs on an intraday basis. Look at a name like MCX. In the last couple of trading sessions, that particular stock was up almost 8%, surging higher in the session. Policy Bazaar, that stock too, which has been under significant pressure on account of all of the overhangs that it has, especially post the earnings. That particular stock is up 7%. Zydus Life Sciences, remember the company just came out with its results a couple of minutes ago. That particular stock, after an encouraging set, has moved to the high point of the day, up almost 5%. On the other hand, some follow-on selling seen as far as Bharat Forge is concerned, down almost 3%. Triveni Turbine and KEC International, two names from the capital goods space that have seen significant margin compression, especially as far as Q1 is concerned. In fact, KEC International in its analyst call has withdrawn their EBITDA margin guidance. So those stocks seeing quite a bit of profit booking emerge. Some of the other stocks that are doing quite well, have a look at a name like Container Corporation of India. That particular stock too has seen quite a bit of follow-on buying, and that particular stock, Container Corporation, is up almost 2% in this session. With that, it's all the time we have on this edition of Mid-Cap Radar, a special edition of Healthcare Centimeter when we return. Stay tuned.
Hello and welcome to the CNBC TV 18 special. A new Parliamentary Standing Committee report has put the spotlight on hospital and diagnostic pricing, foreign investment and more. And some of its recommendations could have far-reaching implications for the healthcare industry, from price caps and transparent hospital bills to a rethink of FDI and hospital ownership. To talk more about this, we have with us Ankit Thakkar, who's the CEO of Jupiter Lifeline Hospitals, and Rahul Guha, MD and CEO of Thyrocare. Ankit, hi, welcome to the show. Well, it seems as though the news never stops within the entire hospital and healthcare space. But this particular report, according to you, what are your initial thoughts after reading or going through a summary of it?
Well, hi, Ekta. Good afternoon. So I think a lot of positives in the parliamentary report on healthcare. It talks about addressing the missing middle as they define it in the extensive report that they have laid out. The committee talks about the bottom 50% of the most economically vulnerable population being covered by Ayushman Bharat scheme, and then the balance 20% more being covered either by private insurance or by senior schemes or CGHS schemes. And they talk about the 30% missing middle, which are today neither covered by health insurance nor by government schemes. And they are trying to address the affordability gap for this 30% of the population. And they have laid out significant processes on how they would like to see insurance get more affordable. They have laid out significant steps and recommendations on how GST rationalization needs to come in to make potentially GST as healthcare as zero rated in order to allow input tax credit, lowering customs duties, and a lot of those things. So I think it is a very encouraging report from the committee.
Okay. Well, Ankit, on that particular point with regards to insurance, and there's a lot more to discuss, but since you brought that up and this missing middle when it comes to insurance, the committee wants insurance to going forward to cover this missing middle by around 4,000 to 6,000 rupees in terms of a new insurance product, which will cover OPD diagnostics and maybe to some extent chronic disease management. Do you think that's feasible considering the kind of costing and out-of-pocket expenditure as of now?
Absolutely. I think it is 100% feasible. Even today, insurance in India is amongst the cheapest in the world. And we talk about 30%, but if it is 30% on India's population base, you're talking about, about 40 crore people getting into the insurance scheme. Once the denominator becomes so large, the risk naturally gets divided, and without too much effort, either on the regulator side or the government side, just free market itself will ensure that the pricing of insurance goes down significantly.
Okay, well, the crux of the report and the introduction is this huge difference which is between public and private healthcare. In fact, the committee points to a 7x difference between what we spend in a private hospital vis-a-vis what we spend in a government hospital. Childbirth is around 2,300 odd rupees as compared to 37,600 rupees plus in a private hospital. From a hospital operator's perspective, a private hospital operator's perspective, why is there such a huge gap, Ankit?
No, so I think there is no conflict in this data. The difference that you're pointing out is about how much the patient pays out of pocket. This number and this statistic does not take into account the cost. The cost of government healthcare is paid by the larger taxpayer ecosystem and not directly passed on to the patient. So that is a welfare scheme that the government is running, and that does not truly reflect the cost of providing those services. So in that sense, it is, the payer for the healthcare received by a patient in a government healthcare is different from the receiver itself.
Okay, but how much room do you think there is, Ankit, in terms of hospitals to actually reduce costs without compromising on quality?
Well, I think today, if you look at the healthcare costs in India, and I would request you not to look at the developed economies of Western Europe or the United States, but to compare the cost of healthcare in India from some of the poorest nations in the world, maybe sub-Saharan Africa, and you will find that the cost of healthcare in India is probably 2 to 3 times lower than some of the sub-Saharan African countries. And in terms of quality, I think we compete with amongst the best that you can get anywhere in the world. So even today, like for like, we are probably the cheapest healthcare ecosystem in the world and amongst the finest quality. So, I don't think that we have too much ground to cover in terms of improvement there.
Okay. Well, Rahul Guha, the MD and CEO of Thyrocare, also joins in to discuss this report. Well, Rahul, just wanted your initial thoughts in terms of the crux and the key takeaways of this report.
Sure, Ekta, good afternoon. And I think overall, the recommendation to increase healthcare spending for all of us in the healthcare sector, it's a absolute welcome move, particularly the emphasis on preventive testing and diagnostics, I think is a very important step overall, and I fully agree with the recommendations. If you look at it, a 500 rupee lipid profile test and 100 rupee or maybe 300 rupees a month lipid or cholesterol medication can actually prevent a 5 lakh to 10 lakh heart attack, as you get older. And I think the committee has really understood the need for preventive testing as a panacea for the exploding healthcare costs that would happen if, some of these diseases remain untreated into your 50s and 60s. So I definitely think a lot of the recommendations are spot on and on the right track.
But Rahul, there is this fear of capping diagnostic test prices as well. We've heard of that take place before as well. We've heard that maybe that could be in the offing. But do you think that that's a realistic recommendation based on what exactly diagnostic tests cost today?
I think, as Ankit said earlier, I think if you look at healthcare in India, and even if you look at diagnostics in India, we're probably already at the lowest cost in the world with the best service levels and convenience, right? You can order a diagnostic test within an hour and get your report within, I think, 6 to 8 hours on the same day. That's practically unheard of in any developed market at their prices. And to imagine that can happen at 1,000 rupee price point in India, I think it's already from an affordability and accessibility point of view, diagnostics is already there. So I don't think, yes, a price cap can come to help standardize the pricing, but I think it's already at a very affordable level today.
But what would that do to quality?
On the quality front, I definitely think, more expansion of NABL, encouragement of labs. Only 2% of India's labs are NABL accredited. And I think as more and more come under the quality ambit under NABL, and it's a fine organization with fantastic standards, right? And I think if the industry embraces that with open arms, I think the quality issue will be set at rest.
Okay. All right. Well, Ankit, I wanted to bring up one particular thing which stands out and is in focus in the past couple of years, especially since the pandemic, is the FDI inflow that hospitals have seen. The committee has specifically raised concerns about foreign investment exceeding 51% in hospital ownership. They've encouraged it in other sectors such as, say, medical devices, etc. But it's hospital ownership where they say that, it is fears of it becoming monopolistic at this point in time and capitalistic as well. And it should be a public enterprise to a certain extent. What are your thoughts with regards to this?
Well, I think I would probably steer clear of the assumption or making the leap that they want it to be a public enterprise. I think I don't recall looking at that kind of recommendation. On the contrary, all forums, including the current parliamentary panel, has been quite categorical in acknowledging that private sector has a very strong role to play in India's healthcare. As far as specifically FDI is concerned, I think these are more geopolitical questions rather than healthcare questions. And I don't consider myself to be an expert in that realm.
Okay, I understand that, but you've seen the industry evolve, Ankit, in the past 5 to 6 odd years. What has private equity money done to hospitals? Has it improved and standardized operations? But has it also possibly removed the care which patients possibly want and have a need for?
Well, so firsthand, as far as Jupiter is concerned, we never had any private equity on our cap table, so I don't have personal experience. But I think they have played a significant role in terms of expanding access in the country. That is what I can say from the ring side. With much more capital that has become available for healthcare, what used to be a very slow-growing sector is today growing much faster. And I think on the whole, it is solving the problem of access as far as the country is concerned. We really are suffering from a huge supply-demand gap. We need to build a lot more hospitals than what exists today. And in that sense, I think private equity is solving the capital gap need.
Okay, all right, Ankit as well as Rahul. We need to take a short break, but before we do that, the management of healthcare global, in fact, believes that a cap on room rent is a step in the right direction. Here's a word from the ED and CEO, Manish Mattu. We'll take a break and be back.
See, over the last few years, we have seen the laddering between room categories has come down, and there's not a big differentiator between, say, a double twin sharing at a private room. But however, of course, it does exist. But I'm sure there will be a way to navigate this as well. I mean, we've navigated many things in the past, overall as an industry and healthcare global in particular, and this should also be manageable in the foreseeable future if this were to be reality. I mean, the committee must have given it some thought. I mean, personally may or may not agree with it, but let's see. I mean, I'm not even let me see what the content of that recommendation is, and before I can comment on. All I can say right now is that whatever the regulations be, I mean, we will, Healthcare Global will comply with all of them. And I'm sure the rest of the industry too. I don't think there are any clues about. And I think it's a step in the right direction overall, because I think the larger goal of the industry also should be to balance profitability with social good. And I think the industry has done quite a bit in the last couple of years, and there's no reason why we shouldn't continue to move forward with the government on this.
Welcome back. Well, we still have with us Ankit Thakkar, the CEO of Jupiter Lifeline Hospitals, and Rahul Guha, the MD and CEO of Thyrocare. Well, Ankit, we were just conversing about what exactly your thoughts are with regards to the private equity money which has come into the entire hospital space. Well, on one end, one can, argue about the commoditization of healthcare. But would there then be a fear that if in case there is ever any kind of cap that comes through when it comes to FDI in hospitals, there could be a slowing down on expansion when it comes to tier 2, tier 3 cities? That's really where the bed capacity is needed.
So I think, there is multiple things fueling the growth cycle. One is, of course, the private equity money that is coming in now. Two, along with that happening, the balance sheets of a lot of hospital groups are getting strengthened inherently. Three, with the growing penetration of insurance, the way it is anyway, combined with some of the government schemes, and now hopefully when the government is talking about addressing the missing middle, with more and more people coming under the insurance ambit, insurance becoming more prevalent, more affordable. All of these things will take away the affordability question out of healthcare. And once that happens, the supply will naturally catch up.
Okay, well, the supply will naturally catch up according to you. But, one big part of the standing or the parliamentary committee recommendations is basically standardization of hospital rates, standardizing packages, transparent schedule of charges, and potentially a cap on essential procedures as well. How exactly would this change the way hospitals price treatment today? And do you think that this is feasible?
To begin with, all for transparency. I think it's extremely important and vital in everything that we do, much more so in healthcare. As far as standardization is concerned, there are just so many variabilities in healthcare that for practical purposes, it is not a very clean service, so to say, which means you can't really have very specific definitions and inclusions and exclusions. So very clean standardization, neat structures are not very probable as far as healthcare is concerned. However, rationalization is necessary. I have also in our previous interactions, told you that pricing essentially must grow only in line with inflation. And, no one should think of much faster than inflationary growth in pricing as far as healthcare is concerned. So in that sense, rationalization, of course, is necessary and advocated. But a clean, structured standardization in healthcare is a little difficult to achieve.
Do you think that the standardization would then be geographically different? Do you think that it would differ for, say, a tier 2 town versus, say, a tier 1 city like Mumbai? Or do you think that it's so difficult that within the city of Mumbai also, within a particular city, there are different geographies and hence the pricing cannot be standardized at all?
So all the things that you pointed out and more, for example, difference between, different towns and cities, difference between geographies within one city, difference between the quality of facility within the same geography. There are a small 5 or 10 or 20 bed nursing homes, which also offer some medical services, which are offered by larger providers with much more complex technology. And finally, there is a variability from patient to patient, different comorbidities, different disease conditions and presentations. So there are just too many variabilities which make a clean standardization, as I was saying, a little difficult to achieve.
Okay. The report also talks about, hospital billing systems which are linked to approved tariffs. So basically the bill is automatically generated. It's not, it cannot be manipulated. And what you see in terms of the standardized rates is basically what you get at the end of it. And there's no surprise at the end of it. Do you think that at least that is feasible? Because that is the key complaint that patients have, that I was expecting certain charges, and then, you know, I added on and my bill was 2x of what my expectation was. Do you think that this will possibly bridge that uncertainty and that gap, which is much needed?
Yeah, 100%. And I think to a large extent, as far as the organized providers are concerned, it is a reality even today. Because when you're operating healthcare at scale, you don't really have the bandwidth to, you know, manipulate each bill on a patient-to-patient and line item basis. So as you said, all the services have predefined tariffs, which are also agreed with the insurance payers, and there is very little probability of variability on that account. So that is standardized even as we speak today, as far as most of the large providers are concerned.
Okay, 20% cap on beds, that's also been spoken about, and that is something that we've heard in terms of rumors before as well. Do you think that that would be feasible? Would it be something that even Jupiter would be ready to implement?
Yeah, so even today, you know, one of the other things which the parliamentary panel specifically called out is that healthcare today operates in a free market kind of ecosystem where market forces essentially determine most of the pricing that prevails. So, which is a fact, even as far as Jupiter is concerned, the pricing autonomy does not really lie truly with the provider, but it is pretty much linked with the market forces that we operate in. So in that sense, even today, you know, the pricing of beds and all other services is capped by various factors and stakeholders in the economy that we operate, including the insurance companies, including the regulators, including the competitive landscape where we are. So we are fully for that.
Okay, all right. Well, Ankit, it's been a pleasure speaking with you. Thanks very much for joining in and giving us all of that perspective. That's all the time that we have on the show. Thank you very much for watching this special.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Chip names are setting the tone for the region. As you can see, 0.5% down for Taiwan.
We have that certainly that ability if we want to do that. Yeah, you'll find.
Prices start to react. Sometimes it's almost immediately, sometimes it's not.
They've given a guidance of 15-16% YOY FY27 CC terms growth.
24,540 on the Nifty. The first rates are on your screen now.
I think as we go towards the back half of this year, you will see economic momentum broaden.
The room rent is a small fragment of the overall revenue.
Nifty at the low point of trade with a cut of almost 120 points. We're seeing the Sensex down 400 points.
This time around, the execution for the company has been impacted by supply chain disruptions.
Large cap is definitely a number that we've not seen in a while.
Wee bit of recovery from the lows. The major one in the mid caps is the geopolitical worries which are back on the table.
Okay, well, that's the day so far. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant Rima and Nigel with me. Guys, hi, good afternoon. I just want to quickly take a look at oil, which I think is inched up a little bit more from where we were at 8 o'clock in the morning. So closer to 90 than to... Are we at 90? I don't think we're 90. I don't think we've hit 90. Or have we?
Yeah, we had briefly touched it. Briefly touched it.
So 89.77, and we were just under 88 in the morning. So it's basically going in the wrong direction. That's the point. It's not headed down, and it's headed a little bit north. Is that the reason why the market is sulking a little bit? Maybe, but generally speaking, I mean, and this is something we were talking about, interest levels and general, trading interest otherwise as the earnings season also wraps up, perhaps at a lower ebb. At this point in time, no doubt about it. Individual movers here and there, of course, will be in focus, but otherwise, I mean, on a broad basis, generally, it's a little quiet out there. Today, of course, is also expiry, NSE expiry on the weekly side. So perhaps last 20 minutes, that cash session becomes a little bit more consequential. Rima.
It is indeed a very lackluster, lethargic kind of a trading session. The Nifty had a gap down opening. It slipped in the first half of the trading session, and in the second half of the trading session, it's been pretty much static around the 24,450 mark, 0.5% lower on the benchmark indices. Banks have been subdued in trade. The Nifty Banking Index is down more than 300 points, off from the session lows for the Nifty Banking Index, but weak in trade. Other notable losers include an Ultratech Cement, today below the 200-day moving average. Hospital names are weak, led by Max Healthcare, that's down 2%. Consumption names, Tata Consumer, Nestle, weak. Metal names, we've seen an increase in dollar index, we've seen a rise in bond yields, and some of these metal names are seeing some weakness. M&M, Grasim, Interglobe Aviation, Tata Steel also subdued in trade. The mid-cap index was holding up in the green in the morning, but that's also now dipped into the red. Let me tell you what we've lined up for you on the show today. The Hormuz uncertainty rattles stocks. The Nifty is trading around 24,500. Below that, small caps are outperforming to some extent in today's trading sessions, holding up in the green, 0.25% up on that. But downbeat trade across financials, consumption, metals. There's a rally in Info Edge, and that extends for the second consecutive session following strong numbers. Brokerages like Goldman Sachs, JP Morgan upbeat on this stock. Well, sources tell your channel that the promoter entities may add or sell stake in group companies. We're talking about the Vedanta Group. So this CNBC TV 18 exclusive coming up for you on Closing Bell. And splendid gains seen in Kolde Patil, the Pune-based developers. It's logged its best day in 3 years. We'll unpack the triggers behind such a move. Dismal Q1 numbers have dent the sentiment on KEC International. It's geopolitical uncertainty, which is weighed on the stock. The company sees some recovery in terms of margins by Q3, and they're holding on to their revenue guidance of 12 to 15%. Excerpts of our chat also coming up on the show today. But how should you position yourself in the last hour of trade? Ashish Kyal from Wave Strategy is now joining in with a few closing strategies. European markets too, by the way, are a bit weak in trade, so frontline Europe is down close to about 0.5%. Numbers coming in from Matrimony. Bottom line has more than doubled, 19 crore versus 8.5 crore. This has been a stock-specific market. But Ashish, afternoon. At the index level, what is your assessment of the trade today and the stocks that you recommend?
Hi, afternoon to you and all the viewers. If you look at the index, I think market is just trying to digest what we have witnessed over the past 1 week of CS closing last Tuesday. I distinctly remember was the closing was absolutely surprising and the options were all over the place, whether you look at last Tuesday or Thursday Sensex expiry. So today it looks to be a little more manageable where the options are behaving more in the defined pattern. But however, said that there is some kind of a short-term pressure that we are seeing on the index. So there is a possibility we might see a dip towards the level of around 24,360 on the downside. And on the upside, 24,540 is the hurdle. It's just a consolidation. So we had a very classic run up from the lows of around 23,600 towards the high of 24,750. And we are now consolidating. So that's a good sign. I think 1 or 2 days of consolidation, and then we should start moving back on the upside, possibly towards 24,750 and 800 levels. So any dips from here is an opportunity to position oneself on the buy side from a few days perspective. And having said that, the stock on the buy side is going to be L&T Mindtree. We can clearly see the IT sector as a whole has reversed up. It has reversed up from the lows that we have seen in the last year of 2025, also in 2024. Nifty IT index, if you track, has reversed from those same levels. And we are clearly seeing outperformance coming not only from L&T Mindtree, but also from Infosys, TCS. So I think IT is coming out now, and we should start seeing a good momentum in the IT space. So over in LTM, one can create long positions for the target of around 5,100, and the stop loss can be maintained at 4,690 levels. And the next stock on the buy side is going to be MCX. We can see over the past 2 days, MCX showed a very sharp rise. And I think a double bottom pattern is formed at around 2,600. We can expect MCX to reach towards the level of around 3,100 on the upside, and one can maintain a stop loss for the stock at 2,760.
Got it. Okay, all right. Thanks a lot for that, Ashish. By the way, keep an eye out on the bottom of your screen. You have Finolex Cables. I recall having an exclusive chat with the management after multiple quarters. They sounded extremely optimistic about the path ahead. And just take a look at that. In reaction to its numbers, the stock has just taken off. Now at the high point of the day, up more than 10% as we speak. The management of Finolex Cables had spoken to us exclusively here on CNBC TV 18. I recall that chat. We'll try to revisit the discussion points and then, in fact, get an outlook from here on as well. But InfoEdge, that's the start in trade. Brokerages, they have given their view on the stock. Vinny joins us to help us out with a quick analysis on all of that. Vinny, take it away.
Hi, afternoon. So InfoEdge today also continues to see that gain after they reported the numbers yesterday. Con call highlights were also quite positive. Goldman Sachs is maintaining their buy rating, target price of 1,410 rupees per share. What they are highlighting is that the recruitment side of the vertical in terms of revenue growth was a bit muted. But despite that, the company has a very diversified revenue base. Pricing power is there for them. Early traction in the new initiatives that they've taken on the AI side as well. So that will help the billings growth of the company going forward. And they're expecting that to be in the healthy mid-teens % growth that comes in on the billing front. Now, apart from that, they believe InfoEdge's billing growth has seen an acceleration, which is supporting the overall improvement in terms of margins, and they expect that trend to continue going forward as well. So they are overall quite positive for InfoEdge given the AI initiatives that the company has taken, reducing costs. They are not facing more on the worries on the customer front as well. So that is why Goldman Sachs is positive on this one. Even JP Morgan, they're maintaining the overweight rating, target price of 1,500 rupees per share. For them, the numbers were in line with expectations. Margin had seen an expansion as well. But what the tailwind that they're highlighting is the premium hiring as well as newer monetization value-added services. That's something that's here to stay for the company. And that is something that will support the billings growth of the company going forward as well. In the short term as well as in the long-term strategy as well. So that is why both the brokerages positive on this one. And today, the stock is holding on to gains of 7%.
Okay, thank you very much for that. That is InfoEdge, 7.5% higher on that. Ashish Chaturmutha, Managing Director and Fund Manager at JM Financial, now joins in. Ashish, just yesterday we were chatting with Dipan on InfoEdge, and he said while the Naukri story is doing very well, they've managed to nicely pivot away from IT services, get the hiring done from GCCs. The rest of the platforms, whether it's Shiksha, Jeevan Sathi or 99 Acres, hasn't really scaled up to that extent. What is your overall view on InfoEdge from here on?
Hi, Rima. So first of all, thank you for inviting me on the show. InfoEdge as a stock, actually, we have seen very massive underperformance in the last 1.5 years time frame. But of late, despite the kind of volatility we have seen in the ITES space, we are seeing very strong traction coming from the GCC capability, and that's where I think InfoEdge has also diversified itself into this space, and that's the reason we have also seen the top line growing almost 17-18% kind of growth rate, with the billings have improved meaningfully as compared to the last few quarters. More important part is what is happening on the real estate side, where we have seen 99 acres, or being acquired by one of the Indian company, and there we believe that the burn or the kind of cash burn capability is going to come down significantly, at least from 99 acres, because that's not a typical mindset which you will see from the acquiring company, and that's why 99 acres will do very well, because housing.com is being acquired by one of the listed players. So our belief is that 99 acres is also going to see very, very strong traction. In fact, it has seen very good traction this quarter also. So our belief is that, and even if you look at the numbers coming from housing sector, has also seen very strong traction. So let's take an example of Kolte Patil. It has seen very strong realizations coming in. So all put together, I think all cylinders are firing for InfoEdge, and our belief is stock is headed for a very strong re-rating, and a move towards 1650, 1700 could not be ruled out in the medium term for this stock.
Okay, all right, got that. Hi, Ashish. Good afternoon. Good to see you, Ben. Well, we have a lot of numbers actually that are flashing on the screen. We have RVNL as well come out of the set of numbers. Big bump up in terms of the net profit. We'll have to see how much of that is actually an operational move. RVNL now spiking up to the high point of the day as well. Let's go to the next stock that we want to discuss then. Sonal is joining in to tell us about a quick analysis on a stock that's been buzzing around, which is Kolte Patil. Sonal, take it away.
Thank you for that. Well, a good operational update coming in as far as their bookings collections are concerned. Yes, bookings were flat on a YY basis at 617 crore rupees. But if we talk about their realizations, a sharp surge there. They were up 29% at 9,442 rupees a square feet. Cash collections were up 30%, which is very important for a real estate company. Even their balance sheet looked strong because cash from operations were up 29% to come at 212 crore rupees. Company says their realizations improved because of price revisions that they took across projects, and also higher contribution from Mumbai projects because pricing there is much higher. Mumbai now accounts approximately 30% of their total sales value. Remember, Kolte Patil is primarily a Pune-based player, so Mumbai continues to be a bigger part of their pie as well, where they are getting higher pricing as well. They're looking at a lot of redevelopment in Mumbai, where margins are higher. So total gross development value here is around 6,000 crore rupees. Total saleable area here is 2 million square feet. The company says they will not be holding a conference call for Q1, also because there is a lot of internal reorganization which is underway, and the company is progressing through a phase of integration and leadership transition. So that is one of the reasons why they're focusing a lot on internal matters. But yes, the performance was strong, and the street is rewarding the stock for that.
Okay, thank you very much for that. Ashish, overall rate of the real estate performance in Q1 in terms of numbers?
Strong set of numbers, Rima, for the real estate space. So I think after consumer services, which has grown almost 50%, realty is one space which has seen almost 42% kind of EBITDA growth till now in the Q1, and I think this is very meaningful as compared to what we had seen in the first quarter of financial year 26. So I think overall very strong read through across the board, and particularly into the premium and and into the luxury segment, where we are seeing very, very strong realizations coming into it. Kolte Patil particularly we like because of the kind of diversification they have done from the Pune market to Mumbai market, and almost 30% contribution. So obviously it is going to get reflected into higher realization, higher margin profiling. So yes, we believe that the overall real estate sector is going to see very strong re-rating at this point of time.
The Vodafone Idea call is also going on, the conference call, and we will put out details and get a full summary. There's of course, details around fundraise, which will be important, price hikes, if, when, etc. Those timelines will be in focus out there as well. The other one is, I think Surya Roshni, which just reported numbers, and numbers on a year-on-year basis seem to be, very, very sharp improvement. for Surya Roshni. I mean, again, it's been an absolute dud for years. Every couple of years, though, it does give you hope that things perhaps are in the mend, etc. Then, but it hasn't really gone anywhere at all. So that is Surya Roshni for you. They've got the lighting business, they've got pipes, and so two separate sets of businesses under that one company. Yeah, I just want to quickly play out the management of KEC International and what they told us in the morning. So the numbers came out, numbers were disappointing, and the outlook is, I mean, maybe you can call it better, but not vastly better. Stock still down about, actually it's at almost at the low point of the day now, 5% lower. So let's listen in.
I think we should be talking between 6.5% to 7%. Order inflow right now, we have got around 6,300. We have L1s of 3,000 crores. So I think order inflow should happen. Margin guidance, sorry, not margin, the revenue guidance, I think 12 to 15, we are still sticking to it. Maybe closer to 12, then to 15. But I think we'll wait and watch because as I've been maintaining in EPC business, the revenues just get deferred. Net working capital, I think, is around 134 days or something. So for the year end, we want to bring it down to 120. I think throughout April and May, the labor shortage persisted significantly. Okay. June onwards, people started returning. So now we are, I'll say, almost at 90% of our requirement. So June, July, it's picked up significantly. We'll be still short of around 2,000 people or so, but I think that's manageable. On the labor front, so the civil business and to an extent in India T&D, mainly I'll say the civil business is picking up now in terms of revenue. Also logistics have gone up threefold. So that's another item which has hit the balance sheet or the P&L. Shipping as well as inward logistics. If you take a trucking cost, etc., and shipping and the trucking cost in UAE and Saudi has gone up significantly because the fuel prices have almost, I'll say, doubled there in West Asia.
The other one, that's KEC for you. Ashish, I don't know if you have any thoughts on KEC if you do come in. Manappuram, I think, also will report numbers later today. So if you have a view on, Manappuram and KEC, either both or maybe what you track.
So obviously, Manappuram is one stock which we have been liking because of the kind of, diversification they are doing apart from the gold business. And that is also going to see some kind of margin improvement. And this also got reflected into the last 3 months performance where gold prices have actually seen sharper correction. And a proxy to it was typically Muthoot Finance, which has seen very sharp correction. But at the same time, Manappuram has actually outperformed all these gold NBFCs in the same period because of the kind of diversification they have been doing on the business on SME, MSME front. So our belief is Manappuram from a valuation perspective also is very reasonably valued as compared to the peer. Obviously we all are waiting for the results, but definitely as a stock pick within this gold financier and also looking into the other NBFCs which are doing quite well, our belief is Manappuram should post a strong set of numbers, and we like the stock from a medium to long-term perspective.
Ashish, you also trade, as you used to, I'm not sure whether you do F&O and, iron sort of technicals, etc. The cash session today is NSE expiry. What should we expect?
So Prashant, very difficult, thing to judge. I think it has become extremely difficult to take a guess about this case. I think it's still evolving. Traders are still very cautious about what is happening, and I think it will take some more time for it to about the same.
Okay. Do you still do options? Do you still advise on?
No. So obviously we track the data very closely, but from a PMS perspective, obviously we can't do too much about FN.
Okay, all right. Ashish, we'll leave it there. Thank you very much for joining us. Good speaking with you on that note. Well, let's just actually talk about exactly that, options and what's happening there.
Well, that's right. The headline index is under pressure in today's trading session. The Nifty is down anything between 120 to around 150 points or thereabouts. But the mid-cap index actually is reasonably better placed, telling you that all is not lost. Actually, there are select stocks in the broader markets that you are seeing buying, and that's why you're seeing a relative outperformance. The PCR from a few sessions ago of around 1.1 1, it's come down to around 0.83 or thereabouts, telling you that there is aggressive writing on the call side. And that's precisely what's the case. The 24,500 call, the premium's down to 20 bucks from around 140 rupees. So there's aggressive writing that we've seen. In fact, it's dipped further to around 16 rupees as the time value of money gets eroded. The 24,450 put, though, out there as well, you are seeing some writing from around 180 rupees at the start of the trading session. Well, that's come down to around 40 rupees or thereabouts, which brings us to the levels. In terms of support, the 24,410, important support level, while on the upside, the 24,600 odd mark. I think just looking at the Nifty where we are, with a cut of around 130 points, I think we're going to get a bit of a swing in the final 30 minutes of trade. So let's see how that goes, but that's the broad range that we're working with. Individual stocks, LIC, that was the stock that I mentioned earlier today as well. It came out of the F&O ban, likely to be seeing fresh buying, and that's precisely what's happened, fresh buying in today's trading session. Eternal, quite interesting. The stock has done a very swift move from around 270, 275 rupees to around 315 rupees. And today there are first signs that the shorts actually are covering out. So it doesn't require a lot of fresh buying. If those shorts squeeze out, maybe in fact it gets some support from here on. And Dr. Reddy's is the other one that's seeing a bit of a short covering squeeze in today's trade as well. So those are the broad stocks that I'm looking at in trade today. We have the exclusive that's flashing for our viewers on the screen. Yeah, okay, this is something that we played out. Yash had covered this just a short while back.
There's a comment from the company, Nigel, which is...
Oh, okay.
So basically the news is, and we'll play this out with Yash, but that, I mean, the story was that promoters, all source pays that promoters may buy stakes in group companies. And the comment from the sort of companies come through, and I think that is essentially what you're seeing there. Vedanta does not comment on market speculation. This is attributed to a spokesperson of Vedanta Limited. So that's the it's just a comment in terms of response that the query that we sent to the company. We'll take a break. We are back. Ronak Onkar of PPFA's mutual fund on the other side. Stay tuned. Okay, welcome back. I think more numbers are coming in. Last few days, by the way, the earnings season, Insecticides India is there. Revenues are down about 11.5%. EBITDA is down 20%. As stocks come off quite sharply in response to those numbers. Stocks at about 628. Well, Ronak Onkar is with us, co-fund manager, equity, and head of AI research at PPFA's mutual fund. Ronak, good to have you with us, and I hope that I got the designation correct. So that's a new addition to the overall work profile. Tell us a little bit about it, Ronak.
I don't know what has changed. Prashant, thanks for having me, but I don't know what has changed the name of the title that you mentioned, although I'm still the fund manager and the head of research. But I don't know about AI research that you mentioned.
Was it? Sorry, it's not AI research, right? Head of... Okay. Okay. Ronak, talk to us a little bit about, okay, let me just ask you about one name which keeps coming up as, and you guys have, at least from a fund management perspective, have been the torchbearers. IEX, down and out. I think the case came up once again in the Supreme Court. The Supreme Court saying, well, we're not going to stop it now in terms of framing these regulations. Let it go ahead. And then once we see, once the rules are framed, then maybe we can take a look at it. But for now, nothing doing. What is, is it something you're holding because you've held for a long time, Ronak, or I mean, you're really convinced? I mean, it's not so much about whether this coupling will happen or not happen. And it's just, I mean, the underlying strength of the business. And you believe that despite coupling, the business will continue to remain very good. What is it? So explain that to us.
Sure. So with IEX kind of an exchange, we need to understand that bulk of the power that is traded today is a very small portion of the overall electricity that is consumed in the market. And as we are seeing more renewable capacity coming up, more volume gets traded on the exchanges. And of course, there might be a need to have multiple exchanges or platforms available for market participants. But if you look at a company like IEX with a dominant market share, of course, coupling, if it comes, doesn't come, we will see. The one thing that is important to understand is what is the mechanism with which the coupling will happen. So yeah, regulatory framework, mechanism of market share, mechanism of volume share, all of those things are still question marks, and how the business will respond to it. At the moment, the incumbent is very, very dominant. And there's a lot of demand and supply coming in on the platform, and price discovery happens on the platform. So it is a useful platform to begin with. So these network effects are very hard to dislodge. We will see how different market participants react, and we will see how the regulations itself shape up. So right now, although there is a consensus and it should happen, we'll see what actually happens when the implementation takes place.
No, is your base case that this will not happen, or is the base case that this will happen? And I like it even despite that. Because if it is the latter, I mean, then it's a more settled view. Otherwise, it becomes like a bit of a binary. You think it's not going to happen, but who knows? Or is the base case that this will happen, but I like it despite that?
So there are different market segments in which power trading can go under coupling. So we will see which segments that IEX caters to will get affected first. So a lot of things are actually question marks to us as well. And when the information comes in, we will respond to it accordingly. But at the moment, it's very hard to predict which market segments will be under coupling, what exactly the nature of the mechanism will be for coupling. Will it reduce the pricing capability, or even how much of new volume might come onto the exchanges as more and more electricity gets traded over a period of time. So the long-term theme is intact. It's just that the short term, we will have to figure out how the company adjusts to the new regulatory environment if coupling actually comes in.
Ronak, afternoon. The FlexiCap fund has underperformed the market because of your holdings in stocks like an HDFC Bank, ITC, Power Grid, Coal India. The market for the last 1 year or more has been chasing momentum, growth over value. How are you thinking then about the recent underperformance of yours? Are you looking to make changes in the way this market is going to be moving going forward? And what is the market construct?
So based on the underperformance, I think that is par for the course. Periodic underperformance, short-term underperformance is actually the feature of equity markets and equity investing. We have always been encouraging our investors to hold a 5+ year view when they're looking at investing in any of our equity products. FlexiCap fund is one of the equity products that we run. But yeah, the holdings have not done well, which is fine. I mean, some businesses go through various cycles of earnings and the market also responds to these cycles over a period of time, I think fundamentally the companies we own are very strong. They have great balance sheets. They can weather through a lot of cyclical downturn as well, if at all it happens. At the same time, these companies have growth potential as well. So when we invest in companies, we look for not just the quality of people and the quality of business, but also are we paying a reasonable or a low valuation for it. So by nature, if you're paying a low valuation for something, it might be not performing at that point in time. And apart from that, any other company or sectors which we are aware of, we haven't found too many attractive opportunities. So themes are there in the market. But yeah, if you don't find attractive opportunities in terms of valuation, we have not invested in them. And we had a little bit of cash in the portfolio. It's still at about 14.5%. But yeah, underperformance I don't think is a problem. It is, I think, par for the course when we are equity investing.
But stocks like HDFC Bank have given no return for the last 5 years. So is it a cyclical downturn or a structural downturn?
So far, if you see, the businesses have done okay. The growth rates have actually come off a little bit. Some of the lending companies are also cyclical in nature. We should not forget that. So we will see if it's a longer term trend and how the earnings catch up over a period of time. But of course, there are issues with the which are raised in the media as well about the bank's management, which you don't like to see in the media as such. But we will see how these companies respond to it. This is actually quite normal in the industry. These are very well-regulated entities. They actually have very strong distribution franchises, and they have also capital market subsidiaries along with it, insurance subsidiaries along with it, very well diversified businesses as well, along with the other businesses that they own. So I don't think there's an issue with these businesses. The market might respond to it eventually. The companies continue to grow.
All right. Hi, Ronak. Good to see you in. Ronak, what about this cash in the books? Don't you think it's time to go in now? The fund otherwise runs the risk of underperforming if the markets get their act together. Do you think now you'll start deploying more aggressively? I recall it was close to 19-20% at one point of time as well, if not more. No, actually, it was more in one of our interactions, I recall. So do you think now the allocation will be a little bit more aggressive? And also, I wanted your view on tech. We're just looking at a portfolio, and I think Indian IT is around 10% of your portfolio. You can correct me if I'm wrong. But do you think that's one pocket now?
So Nigel, yes, definitely the cash was at peak at about 25%, and we are close to about 14.5% as of the last month's fact sheet. So yeah, we have been deploying. It may not look like from a percentage point of view because stocks also keep moving and the percentage keep moving. But if you look at the portfolio disclosures, investors who are tracking the fund closely will know that we have been deploying over the last year, and the cash has come down from 25% to about 14.5% because of that. The view about IT, yes, we have about 10% in the portfolio in the IT services space. We own Infosys, HCL Tech, and TCS.
Just one last name, if you will. I think you also have the Bajaj holding company, right?
Yes.
In your portfolio. Is that just like a better way to get exposure to all businesses, auto, finance, etc., or is there a value unlock at some point which you're expecting, or is that an optionality?
So holding companies in India are a little oddity. Some trade at a very large discount to the underlying investments. Some trade at a narrow discount to the underlying investments. So Bajaj Holding is also a way to get exposure to the underlying companies in the finance and the auto space in the Bajaj Group. And at a discount that is about 48% as we speak. So yeah, it is basically exposure to the underlying. And what we have seen over a long period of time is that the underlying does follow the holding company in terms of valuation. So they will either be ahead or behind, but eventually the holding company tracks the underlying valuation.
Got it. We'll leave it there, Ronak. Thank you very much. Appreciate you joining us here. And Ronak Onkar, Head of Research and Fund Manager, not Head of AI Research, as I christened you. Thank you very much, Ronak. Appreciate it. Okay, all right. Well, let's talk about D-Street chatter, what Nimish is picking up in terms of his conversations. Nimish, people are enthu or people are a little laid back and it's a little dull out there? What's the mood?
A bit lackluster of late. Prashant, the Nifty has been stuck in a very narrow range. Not much happening from a large cap stocks point of view. But the focus is clearly on the mid cap names, and there is no complaint. A lot of momentum. I guess a lot of reactions are because of earnings as well, and because of which the mid-cap index has been relatively outperforming for the last couple of days. But still, there is a lot of interest and action in the broader markets. Even from a flow perspective, it's a mixed day with a positive bias. But interestingly, there is a bit of buying back in the metal stocks in today's trade. So that stands out from a flow perspective. As I've been saying, right, as we end towards the earnings season, the supply of paper, whether it's an IPO or a QIP or a block, that's going to continue and hit the market. So maybe in the very near term, the upside could be capped because of the oversupply. But from an earnings perspective, we are seeing a lot of reactions in the broader market names.
Got it. Okay, all right. Nimesh, what about individual stocks? What scoop are you picking up?
Well, Nigel, I'll start with first stock, which is normally a block. So the first stock in my list today is Tenneco Clean Air. It's been under pressure of late. I believe there is a supply coming in from a domestic AIF. They've been a big seller. And also, expect a very large block deal in Tenneco Clean Air very soon. So that's the buzz on that particular stock. Second, couple of names whether it's selling today. HDFC Bank as well as Indus Tower. Both have been beaten down stocks virtually at lows, but still even at current levels, there is supply from the larger institutions in both those names. So HDFC expect high delivery volumes on the sell side on both Indus Tower as well as HDFC Bank. Third is APAR Indices. It was part of my chat list yesterday as well. A QIP was on the cards. It got launched last evening. Surprisingly, the stock is higher today despite a large discount in the QIP because there is a very strong demand. I believe some of the large domestic mutual funds are anchor investors. So already the indication from the bankers was there is a demand of more than 4x to the QIP issue. So that's the reason why it's been buzzing in trade today. And the last is Borosil Renewables. Again, not done much in the last many weeks and months, but looks like the supply from larger HNS seems to be largely over. And maybe because of which you're seeing a small uptake in today's market in Borosil Renewables.
It is moving a little bit as we speak. Nimish, thank you very much for that. So that is D Street chatter at this point in time. Zaid is live. Look at the move, 7% higher, about 1,200, almost 1,200 now on Zydus at this point. We'll take a quick commercial break. Technical experts join in for some trading ideas. It's 3:04, so we got about 10 minutes to go for the reference rate to come through. Trading will stop. A transition to the cash session by 3:20 that will start. So all of that will happen, and perhaps a little more needs to be watched a little more closely because this is the second weekly NSE expiry under this new system. The first one, of course, I mean, things were absolutely crazy. Hopefully, because the difference between 315 and 330 on the underlying Nifty is reduced quite a bit, option prices will also be well behaved. So we'll see. We'll take that break. See you on the other side.
Welcome back. Well, the markets, more or less in the same band that we were at the start of the show. We're still sitting with a cut of around 130 points. There have been various attempts to pull back, but that's actually getting sold into. Let's welcome Ashish Kyal back on the show. Ashish, you've got a couple of fresh trades for us?
Yes, Nigel, absolutely. And before I go on the trades, very interesting, Nigel, if you can also observe options which are at the money and a little OTM options have been started behaving a little erratically. Where we are seeing spikes up across 24,600, 24,500 strikes and then cooling off. Let me go back to the stocks now. So the first stock on my radar for
Ashish, the point you were making, which strikes are you talking about? The 24,500 call?
Yeah, I'm talking about 24,500 call and 24,600 call. So if you look at 24,500 call, it showed a very sharp movement on the upside and it's still quoting at 16 rupees. It went to 30 rupees, now crashed to 15. And that's very, very weird because we are at expiry. 24,450 is Nifty. It should ideally be close to zero. It's quoting still at 16 rupees.
Got it. Okay. Interesting. That 15 became 30. It's back to around 16 rupees. Ideally, since it's so far out of the money, it should actually be almost zilch. But we'll keep an eye out on that. Go ahead with your trades.
Yes, so Anand Rathi is Anand Rathi Wealth. We can clearly see it has been outperforming over the past 3-4 days. I think capital market stocks should do absolutely well in the coming quarter, and Anand Rathi can move towards the level of around 2270 over short term. On the downside, one can maintain a stop loss for the stock at 2090 levels. The next stock pick is Eternal. We can clearly see a good consolidation, strong outperformance from Eternal as compared to Swiggy. And I think Eternal is breaking out again from here on after consolidation for the target of 335. Stop loss can be 307.
Okay, all right. There's news coming in. Ashish, thank you very much for that. News coming in on the paper on SEBI consultation paper, perhaps on allowing FPIs in non-agri commodities. It's a story we've reported on before, and I think the last we put this out was March of this year. So, I mean, this was supposed to be done for first for gold and silver and then perhaps others. I had sat down with the SEBI chairman in an interview in March, and he basically at that point said that they will consider allowing FPIs in options trading and commodity derivatives soon. So this kind of sort of all flows from that. Not new in that sense. I think it's just an update, so to speak. Well, Vinny's here, and we'll go back to that story on the non-agri commodities and exchange trading on exchanges by FPIs there. But Siemens is what we want to report on with regards to numbers and more. Vinny, take it away.
Hi, so for Siemens, they've reported revenue slightly better, largely we would say in line with expectations from what the street was anticipating versus the miss that's actually come in on the profit and margin front. So I would say it's a mixed quarter that came in for the company. Now, revenue saw a 14-15% growth on a year-on-year basis. Smart infrastructure segment of the company, that's a 11% growth. Mobility business, that's a 12-13% growth, as well as digital industries, that's a 25% growth. Margins, they have seen a contraction this time. Why? Obviously, because of the volatility in raw material prices, that's impacting the margins of the company. Apart from that, foreign exchange as well as increase in material costs, these are the factors that are impacting the EBITDA margin. If you look at gross margin, we've seen an improvement coming in on the gross margin front. But obviously, there's an exceptional gain that has come in this time as well that sold some business of theirs, and that exceptional gain is of around 2,099 crores. All in all, data centers, grid modernization projects, as well as real estate, commercial real estate side of the business has led the growth for the company in one of the smart infra segments. Mobility segment was led by the rolling stock business as well. So all in all, while we did see a miss coming in on the margins and the profitability front, revenue was largely in line. Order book is steady. Order inflows are seeing a good growth as well. And that's why the bounce back that we've seen coming in the stock as well.
Okay, all right. Thanks very much, Vinny, for that. So that's Siemens with the numbers and the reaction, of course, which is coming through. Well, let's just go back to the the exclusive. So the consultation paper from SEBI is likely to come soon. Yash is here with some quick details. Yash, take it away.
Well, Prashant, now with this approval which has come from the Commodity Derivatives Advisory Committee, there is nothing, no further step needed before market regulator SEBI really releases that important consultation paper which would pave the way, of allowing foreign portfolio investors when it comes to trading in non-agri commodities. Of course, you spoke about the fact that SEBI chairman had alluded to the situation where SEBI wanted to allow FPIs in commodity derivatives, post which there have been a few Commodity Derivatives Advisory Committee meetings in which this matter was discussed. The last one happened on August 3rd, where CDAC gave its final approval when it comes to allowing foreign portfolio investors. And now, with that approval, that entire bunch of, discussion would be taken to market regulator SEBI, which would be then embedded into that important consultation paper. I understand from our sources that there have been certain guardrails also which have been suggested by the CDAC when it comes to allowing FPIs into commodity derivatives. How would this happen now? Of course, there would be a consultation paper, feedback would be taken before regulations are formed, but the intention is to start with gold and silver as the non-agri commodities and then get into other commodities like copper, nickel, crude oil, so on and so forth. This is important particularly for MCX because, gold and silver put together contribute 77% of the futures turnover. These are the numbers of the first quarter FY27. The company reported those numbers very recently, and these are the numbers which stack up in the form of gold and silver. So important from that point of view. CDAC giving its final approval, the role of CDAC ending here. Of course, now things will be taken forward by market regulator SEBI in the form of that consultation.
Okay, all right. Yash, thanks very much for that. So it's 3:15, which means that the market will now transition to the closing auction session starting 3:20 to 3:28 is when that will run. But basically, the Nifty prices, the index prices are now, cash prices they're not trading anymore. Not just the index, but stocks with F&O contracts on them. Those prices will now start trading at 3:20. So we are at 24,450, I think, on the Nifty, and the Nifty Bank at about 57,366. And of course, we look at this, the change on these prices at 3:30 when the final price is discovered. Futures are trading though, and they'll continue to trade all the way till 3:40. Let's just stick with this closing auction session and just look at the data in terms of what has happened. It's been 6 days, started last Monday, so 5 days the last week, and of course yesterday as well. Bernstein has put out a note. Hormuz is here. We're just looking at the important matrices on what this has done to volumes across exchanges. Hormuz, take it away.
There's some interesting data that has come out from Bernstein this time around, and the first bit that they say is the fact that the changes that the closing auction session has brought about, it has led to many second-order effects, and although it is still in its early days, they are expecting it to settle down in the coming months going forward. And some of the other major points that they highlight is the fact that they have made a bifurcation as to how various asset classes will be impacted because of this. Not asset classes as such, but how various brokers will be impacted. But they say that there will be an impact on the near-term volumes and the capital market stocks as well. Now take a look at how the discount brokers, the asset managers and so on are likely to be impacted because of this. The fact that in their note they are saying that although the auction participation has been very sparse, and that has resulted in the price action distortion due to the liquidity factor, due to the thin liquidity factor, as was evident from the moves that you saw on Wednesday and on Monday and on Tuesday when the first 2 days of the closing auction session took place. Now, the table that comes up on your screen that will show you the decline in the volumes that has taken place during the cash week on the specific days as well. Now, if you take a look at that number on Monday, Tuesday was the weekly options expiry of the Nifty contracts, Thursday was the Sensex contracts, and you could see the difference from 424 million contracts traded 4 weeks prior. Then the cash week, it was down to 354 on Tuesday, and from 640 on the 4 weeks prior on the Sensex expiry contracts, it was down to 305 million on Thursday. So that was the kind of change that you have seen on the volumes. Now take a look at the impact on the various participants on this. For the asset managers, Bernstein has gone on to say that the next big test will be when the next rebalancing takes place, the Nifty or the MSCI rebalancing, because that is when passive funds which have have been staying away from the from the cash might be forced to participate, and that might lead to some bit of distortion or some bit of sharp moves in the prices as well. Now, if you take a look at how the discount brokers will be impacted, the discount brokers which are levered to the index options market, now they will also be impacted because of this. Now they are because they charge a fee on the number of market trades that take place during this period, and because of a decline in volumes, then near-term revenues are likely to get impacted as well. Now, because of the fact that the number of options contracts have also come down, so the traded so far, as you just saw in that table. So it is an interesting note that Bernstein has put out. The big takeaway is the fact that although there are teething issues, yes, but there will be it would settle down going forward, but the participation is something that still remains a subject of concern.
Got it. Thanks a lot for that, Hormuz. Always on the ball. Thanks for taking us through that note. Jay Bala, though, of Cash Chaos is waiting by. Hi, Jay. Good afternoon. Good to see you in. Let's get your outlook on the big asset classes that we track. Nifty, Nifty Bank, Tech Index, if at all.
Hi, Nigel. Thanks for having me on the show. So the Nifty is, dithering around the breakout level, and as long as it stays about 24,100, the breakout that it had tentatively before the CAS started, I think that's still valid. But we don't want to see it drop too far below 24,100, and the risk actually comes from cross assets and mainly from crude. Crude should not cross the 31st July high. That's roughly about 86, 87 on the WTI. I don't exactly recall the level on the Brent. So when it comes to the banking index is slightly better off versus the Nifty. The supports are about 55,750 for the banking index. As long as it stays above that, I think the markets are good. But the broader bull market that continues. Like I pointed out last week, the Nifty equal weighted index is at record high. The Nifty auto index has joined it at record highs. So the broader markets are the place to be. Wait for the large cap Nifty to join the breakout, but it's better to be focused on the broader market rather than on the large cap Nifty.
Any particular trading ideas?
Yeah, I have one from the auto ancillary space. I'm bullish on LG Balakrishna Brothers. Stop loss of about 1440, and probably this one is scaling to record highs. See, this LG Balakrishna is on a long-term uptrend, and the recent move is also very trending. And the pullback has been, the choppy signature of a corrective decline. So this slightly lower volume stock, so don't get too aggressive. Stop loss of 1440 is essential. On the 7th of April, I had pointed out I was bullish on the real estate space, and it's heading to record highs. And the real estate sector has traded up to 940 from those levels. And today we have a breakout in Kolte Patil. Kolte Patil is breaking out above a long-term trend line, and it went to nearly to circuit, and it's pulling back. That's a welcome move for me. But unfortunately, it's run up too fast. But so you want to stagger your placements of orders here. So a stop loss at about 435. I'm expecting the stocks to scale about 700 odds.
Okay, got that. Just look at the indicative closing prices at the bottom, at the side of the screen. The closing auction session has started. So the Nifty is 24,482. So it's a 30-odd point change for now. But this is, the indicative price. Yesterday, by the time we ended, there was, I think about an 8-odd point difference between the 315 and the 330 price. That's where we are at. And the Sensex, the same thing for the Sensex as well. The indicative price will come up. And for the Nifty Bank as well, as the things settle down. 441, 366. So that perhaps is a little bit more, about an 80-odd point difference compared to where the Nifty Bank was at 315. But it should also settle down. Like yesterday, every day since this was introduced last Monday, the gap has kept narrowing, as Hormuz also just pointed out with that data which Bernstein has put together. So we'll have these rates up, and I think you should be able to see all these rates on your terminals if you're trading. The indicative closing price for all these the stocks which have got F&O contracts, the 219 odd names or so, they should all be visible in the same form that you have on the screen at this point. We'll take a quick commercial break. We are back. There is, I think, still about 6 minutes to go for close. Be right back. Okay, well, welcome back. I think the closing auction session is, I think about 2 minutes more and we should be starting to get the rate. The auction will end randomly between 320 and 328 and 330, and then the price is discovered. But this is 424, and that is 57,424 indicative price, and 366, about a 60 odd point difference on the Bank Nifty. And you look at the Nifty 50, 467, 450. So it's about a 17 odd point difference as of now. But the final rate will come through in just a bit from now. Jay Bala is with us with his thoughts. He ran us through his trading ideas, etc. These hospital names, Jay, do you have any views? There's some news there, which not exactly positive. Stocks have done well, and then they've recently not done so well. Max Health, for example, and others. Any thoughts?
Yeah, I haven't looked at these recently, but Max Health is not in a uptrend, so I would avoid them. And but the pharma sector as such, it's in a better place. So I'll avoid these names for the moment.
Okay, avoid these names. Anything else on your radar? Any sector in your radar?
Yeah. I'm positive on real estate space and capital goods space. Capital goods, we have recently had a corrective decline that's finished, and probably the bounce from the recent low of July is probably a start of the next uptrend. So you might want to keep your focus there. And I know we had recommended Siemens a few weeks ago, and that's at a fresh 52-week highs. So look at something like GE Power. That's it's recovering from a corrective decline. It's set to go to fresh all-time highs, but it's very thinly traded, so be a bit cautious.
Okay, got it. Thanks a lot for that, Jay. We've got the final rate on the Nifty. It's popped up close on 21 points in that cash session. We ended at 24,450 at around 315. And now the final rate has come in there. So it's popped up close to around 21 points in comparison to what we had at 315 or thereabouts. Quick check on stocks that moved around today. Chennai Petro was up 14%. Rolex Rings was up close to 14%. Kolte Patil was up close to around 11%. Giving CPCL company on the upside was MRPL. Stock was up more than 10%. And you had Sapphire as well as Devyani. That merger was announced, both those two stocks. They rally in tandem now, and that's precisely what happened. Cupid was up close to around 5%. Protection for the bulls out there. While the Vedanta Group stocks, you have Vedanta, Iron and Steel. That was up close to 5% for the second day running. So good moves on those. On the flip side, you had ABFRL, that's Aditya Birla Fashion and Retail, was down close to around 4%. Vedanta was down close to around 2.5%. Bit of an overhang on Hindustan Zinc as well, with buzz that potentially there could be some kind of supply. We'll have to see how that goes. But Hindustan Zinc actually ended at the low point of the day after seeing some firmness in trade today. Sagility was down close to 1.5%, and ITC from the bigger boys was down close to 1%.
Hospital names took a leg down after a draft regulation to cap the room rents, similar to what a 3-star hotel would charge in the vicinity. So Max Healthcare, Apollo Hospitals were the big drags today. Max Healthcare down nearly 3%. SBI corrected a bit, so that's down about 0.5%. And even yesterday, it was under pressure. In fact, over 2 days, SBI is down nearly 3%. ITC, Bharti Airtel, Wipro lost about 0.5% on the back of the NSE changes. Wipro will be exiting the Nifty, while BSE will make an entrance. On the way up, you had strength in Dr. Reddy's. That was the big gainer, 4% up. Eternal, Glenmark Pharma, TCS, Titan also in the green.
All right. Just one point, guys. If we could pull up the 24,450 call, that premium is around 21 rupees. So that issue seems to be sorted out right now, because we ended at 24,471, and the 24,450 call, the premium out there is ended at around 21 rupees. So we had a bit of a spurt, earlier with regard to the 24,500 call. That as our guest told us, it moved from 15 rupees to 30 rupees. It's ended at absolutely zilch, which is the way it is, because it's still out of the money. We ended 24,471. Well, that strike is at 24,500. So I think the pieces are coming together now, since we have the options here.
Yeah. So 24,400 call, 400 call, that is ending at 71, which is again largely okay.
Yeah, that's
but the intraday is what? I'm looking at the intraday chart.
Yeah.
So look at this. At 320, the 24,400 call, that is at 320 was at 45 rupees, and it jumped to it basically doubled, from 320 to about 323 or so. I mean, I think it went up all the way to about 85 rupees, and then it finally kind of settled down to. So yeah, I mean, there is a bit of volatility around some of these, because I think, but it's much better. It's a lot better. I mean, if you remember the last Monday, the first day, option prices went absolutely berserk. But of course, the move was also very large. So two things have happened. The moves on the Nifty themselves, the underlying themselves, has become small. And second, of course, is the fact that you can see the rates. I mean, the indicative price is there. I mean, on the Nifty. So that is also, and we are showing it, others are showing it, and I'm assuming it's available on broker platforms, etc. as well, which apparently was an issue when we started in the first couple of days, when we started the closing auction session. So I think settling down now in that sense. You will, of course, have examples on some strikes and etc. But I think we pointed out two strikes where, at least by the end of it, it seems to be fine in that sense. It's a wrap on this edition of Closing Bell from all of us here. It's goodbye. Thank you for joining us. But if you're trading still, because futures markets are trading, futures and options are still trading all the way till 340. You'll be, of course, be able to find rates and coverage here on CNBC TV 18. We'll take your leave. Thanks for watching.
Markets were under pressure today with the benchmark indices losing around 0.5% each. The Nifty ends below the 24,500 mark while the broader markets outperform.
The Parliamentary Committee on Healthcare aims to cap hospital room rates at local 3-star hotel room rates. It also proposes caps on prices of other items and binding cost estimates before procedures. Whether this will roll out remains the big question.
Vedanta promoters are looking to shuffle their stakes across group companies. Sources tell CNBC TV 18 that the promoters may raise their holdings in the oil and gas and iron and steel arms and are likely to raise up to 3,000 crore rupees by pledging Vedanta and the aluminum business shares.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vivek Iyer, and with me today is my colleague Hormaz Fatakia. Good afternoon, Hormaz. Well, a session which was very choppy, very stock specific, but at the end of the day, we are ending the day with cuts of 0.5% each.
Take that with what it comes, because it was expected to be a very volatile expiry session. But after the market made its intraday low somewhere around 11 o'clock, we have mostly remained within that range, that 150 or 50 or 100 point range between 24,400 and 24,500. So eventually ending at the higher end of that, around about 24,470 is where the index has ended. And the Nifty Bank was the principal culprit as to why the Nifty was down in today's session. And well, it's managed to close to that 57,500 mark, a level that it has been managing to defend all through last week and on Monday as well. But of course, it managed to end significantly off the lows of the day, and that is something that the bulls would want to build upon as they go into midweek trading. But here's the lineup of what we have in store for you today. We start with the top movers and shakers with RIA. We decode why hospital stocks came under pressure and the buzz around a promoter stake rejig at Vedanta. In addition to that, we also bring you the top earnings wrap for the day. And last but not the least, we delve into the key market events to watch out for going into Wednesday's trading session. Over to Ria, who's here with the top movers of the day. Ria.
Well, yes, a lot of movers in today's trading session. Let's start off with the gainers first. We have Finolex Cables as well as Gland Pharma, both reacting to their Q1 numbers, and both of these stocks up nearly 50% in the last 6 months. Amara Raja Energy also saw strong gains today, again reacting to its Q1 numbers, and Chennai Petro as well as MRPL, both of these stocks saw strong gains in today's trading session on the back of higher GRMs globally. In fact, Chennai Petro has been performing well over the last 1 year. It has more than doubled. Also looking at some of their stocks which have hit their 52-week high as well as their all-time high today, we have Redington, Anthem Bio, Aether Energy as well as Bosch on that list. All of these stocks seeing gains of up to 4% today. On the flip side, looking at the losers in today's trading session, all of these stocks reacting to their respective Q1 results. We have Triveni Turbine taking a big hit, nearly 6% today. KEC as well, and the stock has been down nearly 40% in the last 1 year. HLE Glasscoat hitting a lower circuit of 20% today. Idea Forge as well hitting a lower circuit of 5%, although this stock has doubled in the last 4 months, and Castrol also seeing a big cut today.
Well, thank you so much, Ria, for joining us and giving us a sense of all the top movers as far as today's trading session was concerned. But one set of stocks that were under pressure today was the hospital pack. This after the Parliamentary Committee on Healthcare proposed 3-star cap on hospital room charges. Ekta joins in with the key takeaways of the Parliamentary report.
A Parliamentary Standing Committee on Health and Family Welfare has just tabled a report covering hospital pricing, insurance, diagnostics, medicines, and critically, foreign investment in hospitals. Let's start with the affordability gap driving all of this. Average hospitalization cost is around 6,631 rupees in a government hospital versus 50,508 rupees in a private one, more than 7 times higher. For childbirth, for example, it's around 2,300 odd rupees versus over 37,000 odd rupees in a private setup. Government health spending sits at just 1.43% of GDP, and the committee wants that pushed all the way to 5% of GDP over the next 5 years. Now, one of the observations that should possibly worry investors: foreign investment in hospital ownership. The committee flagged FDI often exceeding 51% in hospital operational management, arguing it's enabling the monopolistic acquisition of mid-size hospitals by large corporates, calling the transformation of healthcare into a purely capitalistic enterprise. It asks to review and rationalize FDI limits specifically for hospital acquisition from what it calls predatory corporate buyouts. For a sector riding a wave of private equity-backed roll-ups, think Manipal, Aster, and most recently Medicover, that's possibly a flashpoint. Now on pricing, the committee recommends an immediate mechanism to standardize and cap the cost of essential treatments, diagnostics and routine procedures across private hospitals. It wants a framework to standardize rates for common procedures and diagnostic tests, backed by audits. And a strikingly specific detail: hospital room rate charges should not exceed the average room tariff of a 3-star hotel in the hospital's immediate vicinity. It is also recommending a national mechanism to cap essential procedures and diagnostics and wants hospital billing systems linked directly to these approved rate schedules, so bills are auto-generated and can't be manipulated. The logic: published price, standard package, transparent bill, effectively creating a de facto cost cap. The committee also recommends incentivizing hospitals that earmark at least 20% of their bed capacity for highly subsidized or free treatment, tying government concessions directly to how much affordable care a hospital actually delivers. And on diagnostics, the committee wants public-private partnership for high-cost scans like MRI and CT at capped rates, plus shared resource networks for expensive equipment. For cancer care specifically, it wants ceiling prices on PET CT, MRI and genetic profiling. On insurance, the committee flags over 40 crore Indians as the missing middle, too well off for free schemes, unable to afford full private insurance. Its fix: a standardized contributory product priced at around 4,000 to 6,000 rupees a family annually, with OPD coverage plus health savings account, with employers possibly contributing 100 to 200 rupees a month per worker for informal and gig workers. The bottom line: this report pulls in two directions. At once, more insurance, more government spending, greater utilization on one side, price caps, room rate benchmarks, billing transparency and FDI scrutiny on the others. These are recommendations, but the noise of private hospital regulation in some form is getting louder, and if even part of this framework lands, it could possibly reshape the economics of Indian healthcare, from the hospital bed to possibly even who's allowed to own it.
Ekta, thank you for that. To take this conversation forward, we are now being joined by Sudeep Bandyopadhyay of IndiTrade and Jay Bala of Cash the Chaos. Gentlemen, good afternoon. Thank you for joining in. Jay, important levels now on the Nifty. We're closing to that 24,500 mark yet again. So is that now becoming a firm base for the index?
Yeah, see, the Nifty has already had a breakout over 24,600. It's just a consolidation post that. The hangover of CAS is still there. But as long as the Nifty stays about 24,100, I think the breakout is still valid. We are looking at fresh 52-week highs to come through, but the risks are coming from cross assets, specifically from crude. If crude can stay below July 31st high, that's about WTI level is about 86, 87. Around that mark, then we are still okay. But if it exceeds that, there'll be some amount of further downsides that's possible for the Nifty. So watch crude to stay below the or not cross too far above the July 31st high.
Okay, Jay, thank you so much for that. Well, now on to a CNBC TV 18 exclusive. Vedanta promoters could be looking at a stake shuffle across group companies with plans to step up holdings in the oil and gas and steel businesses. For more details, let's go across to our colleague Yash.
Well, Vivek, what we're picking up is some news when it comes to a very interesting reshuffle that could be happening within the Vedanta group. What we've been given to understand is that promoters of Vedanta may look to buy in certain group companies, and to fund that buying may look to sell or trim their stake into some group companies. I'll exactly come to the names in that sense. Promoters, according to our sources, are looking to up their stake when it comes to Vedanta Oil and Gas, which is VOGL, and Vedanta Iron and Steel, VISL. These are the two companies where, according to our sources, Vedanta promoters could look to increase their stake. At the same time, the funds which would be required to buy out this additional stake in the oil and gas and iron and steel subsidiary, Vedanta promoters could look to trim their holding when it comes to Vedanta Limited and Vedanta Aluminium. According to our sources, the fundraising which Vedanta promoters would do in Vedanta Limited and Vedanta Aluminium could be to the tune of about 2,000 to 3,000 crore rupees. It could be done either through any kind of stake sale or pledging of shares when it comes to Vedanta and Vedanta Aluminium. We've written to Vedanta on this particular query and they have replied to our query saying that Vedanta does not comment on market speculation.
So keep an eye out on these developments. Yash, thank you for that. Sudeep, which among the Vedanta entities do you prefer, or you still continue to prefer the parent one?
Well, I definitely prefer aluminium, Vedanta Aluminium, and of course the parent as well. Parent very much because of Hindustan Zinc. That's pretty much what it is. And the potential is significant. Expansion is on track. So Vedanta Limited and Vedanta Aluminium, these are our favorites. I think this is a part of a corporate strategy where they want to do something with the steel and the oil and gas unit. And before that, they want to increase promoter stake in these companies. So this must be a part of a larger corporate strategy.
Well, thank you so much for your views on the Vedanta Group and Vedanta Aluminium in particular, Sudeep. Well, it's been a busy couple of days for our capital goods analysts. Remember, Siemens came out with its results today. Triveni Turbine and KC International came out with its results post-market hours yesterday. All of them were in focus after their Q1 results. Winnie joins in with the key takeaways from these results.
Hi, thanks so much for that. For Siemens, obviously, in terms of numbers, we would say a mixed quarter that came in, right? Revenue came in line with expectations, but margins and profits, that's where the miss came in. Margins of the company even saw a contraction this time versus last year. There was a one-off around 2,099 crores in terms of overall profitability when you look at it. That 2,099 crores was an exceptional gain due to one of the sale of one of their businesses. So because of that, we are seeing that adjustment coming here. So adjusted profits are seeing a decline on a year-on-year basis. Now, apart from that, smart infra side of the business, that's managed to see a growth. Mobility business has also seen a decent performance, as well as digital industries managing to see a very strong growth. For smart infra, in terms of the margins, that's seen a contraction on a year-on-year basis. Robust performance in smart infra in terms of the revenue was mainly led by grid modernization, data center, as well as commercial real estate. Mobility side of the business was mainly led by the rolling stock side of the business as well. What impacted the margins was raw material price volatility, foreign exchange, as well as increase in those costs is something that's a concern. So we saw a bounce back coming in for Siemens Energy, given that the order book was strong, order backlog is strong of the company as well. And obviously, in terms of revenue, that was above expectations. Triveni Turbine, on the other hand, a weak set of numbers that came in from the company in Q1 FY27. Order inflows managed to see a growth of around 6% as well. Margins mainly saw the impact coming in this time of unfavorable mix, price escalation, as well as some of the orders, delivery orders were phasing out as well. So that is important to watch out for, though they expect H2 FY27 to be better than H1 FY27 overall in terms of margins as well as growth. So let's watch out for that. But the stock was clearly under pressure. KC International also a muted set of performance from the company this time as well. In terms of T&D side of the business, the transmission side flat in terms of growth there. SAE business, that saw strong growth. Railways, renewables, that saw a decline coming in here. Overall net debt has reduced, that's positive. And working capital seeing an improvement. That's a positive there, but stock was under pressure.
That's right. Thank you so much, Vinny, for joining us and giving us a neat wrap of all of the results from the capital goods space. Well, Sudeep, let me come across to you first. Request you to keep this a little short. Within the capital goods market, what is your top pick and why?
Well, after listening to the KEC management commentary and seeing the numbers, I think I will go for KEC. Very simply, Hitachi, Siemens, GE Vernova, all of them are fantastic companies doing very well. But the valuation there is rich, whereas KC International, post what has happened over the last 4 or 5 months, has seen significant correction. And I think it's on the cusp of a quantum jump from here. Things are improving. The Afghanistan, that 300 crore from ADB is expected to come anytime. Labor shortage has been taken care of. And as soon as the West Asia conflict stabilizes or recedes, I think the order book will start swelling significantly. So I will go for KC International at current prices. Of course, this is a bit of a risky strategy.
Remain a believer as far as KC is concerned. Jay, very short response, please. Your top pick, within the entire capital goods space, which is the chart that is looking the strongest?
Yeah, I'm bullish on the entire capital goods space. I'm expecting capital goods index to hit 99,000. But KAC might be close to a selling exhaustion, so avoid for now. But the best is probably GVP So GE Power and GE Vernova.
Sudeep Jay, thank you for sparing time and joining us on the show with your views on the stocks that moved around in trade today. Take a short break, back with the top corporate voices and the key market events to watch for tomorrow.
Welcome back to Markets Forward. Well, here are some of the top corporate voices that we had during the course of the day. Travel tech firm RateGain reported a strong set of Q1 numbers with their profit jumping 102%. Speaking to CNBC TV 18, the company's management said it is confident of exceeding its 3,100 crore rupees revenue guidance for the year, with booking numbers also up 200%.
TVS Supply Chain Solutions said that it is targeting up to 5% margins in its global forwarding business, while India could account for 40% of the total turnover in the next 3 years. The management also said that it plans to partially depledge promoter holdings in FY27.
And, to give us a gist of all of the key events to watch out for in tomorrow's trading session, our colleague Ria is standing by the big wall with all the top events to watch out for in the session tomorrow.
Well, starting off with the global data, first in the US, we will have the CPI inflation as well as the core CPI month-on-month data to watch out for. We also have the August monthly oil market report by the IEA, which will be in focus. And in India, we have the CPI inflation data to watch out for. In terms of results, we have HAL, Grasim, Apollo, as well as Petronet LNG and Astral Limited that will be in focus tomorrow. On the IPO front, we have Shiprocket, Bihari Lal, Doot Transmission, as well as Molbio Diagnostics, which will be in focus. And in other events, NSE will be launching the Nifty India FPI 150 Index Futures and Options from the 12th of August.
Ria, thank you for that update there. We take a leave on this edition of Markets Forward from Vivek and me. Thank you for watching. More news and updates continue on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Hopes fade for a deal between the US and Iran. President Trump demands Tehran pay compensation for people killed in wars, attacks and protests. Iran's new leader, Supreme Leader, announces several new key appointments, names a former wartime commander and veteran political insider to head the nation's highest security body. Crude oil prices near the $90 mark. Sensex and Nifty decline after a range-bound session. Mid-caps outperform but end with marginal losses. Rupee weakens by nearly 15 paisa against the dollar. Equity mutual funds record inflows for the 65th month in a row, but large-cap funds see outflows for the first time in nearly 3 years. Flows into mid-caps and SIPs remain stable. A US judge approves the Justice Department's request to drop criminal charges against business tycoon Gautam Adani and others in an alleged bribery and fraud case. Judge finds irregularities in the decision to dismiss the indictment and terms the conduct of a senior Justice Department official as highly unusual. Gautam Adani welcomes the verdict. Wall Street's largest banks and investors bet big on Nvidia. The AI giant signs a memorandum of understanding with Goldman Sachs, BlackRock, Blackstone and others to mobilize over $500 billion to fund its infra build-out. CEO Jensen Huang tells CNBC this is the first time chips have become an investable asset class. Parliamentary Standing Committee on Healthcare proposes to impose a limit on private hospital room rates and standardize costs for surgeries and other procedures. Also proposes to review and rationalize limits of foreign direct investment. Says FDI is enabling monopolization, acquisition of mid-sized hospitals by large corporates. Deadlock continues in Parliament with just 2 days left in the monsoon session. Lok Sabha passes the bill to rename Kerala as Keralam amid sloganeering by opposition. Home Minister Amit Shah not present in Parliament today. Government has said the Home Minister will make a statement on the Jantar Mantar crackdown if the opposition does not disrupt the House. No let-up in the student protests in Jharkhand. A day after the police crackdown, more than 100 ABP workers detained after attempting to march to the assembly. The state assembly is adjourned 1 day ahead of schedule. Government extends the incentive scheme for electric two-wheelers till March 2028, but halves the subsidy to 5,000 rupees for each vehicle. Only two-wheelers that cost less than 1.5 lakh rupees are eligible for the incentives. And rescue workers combed through the debris in Colombia after a powerful earthquake jolts Cali and dozens of cities and towns. At least 132 people killed and thousands are missing after what is the worst earthquake in 10 years. All right, the top story this evening, negotiations between the US and Iran through mediators continues as both sides demand compensation for damages in the conflict. Here are the latest developments. Now, US President Donald Trump has demanded compensation from Iran, countering Tehran's ask of reparations from Washington. Speaking to reporters at the Oval Office, President Trump said, and I quote, "We are going to ask for money for the damage they've done over a 50-year period," end of quote. He also claimed that the US naval blockade is a steel wall and that US is letting ships transit but is not letting them go to Iran. Iran said that the US had asked for negotiations just 20 days after Trump demanded unconditional surrender at the start of the conflict. According to Iranian state media, Iran's foreign minister Arakchi said that Tehran has shown the world that it is a tough and invincible power. Iranian Supreme Leader Mojtaba Khamenei announced a series of new appointments across the army establishment and the Revolutionary Guards. Khamenei has named Mohsen Raza as the Supreme Leader's military advisor. Oil markets continue to remain on edge. Brent crude prices hovered near the $90 per barrel mark as traffic in the strait remains constrained. The UK military flagged report of an incident involving a tanker and military forces in the Gulf of Oman. More details are still awaited. Here's US President Trump on talks with Iran and the situation at the strait.
They asked for reparations, you might say, or they asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period. Whether you go SS Cole or whether you go all of the people that were so badly hurt, so badly wounded or killed, many thousands of people, and maybe damages for the 52,000 protesters over the last 4 months that were killed in Iran. We think their families should get damages for killing their person or their child or mother, father.
Russia launched another large-scale attack on Ukraine, killing 6 people. Ukrainian President Zelensky said that North Korean missiles were used in the attack that was calculated to inflict maximum damage. Russia says it attacked military-related transport and logistics centers in Kiev. Ukrainian forces also launched drones towards Russia, with one person reportedly killed in the western part of the country. Now, freight costs are increasing for Indian exporters, with rates on the US, Europe and other Western routes surging nearly 4 times in just a couple of months. Exporters are now paying over $9,000 per container, compared with around $3,000 earlier. Industry experts said congestion at ports is delaying vessel availability and multiple blank sailings are disrupting schedules. Strong festive season demand is further intensifying the issue, giving shipping lines room to charge premium rates. The Dalal Street ended a range-bound session in the red. The Nifty closed below the 24,500 mark, while the Sensex shed nearly 400 points. The Nifty Bank also ended about 0.5% lower, in line with the benchmarks. The mid-cap index, however, outperformed and closed flat for the day. All right, a quick look at money markets. The rupee weakened for a second straight day, touching its lowest level in 2 weeks as oil prices also rose. However, RBI intervention kept the fall. A mutual fund flow data for July is out. Equity mutual funds recorded net inflows for the 65th month in a row. However, large cap funds recorded their first net outflows in almost 3 years. Vinny Motiwala joins us with the key trends from the data. Vinny, please take us through the numbers.
Thanks so much for that. So let's talk about the big picture. Equity fund inflows that have come in this time. Yes, a slight bit of a moderation versus the month of June. It is down 15%, but the trend shows a clear preference that's coming and a shift coming in, chasing more growth and more mid and small cap, more flexibility is what the investors are chasing versus a large cap. So now let's start with the large cap. What happened on the large cap category fund? When you talk about it, the category saw a reversal. There was an outflow this time in terms of large cap funds. 1,321 crores was the outflow. So this is the first time since December 2023 that we're seeing an outflow coming in for large cap funds, suggesting investors are currently leaning more towards the categories that are giving greater flexibility and better growth, and sticking to those categories versus a large cap. So now let's talk about the categories that are stealing the story this time, and that's the mid and small cap funds. Mid cap funds, they have managed to be stable. 6,192 crores is what their inflows came in at, up 2% versus last month, holding steady there. Small caps, that's the story, right? 7,767 crores in terms of inflows. This is the best inflows in almost 2 years that one has seen coming in, at least for the small cap category. Trend surely indicating that investors are still confident on this category in terms of encouraging trends and allocation in terms of money more going towards the mid and small cap. Flexi cap funds is another category that is also a beneficiary and has continued to see that up move in the last few months as well. Even this time, they managed to see inflows of 4,790 crores. Now, let's move on and talk about another preference that is coming in from investors. That's going to be in terms of the sectoral and thematic funds. 1,328 crores is what they have garnered this time in terms of sector funds, a bit lower but still stable versus what we've seen coming in the last few months. Apart from that, new fund offerings that have been quite exciting. A lot of new launches have come in, 25 new funds, 2,022 crores is what the new offering inflows have come in for the month of July. SIP contribution stable at 31,961 crore for this month as well. Hybrid also has seen a good inflow, lower than June, but still stable over there. So all in all, positive territory performance that is coming from most of the funds. Large cap is a bit of a miss.
All right, thank you, Vinny, for that. Now, dairy products company Milky Mist IPO was subscribed 67% as of 4 p.m. The subscription was led by employees, followed by retail investors and non-institutional investors. The company has a fixed price band of 133 to 140 rupees a share for public offer of 1,553 crore rupees. The share sale will conclude by August 13th and will be the largest IPO by a dairy company in the country. And in what comes as a big relief for business tycoon Gautam Adani and his nephew Sagar Adani, a US judge has dismissed charges of conspiracy, securities and wire fraud against them. However, the judge found irregularities in the decision to dismiss the indictment and termed the conduct of a senior Justice Department official as highly unusual. Hormaz Patakia joins us now. Hormaz, please take us through what transpired.
A big relief coming in indeed for Gautam Adani and his nephew Sagar Adani, because the US District Judge Nicholas Garofis, he has dismissed the conspiracy, securities and wire fraud charges that were against both the Adani Group chairman and his nephew, and these pertain to allegations with regards to them paying bribes worth close to $250 million to Indian government officials for securing solar energy contracts, charges that the Adani Group has been denying all through and through. And it was this case that led to that indictment that took place towards the final days of the Biden administration, towards the later half of 2024. Now, the process to resolve this issue was ongoing all through the year, because just a couple of months earlier, Adani Enterprises also paid $275 million to settle the Office of Foreign Assets Control, or the OFAC probe that falls under the US Treasury Department. And the group also settled in with the US SEC, the Securities Exchange Commission, in May, when both Gautam Adani and Sagar Adani together paid around $18 million to settle the issue, which pertained to misleading statements with regards to a 2021 bond issuance. Now, with regards to this, JP Morgan says that they are continuing to remain positive on the entire Adani Group complex. They say that this is a positive for sentiments across the group. They're saying that they've already demonstrated enough and more diversified funding sources, and now with a complete resolution, that avenues may increase even further, and that could also possibly lead to a US dollar bond issuance in the future. What JP Morgan is also saying is that the group is likely to step up capex and pursue M&A across their companies, and therefore they continue to remain overweight across the entire group companies. Although there were no significant price action seen among the Adani Group stocks, because these stocks have run up considerably in anticipation of this, and whatever they had lost right from the start of the first phase of Hindenburg, they've recovered all of those losses and a lot more.
All right, thank you, Harmaz, for that. Government has extended the incentive scheme for electric two-wheelers till March 2028. But the subsidy has been halved to 5,000 rupees for each vehicle. Only two-wheelers that cost less than 1.5 lakh rupees are eligible for the incentives. The terminal date for all segments under the scheme is March 31st, 2028. Now, shares of Vedanta fell in trade after sources indicated that the promoters may buy and sell stakes in its group companies. Shares of Vedanta and Vedanta Aluminium may be pledged or sold by promoters and are looking to raise up to 3,000 crore rupees. Remember, SEBI allows equity purchase of up to 5% a year via the creeping acquisition route. Now, deadlock continues in Parliament with just 2 days left in the monsoon session. Lok Sabha passes the bill to rename Kerala as Keralam amid sloganeering by opposition. Home Minister Amit Shah was not present in Parliament today, and the government said he will make a statement on the Jantar Mantar crackdown if the opposition doesn't disrupt the House. The President has also given assent to Vande Mataram bill, granting the song same legal protection as national anthem. A parliamentary standing committee on healthcare has recommended capping and standardizing the cost of essential treatments, diagnostics and routine procedures at private hospitals. The panel has also called for a review of the existing foreign direct investment framework in the private healthcare sector. Ekta Batra joins us now. Ekta, please take us through the key recommendations.
Let's start with the affordability gap driving all of this. Average hospitalization cost is around 6,631 rupees in a government hospital versus 50,508 rupees in a private one, more than 7 times higher. For childbirth, for example, it's around 2,300 odd rupees versus over 37,000 odd rupees in a private setup. Government health spending sits at just 1.43% of GDP, and the committee wants that pushed all the way to 5% of GDP over the next 5 years. Now, one of the observations that should possibly worry investors: foreign investment in hospital ownership. The committee flagged FDI often exceeding 51% in hospital operational management, arguing it's enabling the monopolistic acquisition of mid-sized hospitals by large corporates, calling the transformation of healthcare into a purely capitalistic enterprise. It asks to review and rationalize FDI limits specifically for hospital acquisition from what it calls predatory corporate buyouts. For a sector riding a wave of private equity-backed roll-ups, think Manipal, Aster and most recently Medicover, that's possibly a flashpoint. Now on pricing, the committee recommends an immediate mechanism to standardize and cap the cost of essential treatments, diagnostics and routine procedures across private hospitals. It wants a framework to standardize rates for common procedures and diagnostic tests, backed by audits. And a strikingly specific detail: hospital room rate charges should not exceed the average room tariff of a 3-star hotel in the hospital's immediate vicinity. It is also recommending a national mechanism to cap essential procedures and diagnostics and wants hospital billing systems linked directly to these approved rate schedules, so bills are auto-generated and can't be manipulated. The logic: published price, standard package, transparent bill, effectively creating a de facto cost cap. The committee also recommends incentivizing hospitals that earmark at least 20% of their bed capacity for highly subsidized or free treatment, tying government concessions directly to how much affordable care a hospital actually delivers.
All right, thank you, Ekta, for that. Moving on to Jharkhand now, where there's been no let-up in the student protests the day after the police crackdown. More than 100 ABP workers detained after attempting to march to the assembly. The State Assembly is adjourned one day ahead of schedule. Chief Minister Hemant Soren said on official social media that the student protesters' demand would be taken seriously, but the students have said they will not call off their protest until the JSSC result is cancelled and a CBI probe is ordered. Right, time for a short break. Coming up next, Wall Street's largest banks and investors bet big on Nvidia. The AI giant signs an MOU with Goldman Sachs, BlackRock, Blackstone and others to mobilize over $500 billion to fund its infra build-out. More details when we return. Welcome back. You're watching Business 360. NVIDIA is trying to turn AI chips into Wall Street's newest asset class. The company has inked memorandum of understanding with Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs and KKR. The aim is to mobilize over $500 billion in third-party capital to fund data centers and NVIDIA hardware. In a rare roundtable on CNBC, NVIDIA CEO and executives from 6 companies discussed the announcement. CEO Jensen Huang said this is the first time chips have become an investable asset class.
We're announcing 6 partnerships today. These partnerships are going to pull together independent long-term capital to fund and support AI infrastructure build-out. This is an extraordinary time, as you know, because this is the first time in some 60 years that the computing industry is going through a fundamental platform shift from the way that software was done before to the way that it's going to be done in the future, called artificial intelligence. Fundamentally, what's different about this industry and this way of doing computing is that the computer is now part of the infrastructure, like electricity, like the internet. But now, NVIDIA's AI factory platform is really an investable asset.
I think one of the things Goldman Sachs brings to the table is we have an extraordinary distribution network. So we bring capital, but we also bring a very, very unique distribution network. But Jensen came, approached us with the idea, and we said, you know, we'd love to talk to you about it. We have a deep belief in the direction of travel and the opportunity set over the course of the next 3, 5, 7, 10 years.
And I applaud what NVIDIA has done, bringing all these firms together and saying, we have a common goal. We need to raise $500 billion. Obviously, that's an unprecedented amount of money, but we're going to have to raise trillions of dollars over the coming years. And I do believe this is going to be representing a fantastic investment. In fact, I think it's going to be such a large investment. Over time, you're going to see more and more allocation into this asset class.
So today at our companies, we've seen a 7-fold increase in demand for LLMs in the last 6 months. And yet the amount of compute is not keeping up. The data centers, the power, the chips. And so what you're going to see here is people are going to begin to recognize that this is a financeable asset class.
And you can catch all the roundtable action with NVIDIA CEO and all the Wall Street stalwarts at 7:30 and 9:30 p.m. right here on CNBC TV 18. Anthropic has reportedly introduced an invisible watermarking system for content generated by Claude. The watermark is designed to make AI-created text and files easier to identify without changing how they look or read. Rachna Dhanrajani has more on this and the other developments in the tech space. Rachna.
Well, first up is, of course, Anthropic now watermarking what Claude writes. Models launched from August 2 weave an invisible mark into generated text that can survive copy-pasting and some editing with signed provenance data on files. It applies worldwide, not just in Europe, but is in accordance with EU AI Act transparency rules. However, Anthropic has cautioned it is not a definitive AI detector. Then there's OpenAI that has completed roughly $7 billion employee share sale ahead of a potential listing. The valuation held is at $852 billion, which remains unchanged from their March fundraise. Now, OpenAI bought the stock back itself rather than bringing in outside investors. Then in the US, the Ninth Circuit has declined to hear a Section 230 appeal as premature, leaving thousands of addiction suits against Meta, TikTok, Snap and Google to proceed. The court did not rule on the merits of the defense. This comes almost a week after Meta was fined almost $1 billion by a Mexico court in a similar youth addiction lawsuit.
All right, thank you, Rachna, for that. Moving on to Colombia now, where a powerful earthquake has rocked the country, killing over 130 people and causing extensive damage across several cities. The epicenter was located around 400 kilometers west of the capital, Bogotá. Now, the quake was felt as far away as Ecuador and Panama, though authorities there reported minimal damage. Colombian president has declared a state of national disaster and deployed soldiers to the affected regions. At least 61 buildings have collapsed and more than 1,500 homes damaged. Rescue crews were digging through rubble in Cali, where patients remain trapped under a partially collapsed hospital. 7 airports have suspended operations and hospitals, roads and telecom networks across the region have been disrupted. Colombia's Geological Service says it's the country's strongest earthquake this century. Now, Typhoon Dolphin has pushed deeper inland into China, prompting the closure of key tourist sites and suspension of high-risk construction projects. Beijing is expected to be hit by more than one-third of its annual rainfall over a 24-hour period. Forecasts have also warned of extreme rainfall, with flooding and landslides posing a risk across the affected areas as Chinese authorities continue to evacuate more than 1 million people. Now, Trump Media and Technology Group, which owns Truth Social, reported a wider second quarter loss. Unrealized losses tied to its cryptocurrency assets widened the net loss to $240 million from $20 million. More than 10 customers have signed up to Trump's Media's controversial service that offers faster access to market-moving posts made on its Truth Social platform. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. A segment that is making big strides in India's food processing sector is the bakery and confectionery industry. What's surprising is that this 2 lakh crore rupees industry is largely driven by small businesses. India's bakery market is estimated to cross $32 billion by 2034, growing at a healthy 8 to 10% CAGR. So what is biggest hit among Indian consumers? It's something as simple as bread. Bread accounts for nearly 36% of the market, driven by stable household consumption and strong institutional demand. Another interesting factor is that nearly 65% of the industry remains unorganized. And when it comes to India's sweet tooth, well, cakes and pastries are amongst the fastest growing segments, with the market currently valued at around $5 billion. So what are the key trends shaping India's bakery market, and how is the premium segment rapidly gaining ground? We discuss that in today's show. Joining us now to take that discussion forward is Arc Bakery Corporation's S. Anburajan. Joining us from Tamil Nadu, Defense Bakeries' Gaurav Dhingra joins us from New Delhi. And from Karnataka, we have G.K. Pramod of Iyengar Oven Fresh. From Kerala, we have a representation as well. We have Mr. K. Balaraj of New Jolly Bakery. Gentlemen, hi, thank you so much for joining in. And it's a segment that seems to be really growing, especially with the kind of urban development, the kind of spending, nuclear families, you name it, and almost everything points towards bakery right now. Gaurav, let me come to you first, and let's get the numbers out of the way first. What would you say is the overall Indian bakery market size like, and how has it been growing?
First of all, thank you. Thank you very much, Manisha, for having us all on board. Very quickly, our industry is currently valued at around 1.7 lakh to 2 lakh crores, and it's among the fastest growing. So we're looking at a CAGR of, technically the report says 9.12, and we're rounding off to 10%. So this is the scope of the market where, incomes are rising, nuclear families are growing, and structures are evolving. So therefore, it's poised for a very robust growth.
Gaurav, also, when you look at the value addition, I mean, that really is a category that seems to be growing in right now. People want easier, faster, simplified access to food, and bakery perhaps seems to be making inroads there. So what is the kind of value addition that we are looking at into the space?
Currently, you must have seen there is a new product which is trending, which is the sourdough bread. So that's a value addition to the entire bread segment. These are healthier eating trends which are happening, naturally fermented trends. This is where your normal bread from a mere under 100 rupees or 125 rupees a kilo, it can sell for approximately 250 rupees a kilo. So that's a great value up.
Gaurav, also, I mean, as you said, it's the artisanals which seem to be doing well, and that's a premium category. You have to pay premium price for it as well. And how is that one growing?
In the premiumness of the products, we are looking at, there is always a fear in the bakers industry that when we do artisanal products, will our products be able to, sell? Because we deal with daily items. So there is always a bit of a hiccup, because we are looking at creating a brand for ourselves in our local community so that you get more trusted. And when you gain the trust, the customer is naturally inclined to pay a little extra. We as bakers do not forget that we are a necessity for the industry.
Mr. Pramod, let me come to you then. And what would you say are the India's buying trends when it comes to bakery? I mean, as Gaurav is telling us, well, yes, the market is shifting. There is a bit of a premiumization that you're all working with. But what are the trends right now?
The current trends are moving towards more of a healthy kind of an option. If you look at the protein-based kind of products, people are interested to have more protein-based products, because everywhere now the Gen Zs talk about proteins. Everybody become health conscious. It is health is wealth. So the protein-based concepts are picking up. If you look at Karnataka, already a company by name Loopworm, which has done the usage of the waste in the silkworms, they're actually preparing an animal food. So you also have whey proteins which are based on the milk products. So the protein bars are picking up. So the customers now want a protein-based approach to the bakery products. So we are already experimenting the protein-based cookies, protein-based shakes, protein-based brownies. So the proteins are getting added. And if you look at the millets as a section today, the millet protein powder, millet-based bakery products, millet-based cookies are actually becoming more interesting from the protein perspective. And also, as Gaurav told, value addition is the key. Whether it is the value addition in terms of the sourdough he talked about, it is a value addition in terms of the cakes. So today people want more design cakes. They're trending more towards cream designs, fondant designs. They want customization. And a value addition is in terms of the celebration. They need a place for celebration. So they want to come and celebrate. So the value addition is going to play a major differentiation. The uniqueness we need to add to our products and our services. So now, according to me, it's no more a product. Like earlier, it used to be takeaway. The solo bakeries, the small bakeries, where customers used to come and take away the products. But it is not now takeaway. It's also the experience. That is the reason you are seeing a trend that there is a merge between the bakeries and cafes. So there is a merge happening in this, and a lot of cafes are offering the bakery products. A lot of bakeries are offering the cafe products, which means I don't want the solo product. I don't want to just take it to home. I want to celebrate myself. I want to have a kitty party. I want to have a birthday party. So it is an opportunity for all of us to increase the ticket size. A customer comes to order a cake, say for 2,000 rupees, and there is a place for him to sit and relax and celebrate. The ticket size automatically goes up from 2,000 to 5,000. So it is the of the entrepreneur to add value. And in fact, in terms of the market value, I was just evaluating 800 billion in the global scenario, and in the Indian scenario, 140 billion of people. And even if you consume a protein bar of 5 rupees a day, it's a huge market.
I agree. I get your point. It's an experience that a lot of us are looking at right now. And I get your point on sourdoughs and millets and whey protein. We want stuff healthy, but we want it flavorful as well. I understand you have a lot on your plate to work upon, but that's exactly what the market is looking like right now. Mr. Balraj, let me come to you right now. And the hot point right now, of course, is the food safety regulations. I mean, we have it coming in from Mumbai, Maharashtra, from Bangalore, South India, various parts of the states. When it comes to bakery as an industry, how would you look at the food safety regulations therein and the abiding by it?
Yeah, madam, first of all, let me say one thing very clearly. We welcome, of course, IBF is welcome FSSI. We welcome food safety enforcement. We welcome inspections. And most importantly, we welcome higher standards. Because ultimately, who benefits from all this? It is our own customer, it is our own family, and it is our own society. As bakery people, we have absolutely no objection to food safety. In fact, we want our food to be safe. We want our customers to trust us with they have to come back to us. But at the same time, I would like to make one small request to the government. Let the enforcement be science-based, transparent, consistent, and proportionate. Because you see, a large food company and a small bakery are not always operating with the same resources. A small bakery may have a limited number of workers, limited technical knowledge, and limited financial capacity. Sometimes the entrepreneur may genuinely want to comply, but he may not even know exactly how to comply. So before we punish such a person, let us first give him the knowledge, give him training, give him guidance, explain the requirement, give him a reasonable opportunity to correct the mistake. And if somebody is deliberately violating the food safety standards, definitely take action. There should be no compromise when public health is genuinely at risk. But a genuine MSME entrepreneur who is trying to comply should not feel that an inspection itself is a punishment. Our risk is very simple. Punish the deliberate violator, but educate the genuine entrepreneur. Because if we can, if we can, a small bakery compliant, we are not only protecting the consumer, we are also strengthening the bakery industry itself. And finally, the IBF, Indian Bakers Federation, would say this: we are not against FSSI, we are not against inspections, we are not against higher standards.
Sure.
We are with the government, and we are with the public. We only want to enforce to be fair, practical, transparent, and proportionate, so that food safety improves and at the same time genuine small business can survive.
All right. That
Grow
point
and serve with the public. Yeah.
That point
Say
is very well taken, that you're not against it, but yes, an easy approach, perhaps a more scientific approach, as you said, is something that the market does not mind at all. Gentlemen, do stay on with us. We have to take a very short break. When we come back, we'll of course talk about the challenges that bakery as an industry faces, and of course the forward-looking vision as well on where the bakery industry finds itself in the next 5 to 8 years. We will discuss that after this very short break. Welcome back. You are with us on Commodity Champions. And bakery industry, as we were discussing before the break, is something that's growing the fastest within that segment. But each industry has to have some challenges as well. Mr. Anbur Rajan, let me come to you exactly for that. What is it that the bakery industry, the bread industry is looking at right now? What are the challenges that it is facing? And do you think there is some hand-holding that this industry needs from the government as well?
Yeah, I accept that bakery industries are rapidly growing in our country, but at the same time, we have to think of the other side. The bakery product industries are nowadays facing a lot of issues because the uncertainty of raw material hike. You can see every day the raw material going upwards, but we can't increase the selling price in our bakery outlet. That is the main problem we are facing. And another one thing, due to the recent war, that the energy sources, our bakery industry main energy source is diesel and gas. Both the price are recently hiked nearly more than 40% rate of percentage is increased. So that, but we can't at the same time we can't increase our selling price also. But at the same time, petrochemical maximum of the packing material based on petrochemicals. So that also increased recent days. And main issue, the young generation, all the young generation, they are seeking only white collar job, not only to turn up to the industrial activity. So that in our industry, a wide skill gap is there. That also we have to address that. Recently, we approached the government through Ministry of Food Processing from Indian Bakery Federation. They also consider our appeal. The only positive sign in bakery industry is Indian Bakery Federation continues follow up with the central government for our grievances. They consider our request and they are understood the justification. They are reducing the rate of tax for bakery products is 18% to 5%. That is only the positive sign for our industry.
Oh, well, absolutely. You put that so well in various pointers. Yes, there are some challenges as every sector has, and this sector also has a few. The skill gap, the energy prices, the raw material of that, of course, has been increasing, and there are some concerns there as well. Mr. Pramod, let me come to you, and let's talk about the way the markets are buying or the distribution channels. The quick commerce really seems to be picking up. We, of course, have hypermarkets and supermarkets, but would you say it is the quick commerce that really seems to be changing the face of bakery industry as well?
Absolutely, because it is convenience that, I have some guests coming to home and I need some hot puffs, I need some hot samosas, I need some cakes. And the best way to order it sitting at home and then the next 50 days. For convenience, even as a baker, I would love to buy on e-commerce. And if you look at the market size, it is close to around 6 billion. And the CAGR growth is more than 40%. We are expecting it to reach around 130 billion in the coming years. So this is companies like Zepto, companies like Blinkit, already few traditional Karnataka bakeries, iconic bakeries have already started giving their products on these platforms. And it's a big opportunity because for me, the distribution is much easier. I have to just give it to their warehouse and then, produce a quality product and my distribution straight away goes to the customer without any other middle agent.
Sure.
So the only concern area here is that whether again, these commerce companies don't share the database of the customers. What are their commissions? Whether it will become another kind of a story, what we are currently facing up with Swiggy and Zomato, whether it will take up that shape, that part need to be observed carefully.
Sure.
But otherwise, even a WhatsApp-based commerce for a small baker need to have his own WhatsApp-based commerce where the product can reach out to his customers in a much more convenient way by having a third-party tie-up with the delivery partners.
Oh,
so
absolutely. This is something that you'll, of course, as an industry have to watch out for, as we've been constantly saying that 90% of bakery is still MSMEs and unorganized is something that the street will have to look at. But Gaurav, let me come to you. And, the festival season is upon us, and bakery is not just about breakfast or tier 2, tier 3 cities anymore. It's about curation. It's about longer shelf lives. Do you think the festival season, as always has been the case, is looking at curated, custom-made, and a slight of a, giving some competition to the traditional mithais as well?
Well, definitely. The festival season, and India is a country of festivals. And wherever we are, the festival season always brings a little bit of a bonus to all the bakers. You know, all throughout the year, there is the necessity angle of it. But then when time comes, we always upsell our products such as cakes, pastries, brownies, and we curate certain specific requirements. Even now, besides the festival traditional season, we are looking also at the wedding season, which is also there, and bakery products have become extremely popular. I'd like to add, in addition to the point which Anburajan sir also made a little earlier, that our industry is right now accounting for 84% of the total industry's employment. So the challenges which we face, they need to be resolved, because when the festival season hits us, we need the kind of skilled people in our industry, and this is where there's a lot of challenges which arise to execute our businesses more smoothly. So the demand is there, but of course we need the right hands and people in our industry to close those gaps.
I'm assuming that would happen as you get more and more organized therein. But Mr. Anburajan, let me come to you with a final question then. What is it that bakery as an industry is looking at as a vision, let's say 5 years down the line? What is it that you are looking at in sense of growth, in sense of opening up this market?
Yeah, actually, chances are really open to all the fellow bakers. But at the same time, more entrepreneurs coming up every day. From our association also, we are encouraging people to come up a new entrepreneurs. And right now, plenty of home bakers are developing in their home. They don't have any compliance and all, but they are capturing the market heavy.
Oh, well, yes, those cloud kitchens and those homemade chefs is something that you can't really avoid with. But Gaurav, let me come to you with this as well. Would you say investments, capex, technology, innovations, continuing to evolve within the space is something that you as an industry will have to look at?
Yes, evolution is important. Keep innovating your products, keep innovating experiences, keep innovating the offers which you bring to the customer, because our customer definitely needs the baseline of keeping consistent products on the menu, but time comes and you need to reinvent yourself every season, I would say. And that's what keeps the engagement going, a positive sense of engagement going with your clients. And this is the secret of successful bakery business.
It sure is. And on that high note, gentlemen, thank you so much for joining in. Thank you so much for taking us through the bakery business, of course, in India. Those are some of the numbers that we don't really touch upon on a daily basis, but this is a segment which is quickly and surely growing in the Indian markets. And as our panelists tell us, that it's a CAGR of nearly 8 to 10% of a growth that we're looking at, with newer products, newer markets getting into the space as well. But with that, that's all the time that we have on this segment of Commodity Champions. Thank you for watching.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, tensions continue to simmer in Jharkhand over the alleged irregularities in competitive examinations for state government jobs. Now, clashes broke out between ABVP workers and police this morning as protesters marched towards the Jharkhand Assembly. The march came a day after police used lathi charge to disperse student protesters who had entered the assembly premises. Now, protesters alleged that the police stopped vehicles carrying students to Ranchi and erected multiple barricades topped with barbed wire. Now, BJP workers also staged a protest outside the Chief Minister, Hemant Soren's residence in support of the students and called for a statewide bandh. Meanwhile, Congress leader Rahul Gandhi condemned the police action. The State Assembly has been adjourned one day ahead of schedule. The protests have been underway now for more than 2 weeks, with students demanding a CBI probe into all examinations linked to the Jharkhand Public Service Commission. On Sunday night, the state government said that it had accepted 98% of the students' demands. The government agreed to cancel 3 examinations. 3 JPSC members have also resigned. Education Minister Sudhivya Kumar has said that the ED would be asked to probe suspected financial irregularities, but the state's own CID would investigate the criminal aspects of the cases. But the students have said that they will not call off their protest until this investigation is handed over to the CBI and that the Jharkhand Staff Selection Commission combined graduate level examination result is cancelled. The state government has said that it does not have the authority to cancel the result as the process was monitored by the Supreme Court as well as the High Court. Instead, it has offered to set up a high-level judicial inquiry committee headed by a retired judge to oversee the CID probe. However, the students have rejected that proposal. And well, joining us now to help us unpack the various contours, the various layers of this latest protest is with us Yashovardhan Azad, a former IPS officer. He'll just be joining us in a bit. We also have with us educationist Dr. Vinod Sharma, who's joining us live as well. To both of our guests, thank you so much for joining us. Dr. Sharma, let me come to you first. We've seen not very long back a protest that we saw in Jantar Mantar in the national capital. At the time, the central government was saying that, look, these are forces inimical to the nation. These are opposition-led forces that are causing chaos. Now we have a case of turning of the tables. Jharkhand has a Congress-supported government in power. They are now saying that, look, it's the ABVP, it's the BJP-led forces that are causing trouble in Ranchi. Are we at risk of losing out the message that Gen Z, that students are trying to convey amidst all the politics that we are seeing?
Yeah, thank you so much for inviting me here. Yes, of course, we can see that now India is facing an education reform. Education is calling out that it must be reformed. And second thing, what I could see, the protest is not of any government and not of any politics. It is always of students' welfare, students' interest. Any government, all governments have faced the protest, and protest is the right. Students may be of Delhi, students may be of Jharkhand, maybe of Rajasthan. Students have rights to protest. What do the students need? What do they want? They want jobs. They want earnings. They want stability. They want success. What for? They are studying for a long time. But when they see the examination pattern is corrupted, that turns into their dreams got shattered. In that case, usually the students are irritated, they are frustrated, they don't know what to do. And once this kind of protest triggers, the students join them. But what they're looking for, they're looking for success. And second thing is, coaching mafia. Coaching mafia is the paper leak mafia and examination pattern, because nowadays the coaching institutes, they do not take admission for studying and for coaching. They take admission for guaranteed success, for guaranteed job, for guaranteeing the paper arrangement, providing papers. So that is the reason.
We'll actually come back and explore some of the causes and perhaps what the solutions could be with your advice, Dr. Sharma, in just a bit. But let me also get Mr. Azad's perspective. Mr. Azad, not very long back, we had a conversation about the protest that we saw in the national capital. We were discussing if there was excessive use of force by the police here in Delhi. I want to pose the same question, only change the location. What we've seen on August 10th, would you term it as excessive use of force? There was, again, similar cases of water cannons, lathi charge, use of batons, use of tear gas. While we do have the right of protest of students on one hand, did you see any excessive use of force in Ranchi?
Well, it's difficult to state from here whether there is excessive force or not. There have been injuries both sides, 5 and 4, which are read in the newspapers. And I think everything was used. The water cannons were used. Also, the tear gas shells were used. And the crowd was moving towards, they broke all the barricades. And so the lathi charge was inevitable. In a case situation like this, any police would be accused of, alleged brutality because, you can't have a mild lathi charge. You have to use force to push back people. And in this pushing back, there are injuries, which is absolutely normal. Even if you look at the Nirbhay Kand, which took place in 2012 in Delhi, RAF was used. There were injuries both sides. There was 45 policemen. In fact, senior 4 policemen got injuries in the head. And the crowd was also, injured, at least 5 or 6 of them. So I would say that this is a regular practice. The actual issue is forgotten.
But Mr. Azad, let me then ask you a supplementary question. If this is what we've come to expect, you cited the Nirbhaya protest, we've seen in the Jantar Mantar protest, now seeing in Ranchi as well. Does it further strengthen the case for an SOP to be formulated and then subsequently deployed, enforceable SOPs on the ground for police forces? Take, for example, lathis not to be struck above the waist so as to not cause any injuries to the head. These SOPs are already in place but not being enforced.
You see, the SOP is not even required. I mean, when we were here in the field, I never read the SOP in my life, but these are well known. I mean, you first start with a gradual stage, and then you go up to a lathi charge. So using a lathi below the waist is known, firing below the waist is known, because the crowd is not an enemy. I mean, you have to manage the crowd. You don't have to disperse the crowd using lethal force. So these are well known. But given the situation that it's difficult. I mean, there are definitely unprofessional acts by the police, and it happens in the heat of the moment. A policeman gets hit by a stone. He goes wild. He attacks 4 or 5 people. The question is, the policeman cannot act in an indisciplined manner because he has to work under the law. The crowd can do anything it feels like. But the reaction sometimes becomes disproportionate. There is no doubt about it. But there are 2 things I want to point out about the protest itself. I think the protest is sans ideology, the sans politics. And even if they allege that ABVP is there and in Jantar Mantar they allege the Congress is there, for the first time, I think this kind of protest has really shaken the roots of the government and governance, because they have pointed out the exact malady. And I think time has come to take out education from the grip of the bureaucrats and give it back to the educationists who are the right persons to handle this. I'm very happy that the Gen Z has already had an impact. The PSC members have resigned. But let me tell you another thing. The state PSCs are in a very bad shape across the states. And everywhere this is the same problem. And mind you, this agitation of Gen Z is going to pick up in all the states. They better beware that this thing is coming.
Well, that's an interesting issue that you're flagging, that this issue of paper leakages is not unique to only NEET. It's been seen across multiple public examinations, competitive examinations affecting lakhs and lakhs of aspirants and students. Let's talk solutions now. Dr. Sharma, let me come to you. When we look at a solution, when we had the Jantar Mantar protest, that led to a high-powered committee led by Nandan Nilekani. This government as well in Jharkhand is proposing a similar high-powered committee to look at an inquiry committee of sorts to look at what the issues were. What is the way forward? Are we looking at more and more committees, more and more recommendations, more and more paperwork? Is the solution not known to those who are already in those positions of power?
Solution. You have now pointed out very important thing, solution. what I have been looking for the last from the last protest. I would definitely agree with Mr. Azad that blaming police or governance is very easy, but it is an SOP. Why the protests are happening? Protests are happening because students want their career, their future. So the solution is, my solution, what I'm going to explain, can be looking weird, but I have many debates I have put forth this solution. First thing, education must be reformed. It is not political, it is educational. It is education, it is future. It is future of India, future of nation. Number two, educationists and all parties, intellectuals, they must come together. Consider this as a national threat. Consider this as a kind of war, as a kind of pandemic. It is educational reforms time. Gen Z requires educational reform. Gen Z is what? Digital generation that has followers, and they are following also. So they can easily be distracted and easily be directed also. So the education system can be recreated, can be restructured once all parties, they put their personal agendas aside, their political agenda aside, they come together for building a good nation. They can nominate intellectuals. Each party has intellectuals, and they can create. And like Mr. Azad said, these students, they require counselings, they require stout examination process, but from directly from the root, from studying process also, from coaching process also. Education syllabuses can be made in a manner so the students can find career in them, they can find skills in them.
So an overhaul of the education system is what Dr. Sharma is saying.
Come together. It is not taking the resigns
Hoping for support, of course, from all quarters. Whether or not that materializes, we're yet to see. But Mr. Azad, let me come to you. From an operational standpoint, when it comes to dealing with paper leakage,
UPSC is a set pattern. So this can be like
yes, Dr. Sharma, I'll just come back to you in a moment. But from an operational perspective, Mr. Azad, if I want to get your perspective, we spoke to Professor Kamakoti. He's a part of that high-level committee that has been now formed under Nandan Nilekani. One of the concerns that he'd raised is that no amount of technology will make up for a fraudulent question paper setter. Is this an unsolvable problem from an operational standpoint when it comes to deploying examinations at a scale of lakhs and lakhs of aspirants?
No, there is a problem. There's no doubt about it. But as Dr. Sharma rightly says, if you take it as a national challenge, then you can overcome it. Look at in China, what happens? You have crores people giving exam at one time, but you can do it. So that's why I'm saying, and another point which you said earlier was very, very important, that isn't it that the people who are there are aware of what are the problems and where are the gaps? Of course they know. You think the state PSC, which reeks of corruption almost everywhere, they don't know where exactly the solution lies? You know what the real problem is? The real problem is that people who don't get into the competitive exams at the national level and they related to big officers and to big leaders, they are the ones who are adjusted through the PSCs by corruption, by various things. And every state is suffering this rot. So the Gen Z thing is absolutely correct, which is happening. My first, solution is give it back to the educationists like Dr. Sharma. They are the experts. They know how to conduct exams. Take it out of the bureaucracy and give the educationists a free hand, and then give them bureaucrats and policemen under them, that how we will implement the issue. This is because making another committee, you had a committee in 2004, it was as competent. There's another committee in 2026. What is it going to do? Nothing. The most important problem, which Dr. Sharma said, is the coaching mafia. The most important problem is the schools are without toilets. The most important problems are that the teachers don't teach in schools. And the most important, what he said, was framing a syllabus which gives you jobs, not slogans. These are the important things which need to be done. But for that, the CMs will have to act and govern. Then only it will come about.
Right. That, in fact, was in fact the very same recommendation that Anil Swarup, former Education Secretary, who joined us a while back, had also given, that we need to give the education system back to the hands of the educationists. But speaking of education, Dr. Sharma, let me come to you for one final question. In the near term, as far as resolving this issue is concerned, what Mr. Anil Swarup had recommended was greater decentralization rather than centralization of decision-making when it comes to such competitive examinations. Is that the way forward? That when it comes to these examinations, trust the states to actually have their systems in place for deploying these mechanisms, or will that only lead to more corruption, breed more corruption?
Actually, this is a tree of problems. And there are many branches we can see as a problem. And paper leaks. It is one of the problems, one of the symptoms. So this time they are dealing with this thing only. But there are root causes. They are right from the schooling. Mr. Azad said right. Teaching system. Teachers must be competent to teach in a manner so that the students can enjoy the studies as well as they can find out the careers in them. Second thing, in very simple manner, only 4 things as a career we do have. If I am a student, only 4 things: government job, private job, business, and self-employment. Right? So our education system must be made in a manner so that out of the 4s, they teach all the 4s, like in China, in Japan. So we can copy. Protest is, most protests are political. Most protests are taken over by the politics. Very, very genuine students are, encapsulated, hidden inside. They don't know what to speak. Yeah, they're just studying right now also.
Dr.
So as Azad sir said, as you say, education system must be a common problem, not a political one. Number one. Education problem
back to the hands
must
of
be
the educationists is what many of us, many of our panelists have been saying.
Yes.
As a national challenge, take it up on a national challenge and give it back in the hands of educationists. I guess that's the common consensus that we've managed to find as far as this panel is concerned. Mr. Azad, Dr. Sharma, thank you so much for joining us with your perspective. On that note, it's time for slipping into a very short break. But don't go anywhere. Coming up next, the Parliamentary Standing Committee on Healthcare has proposed to impose a limit on private hospital room rates and standardized costs for surgeries and other procedures. More on that on the other side. Welcome back to News Centre. Now, a parliamentary standing committee on healthcare has recommended capping and standardising the cost of essential treatments, diagnostics and routine procedures at private hospitals. Now, the panel has also called for a review of the existing foreign direct investment framework in the private healthcare sector. Ekta Batra now joins us. Ekta, take us through the key recommendations and what the likely impact could be if these suggestions, if these recommendations are considered and then taken up.
A parliamentary standing committee on health and family welfare has just tabled a report covering hospital pricing, insurance, diagnostics, medicines, and critically, foreign investment in hospitals. Let's start with the affordability gap driving all of this. Average hospitalization cost is around 6,631 rupees in a government hospital versus 50,508 rupees in a private one, more than 7 times higher. For childbirth, for example, it's around 2,300 odd rupees versus over 37,000 odd rupees in a private setup. Government health spending sits at just 1.43% of GDP, and the committee wants that pushed all the way to 5% of GDP over the next 5 years. Now, one of the observations that should possibly worry investors: foreign investment in hospital ownership. The committee flagged FDI often exceeding 51% in hospital operational management, arguing it's enabling the monopolistic acquisition of mid-size hospitals by large corporates, calling the transformation of healthcare into a purely capitalistic enterprise. It asks to review and rationalize FDI limits specifically for hospital acquisition from what it calls predatory corporate buyouts. For a sector riding a wave of private equity-backed roll-ups, think Manipal, Aster, and most recently Medicover, that's possibly a flashpoint. Now on pricing, the committee recommends an immediate mechanism to standardize and cap the cost of essential treatments, diagnostics, and routine procedures across private hospitals. It wants a framework to standardize rates for common procedures and diagnostic tests, backed by audits. And a strikingly specific detail: hospital room rate charges should not exceed the average room tariff of a 3-star hotel in the hospital's immediate vicinity. It is also recommending a national mechanism to cap essential procedures and diagnostics and wants hospital billing systems linked directly to these approved rate schedules, so bills are auto-generated and can't be manipulated. The logic: published price, standard package, transparent bill, effectively creating a de facto cost cap. The committee also recommends incentivizing hospitals that earmark at least 20% of their bed capacity for highly subsidized or free treatment, tying government concessions directly to how much affordable care a hospital actually delivers. And on diagnostics, the committee wants public-private partnership for high-cost scans like MRI and CT at capped rates, plus shared resource networks for expensive equipment. For cancer care specifically, it wants ceiling prices on PET-CT, MRI, and genetic profiling. On insurance, the committee flags over 40 crore Indians as the missing middle, too well off for free schemes, unable to afford full private insurance. Its fix: a standardized contributory product priced at around 4,000 to 6,000 rupees a family annually, with OPD coverage plus health savings account, with employers possibly contributing 100 to 200 rupees a month per worker for informal and gig workers. The bottom line: this report pulls in 2 directions. At once, more insurance, more government spending, greater utilization on one side, price caps, room rate benchmarks, billing transparency, and FDI scrutiny on the others. These are recommendations, but the noise of private hospital regulation in some form is getting louder, and if even part of this framework lands, it could possibly reshape the economics of Indian healthcare, from the hospital bed to possibly even who's allowed to own it.
Right, Ekta, thanks a lot for that. Now, logistics major Porter is betting big on the EV transition. Speaking to CNBC TV 18's Shivani Bazar's CEO Uttam Digga said that the company currently has 50,000 electric vehicles in its fleet, which it expects to grow by about 8 times in the next 5 years. However, the logistics player cautioned that fuel economics alone is not enough to drive faster EV adoption, especially for heavier vehicles.
For two-wheeler and three-wheeler, where I think the price difference between ICE and EV vehicle is fairly now normalized. I think it has started making a dent. I think it's far more better. Even in cities like Delhi, where you have this no entry permission advantage, I think EV make far more than an ICE vehicle. So I think it depends on these. Category to category, the answer might differ. For bigger vehicles, I think it's still early. Hopefully, in next couple of years, we would be there.
From a fuel economy point of view, does it make the entire transaction more profitable? One is that. Second, you know that EV transition is also facing challenges because of the infrastructure. Would you say that is the biggest challenge right now?
So I think, answering your first question, fuel price, has it been a push for adoption? I feel yes. I think there has been, because of increasing fuel price and the outlook on the fuel price, I think there has been a push. But still, I think the biggest, when you look at owner come driver, the biggest hesitation is that, is it worth my life saving of 5 lakh rupees, 6 lakh rupees to put it in a vehicle where financing is a challenge, resale value is a challenge, infrastructure is a challenge, and so on and so forth. So I think that hesitation is still there. We've seen that Delhi has been one of the markets where I think these challenges have died down over the last 2 or 3 years. But in other markets, these are still a real challenge. Now, coming to the ecosystem, again, I think the government needs to take some initiatives. Us as a company, the entire ecosystem need to take some initiatives. And I think bit by bit, I think everybody is doing their bit. And we have made that journey in three-wheeler. Hopefully, in next couple of years, for heavier vehicles with the right policy initiative and corporate initiative, I think that journey would be done.
So we can say that Porter will go big on EVs from here on.
We are planning to, so today we would have 50,000 vehicles in EV, one of the biggest fleet in the country, and 10,000 vehicles just in Delhi. I think this is expected to grow close to 8 to 10x in next 5 years. So I think that's how big we want to go in EV.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Parliamentary Standing Committee on Health and Family Welfare has just tabled a report covering hospital pricing, insurance, diagnostics, medicines, and critically, foreign investment in hospitals. Let's start with the affordability gap driving all of this. Average hospitalization cost is around 6,631 rupees in a government hospital versus 50,508 rupees in a private one, more than 7 times higher. For childbirth, for example, it's around 2,300 odd rupees versus over 37,000 odd rupees in a private setup. Government health spending sits at just 1.43% of GDP, and the committee wants that pushed all the way to 5% of GDP over the next 5 years. Now, one of the observations that should possibly worry investors: foreign investment in hospital ownership. The committee flagged FDI often exceeding 51% in hospital operational management, arguing it's enabling the monopolistic acquisition of mid-sized hospitals by large corporates, calling the transformation of healthcare into a purely capitalistic enterprise. It asks to review and rationalize FDI limits specifically for hospital acquisition from what it calls predatory corporate buyouts. For a sector riding a wave of private equity-backed roll-ups, think Manipal, Aster, and most recently Medicover, that's possibly a flashpoint. Now on pricing, the committee recommends an immediate mechanism to standardize and cap the cost of essential treatments, diagnostics, and routine procedures across private hospitals. It wants a framework to standardize rates for common procedures and diagnostic tests, backed by audits. And a strikingly specific detail: hospital room rate charges should not exceed the average room tariff of a 3-star hotel in the hospital's immediate vicinity. It is also recommending a national mechanism to cap essential procedures and diagnostics and wants hospital billing systems linked directly to these approved rate schedules, so bills are auto-generated and can't be manipulated. The logic: published price, standard package, transparent bill, effectively creating a de facto cost cap. The committee also recommends incentivizing hospitals that earmark at least 20% of their bed capacity for highly subsidized or free treatment, tying government concessions directly to how much affordable care a hospital actually delivers. And on diagnostics, the committee wants public-private partnership for high-cost scans like MRI and CT at capped rates, plus shared resource networks for expensive equipment. For cancer care specifically, it wants ceiling prices on PET CT, MRI, and genetic profiling. On insurance, the committee flags over 40 crore Indians as the missing middle, too well off for free schemes, unable to afford full private insurance. Its fix: a standardized contributory product priced at around 4,000 to 6,000 rupees a family annually, with OPD coverage plus health savings account, with employers possibly contributing 100 to 200 rupees a month per worker for informal and gig workers. The bottom line: this report pulls in 2 directions. At once, more insurance, more government spending, greater utilization on one side, price caps, room rate benchmarks, billing transparency, and FDI scrutiny on the others. These are recommendations, but the noise of private hospital regulation in some form is getting louder, and if even part of this framework lands, it could possibly reshape the economics of Indian healthcare, from the hospital bed to possibly even who's allowed to own it. To talk more about this, we have with us Ankit Thakkar, who's the CEO of Jupiter Lifeline Hospitals, and Rahul Guha, MD and CEO of Thyrocare. Ankit, hi, welcome to the show. Well, it seems as though the news never stops within the entire hospital and healthcare space. But this particular report, according to you, what are your initial thoughts after reading or going through a summary of it?
Well, hi, Ekta. Good afternoon. So I think a lot of positives in the parliamentary report on healthcare. It talks about addressing the missing middle, as they define it in the extensive report that they have laid out. The committee talks about the bottom 50% of the most economically vulnerable population being covered by Ayushman Bharat scheme, and then the balance 20 more percent being covered either by private insurance or by senior schemes or CGHS schemes. And they talk about the 30% missing middle, which are today neither covered by health insurance nor by government schemes. And they are trying to address the affordability gap for this 30% of the population. And they have laid out significant processes on how they would like to see insurance get more affordable. They have laid out significant steps and recommendations on how GST rationalization needs to come in to make potentially GST as healthcare as zero rated in order to allow input tax credit, lowering customs duties, and a lot of those things. So I think it is a very encouraging report from the committee.
Okay. Well, Ankit, on that particular point with regards to insurance, and there's a lot more to discuss, but since you brought that up and this missing middle when it comes to insurance, the committee wants insurance to going forward to cover this missing middle by around 4,000 to 6,000 rupees in terms of a new insurance product, which will cover OPD diagnostics and maybe to some extent chronic disease management. Do you think that's feasible considering the kind of costing and out-of-pocket expenditure as of now?
Absolutely. I think it is 100% feasible. Even today, insurance in India is amongst the cheapest in the world. And we talk about 30%, but if it is 30% on India's population base, you're talking about, about 40 crore people getting into the insurance scheme. Once the denominator becomes so large, the risk naturally gets divided, and without too much effort, either on the regulator side or the government side, just free market itself will ensure that the pricing of insurance goes down significantly.
Okay, well, the crux of the report and the introduction is this huge difference which is between public and private healthcare. In fact, the committee points to a 7x difference between what we spend in a private hospital vis-a-vis what we spend in a government hospital. Childbirth is around 2,300 odd rupees as compared to 37,600 rupees plus in a private hospital. From a hospital operator's perspective, a private hospital operator's perspective, why is there such a huge gap, Ankit?
No, so I think there is no conflict in this data. The difference that you're pointing out is about how much the patient pays out of pocket. This number and this statistic does not take into account the cost. The cost of government healthcare is paid by the larger taxpayer ecosystem and not directly passed on to the patient. So that is a welfare scheme that the government is running, and that does not truly reflect the cost of providing those services. So in that sense, it is, the payer for the healthcare received by a patient in a government healthcare is different from the receiver itself.
Okay, but how much room do you think there is, Ankit, in terms of hospitals to actually reduce costs without compromising on quality?
Well, I think today, if you look at the healthcare costs in India, and I would request you not to look at the developed economies of Western Europe or the United States, but to compare the cost of healthcare in India from some of the poorest nations in the world, maybe sub-Saharan Africa. And you will find that the cost of healthcare in India is probably 2 to 3 times lower than some of the sub-Saharan African countries. And in terms of quality, I think we compete with amongst the best that you can get anywhere in the world. So even today, like for like, we are probably the cheapest healthcare ecosystem in the world and amongst the finest quality. So, I don't think that we have too much ground to cover in terms of improvement there.
Okay. Well, Rahul Guha, the MD and CEO of Thyrocare, also joins in to discuss this report. Well, Rahul, just wanted your initial thoughts in terms of the crux and the key takeaways of this report.
Sure, Ekta, good afternoon. And I think overall, the recommendation to increase healthcare spending for all of us in the healthcare sector, it's a absolute welcome move, particularly the emphasis on preventive testing and diagnostics, I think is a very important step overall, and I fully agree with the recommendations. If you look at it, a 500 rupee lipid profile test and 100 rupee or maybe 300 rupees a month lipid or cholesterol medication can actually prevent a 5 lakh to 10 lakh heart attack, as you get older. And I think the committee has really understood the need for preventive testing as a panacea for the exploding healthcare costs that would happen if, some of these diseases remain untreated into your 50s and 60s. So I definitely think a lot of the recommendations are spot on and on the right track.
But Rahul, there is this fear of capping diagnostic test prices as well. We've heard of that take place before as well. We've heard that maybe that could be in the offing. But do you think that that's a realistic recommendation based on what exactly diagnostic tests cost today?
I think, as Ankit said earlier, I think if you look at healthcare in India, and even if you look at diagnostics in India, we're probably already at the lowest cost in the world with the best service levels and convenience, right? You can order a diagnostic test within an hour and get your report within, I think, 6 to 8 hours on the same day. That's practically unheard of in any developed market at their prices. And to imagine that can happen at a 1,000 rupee price point in India, I think it's already, from an affordability and accessibility point of view, diagnostics is already there. So I don't think, yes, a price cap can come to help standardize the pricing, but I think it's already at a very affordable level today.
But what would that do to quality?
On the quality front, I definitely think, more expansion of NABL, encouragement of labs. Only 2% of India's labs are NABL accredited. And I think as more and more come under the quality ambit under NABL, and it's a fine organization with fantastic standards, right? And I think if the industry embraces that with open arms, I think the quality issue will be set at rest.
Okay. All right. Well, Ankit, I wanted to bring up one particular thing which stands out and is in focus in the past couple of years, especially since the pandemic, is the FDI inflow that hospitals have seen. The committee has specifically raised concerns about foreign investment exceeding 51% in hospital ownership. They've encouraged it in other sectors such as, say, medical devices, etc. But it's hospital ownership where they say that, it is fears of it becoming monopolistic at this point in time and capitalistic as well. And it should be a public enterprise to a certain extent. What are your thoughts with regards to this?
Well, I think I would probably steer clear of the assumption or making the leap that they want it to be a public enterprise. I think I don't recall looking at that kind of recommendation. On the contrary, all forums, including the current parliamentary panel, has been quite categorical in acknowledging that private sector has a very strong role to play in India's healthcare. As far as specifically FDI is concerned, I think these are more geopolitical questions rather than healthcare questions. And I don't consider myself to be an expert in that realm.
Okay, I understand that. But, you've seen the industry evolve, Ankit, in the past 5 to 6 odd years. What has private equity money done to hospitals? Has it improved and standardized operations? But has it also possibly removed the care which patients possibly want and have a need for?
Well, so firsthand, as far as Jupiter is concerned, we never had any private equity on our cap table, so I don't have personal experience. But I think they have played a significant role in terms of expanding access in the country. That is what I can say from the ring side. With much more capital that has become available for healthcare, what used to be a very slow growing sector is today growing much faster. And I think on the whole, it is solving the problem of access as far as the country is concerned. We really are suffering from a huge supply-demand gap. We need to build a lot more hospitals than what exists today. And in that sense, I think private equity is solving the capital gap need.
Okay, all right, Ankit as well as Rahul. We need to take a short break, but before we do that, the management of healthcare global, in fact, believes that a cap on room rent is a step in the right direction. Here's a word from the ED and CEO, Manish Mattu. We'll take a break and be back.
See, over the last few years, we have seen the laddering between room categories has come down, and there's not a big differentiator between, say, a double twin sharing and a private room. But however, of course, it does exist. But I'm sure there will be a way to navigate this as well. I mean, we've navigated many things in the past, overall as an industry and healthcare global in particular, and this should also be manageable in the foreseeable future if this were to be a reality. I mean, the committee must have given it some thought. I mean, personally may or may not agree with it, but let's see. I mean, I'm not even let me see what the content of that recommendation is, and before I can comment on. All I can say right now is that whatever the regulations be, we will, Healthcare Global will comply with all of them. And I'm sure the rest of the industry too. I don't think there are any clues about. And I think it's a step in the right direction overall, because I think the larger goal of the industry also should be to balance profitability with social good. And I think the industry has done quite a bit in the last couple of years, and there's no reason why we shouldn't continue to move forward with the government on this.
Welcome back. Well, we still have with us Ankit Thakkar, the CEO of Jupiter Lifeline Hospitals, and Rahul Guva, the MD and CEO of Thyrocare. Well, Ankit, you know, we were just conversing about what exactly your thoughts are with regards to the private equity money which has come into the entire hospital space. Well, on one end, one can, you know, argue about the commoditization of healthcare. But would there then be a fear that if in case there is ever any kind of cap that comes through when it comes to FDI in hospitals, there could be a slowing down on expansion when it comes to tier 2, tier 3 cities? That's really where the bed capacity is needed.
So I think, there is multiple things fueling the growth cycle. One is, of course, the private equity money that is coming in now. Two, along with that happening, the balance sheets of a lot of hospital groups are getting strengthened inherently. Three, with the growing penetration of insurance, the way it is anyway, combined with some of the government schemes, and now hopefully when the government is talking about addressing the missing middle, with more and more people coming under the insurance ambit, insurance becoming more prevalent, more affordable. All of these things will take away the affordability question out of healthcare. And once that happens, the supply will naturally catch up.
Okay, well, the supply will naturally catch up according to you. But, you know, one big part of the standing or the parliamentary committee recommendations is basically standardization of hospital rates, standardizing packages, transparent schedule of charges, and potentially a cap on essential procedures as well. How exactly would this change the way hospitals price treatment today? And do you think that this is feasible?
To begin with, all for transparency. I think it's extremely important and vital in everything that we do, much more so in healthcare. As far as standardization is concerned, there are just so many variabilities in healthcare that for practical purposes, it is not a very clean service, so to say, which means you can't really have very specific definitions and inclusions and exclusions. So very clean standardization, neat structures are not very probable as far as healthcare is concerned. However, rationalization is necessary. I have also in our previous interactions, told you that pricing essentially must grow only in line with inflation. And, no one should think of much faster than inflationary growth in pricing as far as healthcare is concerned. So in that sense, rationalization, of course, is necessary and advocated. But a clean, structured standardization in healthcare is a little difficult to achieve.
Do you think that the standardization would then be geographically different? Do you think that it would differ for, say, a tier 2 town versus, say, a tier 1 city like Mumbai? Or do you think that it's so difficult that within the city of Mumbai also, within a particular city, there are different geographies and hence the pricing cannot be standardized at all?
So all the things that you pointed out and more, for example, difference between, different towns and cities, difference between geographies within one city, difference between the quality of facility within the same geography. There are a small 5 or 10 or 20 bed nursing homes which also offer some medical services which are offered by larger providers with much more complex technology. And finally, there is a variability from patient to patient, different comorbidities, different disease conditions and presentations. So there are just too many variabilities which make a clean standardization, as I was saying, a little difficult to achieve.
Okay. The report also talks about, hospital billing systems which are linked to approved tariffs. So basically the bill is automatically generated. It's not, it cannot be manipulated. And what you see in terms of the standardized rates is basically what you get at the end of it. And there's no surprise at the end of it. Do you think that at least that is feasible? Because that is the key complaint that patients have, that I was expecting certain charges, and then, I added on and my bill was 2x of what my expectation was. Do you think that this will possibly bridge that uncertainty and that gap, which is much needed?
Yeah, 100%. And I think to a large extent, as far as the organized providers are concerned, it is a reality even today. Because when you're operating healthcare at scale, you don't really have the bandwidth to, manipulate each bill on a patient-to-patient and line item-to-line item basis. So, as you said, all the services have predefined tariffs, which are also agreed with the insurance payers, and there is very little probability of variability on that account. So that is standardized even as we speak today, as far as most of the large providers are concerned.
Okay, 20% cap on beds, that's also been spoken about, and that is something that we've heard in terms of rumors before as well. Do you think that that would be feasible? Would it be something that even Jupiter would be ready to implement?
Yeah, so even today, one of the other things which the parliamentary panel specifically called out is that healthcare today operates in a free market kind of ecosystem where market forces essentially determine most of the pricing that prevails. So, which is a fact, even as far as Jupiter is concerned, the pricing autonomy does not really lie truly with the provider, but it is pretty much linked with the market forces that we operate in. So in that sense, even today, the pricing of beds and all other services is capped by various factors and stakeholders in the economy that we operate, including the insurance companies, including the regulators, including the competitive landscape where we are. So we are fully for that.
Okay, all right. Well, Ankit, it's been a pleasure speaking with you. Thanks very much for joining in and giving us all of that perspective. That's all the time that we have on the show. Thank you very much for watching this special.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Hopes fade for a deal between the US and Iran. President Trump demands Tehran pay compensation for people killed in wars, attacks and protests. Iran's new leader, Supreme Leader, announces several new key appointments, names a former wartime commander and veteran political insider to head the nation's highest security body. Crude oil prices near the $90 mark. Sensex and Nifty decline after a range-bound session. Mid-caps outperform but end with marginal losses. Rupee weakens by nearly 15 paisa against the dollar. Equity mutual funds record inflows for the 65th month in a row, but large-cap funds see outflows for the first time in nearly 3 years. Flows into mid-caps and SIPs remain stable. A US judge approves the Justice Department's request to drop criminal charges against business tycoon Gautam Adani and others in an alleged bribery and fraud case. Judge finds irregularities in the decision to dismiss the indictment and terms the conduct of a senior Justice Department official as highly unusual. Gautam Adani welcomes the verdict. Wall Street's largest banks and investors bet big on Nvidia. The AI giant signs a memorandum of understanding with Goldman Sachs, BlackRock, Blackstone and others to mobilize over $500 billion to fund its infra build-out. CEO Jensen Huang tells CNBC this is the first time chips have become an investable asset class. Parliamentary Standing Committee on Healthcare proposes to impose a limit on private hospital room rates and standardized costs for surgeries and other procedures. Also proposes to review and rationalize limits of foreign direct investment. Says FDI is enabling monopolization, acquisition of mid-sized hospitals by large corporates. Deadlock continues in Parliament with just 2 days left in the monsoon session. Lok Sabha passes the bill to rename Kerala as Keralam amid sloganeering by opposition. Home Minister Amit Shah not present in Parliament today. Government has said the Home Minister will make a statement on the Jantar Mantar crackdown if the opposition does not disrupt the House. No let-up in the student protests in Jharkhand. A day after the police crackdown, more than 100 ABP workers detained after attempting to march to the assembly. The state assembly is adjourned 1 day ahead of schedule. Government extends the incentive scheme for electric two-wheelers till March 2028, but halves the subsidy to 5,000 rupees for each vehicle. Only two-wheelers that cost less than 1.5 lakh rupees are eligible for the incentives. And rescue workers combed through the debris in Colombia after a powerful earthquake jolts Cali and dozens of cities and towns. At least 132 people killed and thousands are missing after what is the worst earthquake in 10 years. All right, the top story this evening, negotiations between the US and Iran through mediators continues as both sides demand compensation for damages in the conflict. Here are the latest developments. Now, US President Donald Trump has demanded compensation from Iran, countering Tehran's ask of reparations from Washington. Speaking to reporters at the Oval Office, President Trump said, and I quote, "We are going to ask for money for the damage they've done over a 50-year period," end of quote. He also claimed that the US naval blockade is a steel wall and that US is letting ships transit but is not letting them go to Iran. Iran said that the US had asked for negotiations just 20 days after Trump demanded unconditional surrender at the start of the conflict. According to Iranian state media, Iran's foreign minister Arakchi said that Tehran has shown the world that it is a tough and invincible power. Iranian Supreme Leader Mojtaba Khamenei announced a series of new appointments across the army establishment and the Revolutionary Guards. Khamenei has named Mohsen Raza as the Supreme Leader's military advisor. Oil markets continue to remain on edge. Brent crude prices hovered near the $90 per barrel mark as traffic in the strait remains constrained. The UK military flagged report of an incident involving a tanker and military forces in the Gulf of Oman. More details are still awaited. Here's US President Trump on talks with Iran and the situation at the strait.
They asked for reparations, you might say, or they asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period. Whether you go SS Cole or whether you go all of the people that were so badly hurt, so badly wounded or killed, many thousands of people, and maybe damages for the 52,000 protesters over the last 4 months that were killed in Iran. We think their families should get damages for killing their person or their child or mother, father.
Russia launched another large-scale attack on Ukraine, killing 6 people. Ukrainian President Zelensky said that North Korean missiles were used in the attack that was calculated to inflict maximum damage. Russia says it attacked military-related transport and logistics centers in Kiev. Ukrainian forces also launched drones towards Russia, with 1 person reportedly killed in the western part of the country. Now, freight costs are increasing for Indian exporters, with rates on the US, Europe and other Western routes surging nearly 4 times in just a couple of months. Exporters are now paying over $9,000 per container, compared with around $3,000 earlier. Industry experts said congestion at ports is delaying vessel availability and multiple blank sailings are disrupting schedules. Strong festive season demand is further intensifying the issue, giving shipping lines room to charge premium rates. The Wall Street ended a range-bound session in the red. The Nifty closed below the 24,500 mark, while the Sensex shed nearly 400 points. The Nifty Bank also ended about 0.5% lower, in line with the benchmarks. The mid-cap index, however, outperformed and closed flat for the day. All right, a quick look at money markets. The rupee weakened for a second straight day, touching its lowest level in 2 weeks as oil prices also rose. However, RBI intervention kept the fall. A mutual fund flow data for July is out. Equity mutual funds recorded net inflows for the 65th month in a row. However, large cap funds recorded their first net outflows in almost 3 years. Vinny Motiwala joins us with the key trends from the data. Vinny, please take us through the numbers.
Thanks so much for that. So let's talk about the big picture. Equity fund inflows that have come in this time. Yes, a slight bit of a moderation versus the month of June. It is down 15%, but the trend shows a clear preference that's coming and a shift coming in, chasing more growth and more mid and small cap, more flexibility is what the investors are chasing versus a large cap. So now let's start with the large cap. What happened on the large cap category fund? When you talk about it, the category saw a reversal. There was an outflow this time in terms of large cap funds. 1,321 crores was the outflow. So this is the first time since December 2023 that we're seeing an outflow coming in for large cap funds, suggesting investors are currently leaning more towards the categories that are giving greater flexibility and better growth, and sticking to those categories versus the large cap. So now let's talk about the categories that are stealing the story this time, and that's the mid and small cap funds. Mid cap funds, they have managed to be stable. 6,192 crores is what their inflows came in at, up 2% versus last month, holding steady there. Small caps, that's the story, right? 7,767 crores in terms of inflows. This is the best inflows in almost 2 years that one has seen coming in, at least for the small cap category. Trend surely indicating that investors are still confident on this category in terms of encouraging trends and allocation in terms of money more going towards the mid and small cap. Flexi cap funds is another category that is also a beneficiary and has continued to see that up move in the last few months as well. Even this time, they managed to see inflows of 4,790 crores. Now, let's move on and talk about another preference that is coming in from investors. That's going to be in terms of the sectoral and thematic funds. 1,328 crores is what they've garnered this time in terms of sector funds, a bit lower but still stable versus what we've seen coming in the last few months. Apart from that, new fund offerings that have been quite exciting. A lot of new launches have come in, 25 new funds, 2,022 crores is what the new offering inflows have come in for the month of July. SIP contribution stable at 31,961 crore for this month as well. Hybrid also has seen a good inflow, lower than June, but still stable over there. So all in all, positive territory performance that is coming from most of the funds. Large cap is a bit of a miss.
All right, thank you, Vinny, for that. Now, dairy products company Milky Mist IPO was subscribed 67% as of 4 p.m. The subscription was led by employees, followed by retail investors and non-institutional investors. The company has a fixed price band of 133 to 140 rupees a share for public offer of 1,553 crore rupees. The share sale will conclude by August 13th and will be the largest IPO by a dairy company in the country. And in what comes as a big relief for business tycoon Gautam Adani and his nephew Sagar Adani, a US judge has dismissed charges of conspiracy, securities and wire fraud against them. However, the judge found irregularities in the decision to dismiss the indictment and termed the conduct of a senior Justice Department official as highly unusual. Hormaz Fatakia joins us now. Hormaz, please take us through what transpired.
A big relief coming in indeed for Gautam Adani and his nephew Sagar Adani, because the US District Judge Nicholas Garofis, he has dismissed the conspiracy, securities and wire fraud charges that were against both the Adani Group chairman and his nephew, and these pertain to allegations with regards to them paying bribes worth close to $250 million to Indian government officials for securing solar energy contracts, charges that the Adani Group has been denying all through and through. And it was this case that led to that indictment that took place towards the final days of the Biden administration, towards the later half of 2024. Now, the process to resolve this issue was ongoing all through the year, because just a couple of months earlier, Adani Enterprises also paid $275 million to settle the Office of Foreign Assets Control, or the OFAC probe that falls under the US Treasury Department. And the group also settled in with the US SEC, the Securities Exchange Commission, in May, when both Gautam Adani and Sagar Adani together paid around $18 million to settle the issue, which pertained to misleading statements with regards to a 2021 bond issuance. Now, with regards to this, JP Morgan says that they are continuing to remain positive on the entire Adani Group complex. They say that this is a positive for sentiments across the group. They're saying that they've already demonstrated enough and more diversified funding sources, and now with a complete resolution, that avenues may increase even further, and that could also possibly lead to a US dollar bond issuance in the future. What JP Morgan is also saying is that the group is likely to step up capex and pursue M&A across their companies, and therefore they continue to remain overweight across the entire group companies. Although there were no significant price action seen among the Adani Group stocks, because these stocks have run up considerably in anticipation of this, and whatever they had lost right from the start of the first phase of Hindenburg, they've recovered all of those losses and a lot more.
All right, thank you, Harmaz, for that. Government has extended the incentive scheme for electric two-wheelers till March 2028. But the subsidy has been halved to 5,000 rupees for each vehicle. Only two-wheelers that cost less than 1.5 lakh rupees are eligible for the incentives. The terminal date for all segments under the scheme is March 31st, 2028. Now, shares of Vedanta fell in trade after sources indicated that the promoters may buy and sell stakes in its group companies. Shares of Vedanta and Vedanta Aluminium may be pledged or sold by promoters and are looking to raise up to 3,000 crore rupees. Remember, SEBI allows equity purchase of up to 5% a year via the creeping acquisition route. Now, deadlock continues in Parliament with just 2 days left in the monsoon session. Lok Sabha passes the bill to rename Kerala as Keralam amid sloganeering by opposition. Home Minister Amit Shah was not present in Parliament today, and the government said he will make a statement on the Jantar Mantar crackdown if the opposition doesn't disrupt the House. The President has also given assent to Vande Mataram bill, granting the song same legal protection as national anthem. A parliamentary standing committee on healthcare has recommended capping and standardizing the cost of essential treatments, diagnostics and routine procedures at private hospitals. The panel has also called for a review of the existing foreign direct investment framework in the private healthcare sector. Ekta Batra joins us now. Ekta, please take us through the key recommendations.
Let's start with the affordability gap driving all of this. Average hospitalization cost is around 6,631 rupees in a government hospital versus 50,508 rupees in a private one, more than 7 times higher. For childbirth, for example, it's around 2,300 odd rupees versus over 37,000 odd rupees in a private setup. Government health spending sits at just 1.43% of GDP, and the committee wants that pushed all the way to 5% of GDP over the next 5 years. Now, one of the observations that should possibly worry investors: foreign investment in hospital ownership. The committee flagged FDI often exceeding 51% in hospital operational management, arguing it's enabling the monopolistic acquisition of mid-size hospitals by large corporates, calling the transformation of healthcare into a purely capitalistic enterprise. It asks to review and rationalize FDI limits specifically for hospital acquisition from what it calls predatory corporate buyouts. For a sector riding a wave of private equity-backed roll-ups, think Manipal, Aster and most recently Medicover, that's possibly a flashpoint. Now on pricing, the committee recommends an immediate mechanism to standardize and cap the cost of essential treatments, diagnostics and routine procedures across private hospitals. It wants a framework to standardize rates for common procedures and diagnostic tests, backed by audits. And a strikingly specific detail: hospital room rate charges should not exceed the average room tariff of a 3-star hotel in the hospital's immediate vicinity. It is also recommending a national mechanism to cap essential procedures and diagnostics and wants hospital billing systems linked directly to these approved rate schedules, so bills are auto-generated and can't be manipulated. The logic: published price, standard package, transparent bill, effectively creating a de facto cost cap. The committee also recommends incentivizing hospitals that earmark at least 20% of their bed capacity for highly subsidized or free treatment, tying government concessions directly to how much affordable care a hospital actually delivers.
All right, thank you, Ekta, for that. Moving on to Jharkhand now, where there's been no let-up in the student protests. A day after the police crackdown, more than 100 ABP workers detained after attempting to march to the assembly. The State Assembly is adjourned one day ahead of schedule. Chief Minister Hemant Soren said on official social media that the student protesters' demand would be taken seriously, but the students have said they will not call off their protest until the JSSC result is cancelled and a CBI probe is ordered. Right, time for a short break. Coming up next, Wall Street's largest banks and investors bet big on Nvidia. The AI giant signs an MOU with Goldman Sachs, BlackRock, Blackstone and others to mobilize over $500 billion to fund its infra build-out. More details when we return. Welcome back. You're watching Business 360. NVIDIA is trying to turn AI chips into Wall Street's newest asset class. The company has inked memorandum of understanding with Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs and KKR. The aim is to mobilize over $500 billion in third-party capital to fund data centers and NVIDIA hardware. In a rare roundtable on CNBC, NVIDIA CEO and executives from 6 companies discussed the announcement. CEO Jensen Huang said this is the first time chips have become an investable asset class.
We're announcing 6 partnerships today. These partnerships are going to pull together independent long-term capital to fund and support AI infrastructure build-out. This is an extraordinary time, as you know, because this is the first time in some 60 years that the computing industry is going through a fundamental platform shift from the way that software was done before to the way that it's going to be done in the future, called artificial intelligence. Fundamentally, what's different about this industry and this way of doing computing is that the computer is now part of the infrastructure, like electricity, like the internet. But now, NVIDIA's AI factory platform is really an investable asset.
I think one of the things Goldman Sachs brings to the table is we have an extraordinary distribution network. So we bring capital, but we also bring a very, very unique distribution network. But Jensen came, approached us with the idea, and we said, you know, we'd love to talk to you about it. We have a deep belief in the direction of travel and the opportunity set over the course of the next 3, 5, 7, 10 years.
And I applaud what NVIDIA has done, bringing all these firms together and saying, we have a common goal. We need to raise $500 billion. Obviously, that's an unprecedented amount of money, but we're going to have to raise trillions of dollars over the coming years. And I do believe this is going to be representing a fantastic investment. In fact, I think it's going to be such a large investment. Over time, you're going to see more and more allocation into this asset class.
So today at our companies, we've seen a 7-fold increase in demand for LLMs in the last 6 months. And yet the amount of compute is not keeping up. The data centers, the power, the chips. And so what you're going to see here is people are going to begin to recognize that this is a financeable asset class.
And you can catch all the roundtable action with NVIDIA CEO and all the Wall Street stalwarts at 7:30 and 9:30 p.m. right here on CNBC TV 18. Anthropic has reportedly introduced an invisible watermarking system for content generated by Claude. The watermark is designed to make AI-created text and files easier to identify without changing how they look or read. Rachna Dhanrajani has more on this and the other developments in the tech space. Rachna.
Well, first up is, of course, Anthropic now watermarking what Claude writes. Models launched from August 2 weave an invisible mark into generated text that can survive copy-pasting and some editing with signed provenance data on files. It applies worldwide, not just in Europe, but is in accordance with EU AI Act transparency rules. However, Anthropic has cautioned it is not a definitive AI detector. Then there's OpenAI that has completed roughly $7 billion employee share sale ahead of a potential listing. The valuation held is at $852 billion, which remains unchanged from their March fundraise. Now, OpenAI bought the stock back itself rather than bringing in outside investors. Then in the US, the Ninth Circuit has declined to hear a Section 230 appeal as premature, leaving thousands of addiction suits against Meta, TikTok, Snap and Google to proceed. The court did not rule on the merits of the defense. This comes almost a week after Meta was fined almost $1 billion by a Mexico court in a similar youth addiction lawsuit.
All right, thank you, Rachna, for that. Moving on to Colombia now, where a powerful earthquake has rocked the country, killing over 130 people and causing extensive damage across several cities. The epicenter was located around 400 kilometers west of the capital, Bogota. Now, the quake was felt as far away as Ecuador and Panama, though authorities there reported minimal damage. Colombian president has declared a state of national disaster and deployed soldiers to the affected regions. At least 61 buildings have collapsed and more than 1,500 homes damaged. Rescue crews were digging through rubble in Cali, where patients remain trapped under a partially collapsed hospital. 7 airports have suspended operations and hospitals, roads and telecom networks across the region have been disrupted. Colombia's geological service says it's the country's strongest earthquake this century. Now, Typhoon Dolphin has pushed deeper inland into China, prompting the closure of key tourist sites and suspension of high-risk construction projects. Beijing is expected to be hit by more than one-third of its annual rainfall over a 24-hour period. Forecasts have also warned of extreme rainfall, with flooding and landslides posing a risk across the affected areas as Chinese authorities continue to evacuate more than 1 million people. Now, Trump Media and Technology Group, which owns Truth Social, reported a wider second quarter loss. Unrealized losses tied to its cryptocurrency assets widened the net loss to $240 million from $20 million. More than 10 customers have signed up to Trump's Media's controversial service that offers faster access to market-moving posts made on its Truth Social platform. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. IoT Devices gets 15 crore rupees in a pre-series A round led by Inflexor Ventures. The medtech startup will use the funds to scale its AI-driven diagnostics platform for diabetic foot complications, expand manufacturing and grow its presence in India and global markets.
IIT Madras alumni founded Discovered Materials raises $9 million from Lightspeed, YC and Peak 15. The startup will use the funds to scale its advanced materials technology.
Slice Small Finance Bank reports net profits of 50.9 crore rupees in Q1, surpasses its entire FY26 profit of 48.4 crore rupees. The stronger quarter marks a key milestone in Slice's post-merger turnaround as it sharpens its digital banking pitch.
Wall Street's largest banks and investors bet big on Nvidia. The AI giant signs a memorandums of understanding with Goldman Sachs, BlackRock, Blackstone and others to mobilize over $500 billion to fund its infra build-out. CEO Jensen Huang tells CNBC this is the first time chips have become an investable asset class.
Anthropic has reportedly introduced an invisible watermarking system for content generated by Claude. The watermark is designed to make AI-created text and files easier to identify without changing how they look or read. Those were the headlines we've been tracking for you this evening. For India to become a sporting powerhouse, the journey has to start long before the stadium. at the grassroots. Capri Sports, part of Capri Global's Ventures portfolio, is now betting on girls football with Nova Sports, a new platform designed to take young players from grassroots participation to elite competition. Starting in Bengaluru, the ambition is to go national and reach more than 1.5 million girls over the next decade. Joining me now is Jinisha Sharma, the founder and director of Capri Sports. Jinisha, welcome to Startup Street. Now, Capri Sports already has investments across cricket, kabaddi and football. Why launch Nova Sports now, and why make girls football the starting point? What gap in the ecosystem are you trying to address, Jinisha?
Thank you for having me. So Capri Sports is entering its 5th year in the business, and every year we keep thinking about what more can we do to push our interest in women's sports forward. And if you really look at where women's sports is growing in India, it's at an inflection point. And our interest in girls football really stems from the idea that there's so much talent, there's so much interest, but the pathway is still fragmented. If you look at numbers around the female football registrations, which have grown massively over the years, if you also look at the India teams who have been, performing phenomenally across the world, football has an enormous cultural reach, and we're excited about that. But what's really missing is a consistent girls-only pathway, which is safe. There's year-round coaching, regular competition, which I think really is a huge marker of success, is that the girls need to play regularly.
Yes.
And what's going to be the next step from the first time that they have, they make contact with the ball all the way to elite performance. So, that's what we're hoping to solve with Nova.
All right. So Nova Sports is starting in Bengaluru, but the ambition, like I mentioned earlier, is to reach more than 1.5 million girls over the next decade. Jinisha, walk us through the roadmap. What age group are you targeting, and how quickly do you expand beyond Bengaluru, and what kind of investment will that require?
Sure. So we're starting in Bengaluru, that's right. We're kicking off with the Supernova Football Championship, which, soon after the championship, the Nova Football Academy will be in full swing. Bengaluru is a testing ground. I think any sport investment, that market is really primed for. So we want to validate the model before we scale it. There are some interesting markets which already have a lot of interest in sports, have a lot of participation coming in from young girls. So we're going to target that. In terms of age group, we're really looking at anywhere between 12 to 17. And we're hoping to develop more programs where we can go younger and younger. In sport, the younger you start, especially in a sport like football, the younger you start, the faster you can reach.
Jinisha, one of the biggest challenges in Indian sports is that participation at the grassroots doesn't always translate into a professional pathway. So how will Nova connect schools, academies, coaches and competition so that, talented girls don't fall out of the system? And how do you identify those who can eventually compete at the elite level?
So grassroots, if you look at it, it's not just the feeder system for elite sport. So we're ensuring that both the grassroots, which is the academy pathway, and the elite talk to each other, right? So we're building both the pathways. So we don't want to alienate any young girl who wants to just come out and try sport for the first time, try football for the first time. But at the same time, we want to encourage them to go as long as they want to. So we're, creating a system where we're building experts, we're building partnerships, including looking at global exposures. All of that is available. And we're hoping that we can take as many girls who want to go all the way, and we can be the one who do that.
Okay. So, Jinisha, let's talk about the business opportunity. Women's sport is attracting more audiences, sponsors and investors, but monetization still trails men's sport significantly. So how large do you believe that the commercial opportunity in women's sport in India can become, and what needs to change for the economics to really take off?
So the significant opportunity sits above us right now when it comes to women's sports. And, we've seen that firsthand with how WPL has been growing. We conducted some research with our partners, and the number really looks at the value of women's sports growing to $900 million by 2030, right? Which is in less than 4 years. But the point that we're trying to do with Nova, and what we really believe in, is that you can't just build a business at the top. you need a lot more younger girls who are participating. You need more competitive matches, stronger athlete stories, consistent properties. Sports as an asset class is long-term investment. You're not going to see returns such in more traditional manner.
Absolutely.
But when you, yep. But as I was saying, that as participation grows, the commercial layers are going to become much stronger when it comes to sponsorship, events, tech, media, and more sports IP. So I think in terms of, I would say participation is really where we want to build that layer. And I do think in India, what we're seeing with a lot of new formats like High Rocks, what we're seeing is it's changing from just watching sports, but actually playing and participating is becoming where value can really be driven.
But Janisha, grassroots sports programs are often dependent on sponsorships or philanthropy. You've spoken about building sustainable pathways. What is the business model for Nova Sports? Can grassroots development itself eventually become commercially sustainable?
I think so, yes. And that's what we're looking to do. It absolutely is a business for us. We are not looking at this from a philanthropic angle. In terms of participation, we want to look at scale, and that's where you can really... So sustainable commercial layers can only grow once you start to scale, which is why we have our eyes on the prize, which is to go into more cities, more sports. The segment still remains for us as focused on girls, so really creating pathways for girls specifically, which would include coaching, psychology, everything that the girl needs to really excel in sports. But the scale is going to come from us branching out into different cities and different sports.
All right. Janisha, we've completely run out of time, but many thanks for joining us here on Startup Street, and wish you the very best with Nova Sports. Thank you so much.
Thanks so much.
And moving on the hot seat, accounting has long been one of the most time-consuming and compliance-heavy functions for small businesses. But what if artificial intelligence could take over everything from bookkeeping and tax filing to financial reporting and forecasting? That's the bet Surat-based fintech startup Hisab Kitab is making. Founded by two chartered accountants, the company has now raised its seed round at a valuation of 20 crore rupees. The startup says it plans to use the fresh capital to build AI-powered finance agents and expand its reach across India and international markets. Joining us now to discuss this further is Abhinav Sharma, the co-founder and CMO of Hisab Kitab. Abhinav, thank you so much for taking time out and being here with us on Startup Street. As I said, right, you've spent years as a chartered accountant before building this company. What was the biggest pain point that you sort of experienced that convinced you accounting needed an AI-first overhaul?
So, first of all, thank you for having me. And secondly, the reason why we built this was basically we have seen a lot of manual work being happening in our domain specifically. And despite having a lot of software, a lot of technology available to the people right now, and still we CAs and businesses were falling behind in this particular segment because everyone felt accounting is a bit boring industry to have. And that's why we took some initiative and we started changing things. And first of all, we were into services. So when you do services, you go deep into businesses and you analyze like what are the processes you can actually automate. You can't learn those things from being outside or having an abstract view of the things. And that helps us to go deep into business insights at what were the problem people were actually facing and what all processes can be automated in what way. And with the advent of AI, all those things fueled us to just push things more towards automating the whole process.
Absolutely. And there are dozens of accounting platforms already in the market, right? What does your sort of AI intelligence layer do today that existing software simply can't? Take us through what it is that you have on offer.
So if you compare side by side, for right now, if you want to do a accounting statement entry of a bank, it takes, for a 10-page statement, it usually takes around 2 hours or something like that. With our AI tool, all you need to do is just upload your bank statement and the whole accounting entry gets popped up in front of you and you have to do the maker checker process. That's it. So the process which earlier used to take 2 hours, right now it's getting done in 15 minutes. That's it. And secondly, we provide the flexibility to any random businesses to adopt the accounting software as per their own needs. It's not a standard vanilla software which I'm giving for every accounting industry, because that has been norm in India, that there is a single accounting software which everyone is using as per their how the software is being meant, and not the customizations which can be happened at their own level, the flexibility which those guys can have, and the automation which can happen. So we are trying to give more into hands of people so that they can modify the systems according to their own needs. And at the same time, the automation is running parallelly, which is solving time. So if let's say earlier you have a team of 5 people doing your accounting in your company, right now you only need 3 people for that. So you're saving 2 man completely on the budget side, as well as on the CA side also, we are trying to automate a lot of compliance. So that's what helping us in changing things, which is not available right now.
All right. And you've raised this fresh round of funding at a 20 crore rupee valuation. You were bootstrapped up until now. What are the top 3 priorities for this capital over the next 18 to 24 months? And why did you feel that now was the time to raise it?
So we felt with the help of AI, a lot of processes can be automated. And right now, if we had been going with the pace which we had been before not raising the funds, it would have been a bit slow to capture the market. And we wanted to go global with this thing and not just limited to India. We are right now in India, Bhutan, and UAE. So we have plans to expand it to more GCC and MENA countries. At the same time, we want to expand the footfall locally here in India, where people should know about our company more and more, because the branding side of the things, which is what helped us. And at the same time, on the technology front, we want to introduce more finances, more cash flow predictions, more financial predictions, and all those things into our system. So basically, this fund will help us to go more deep into the marketing side of the things as well as tech. So for leading more aggressively on those fronts, that's why we decided to raise that. Right now, it's the right time to raise the funds.
Absolutely. And speaking about that, it's also important to see the kind of growth you've had, right? You've grown monthly revenues nearly 6-fold in a year. What's sort of driving that growth? Is it new customer acquisition, higher ARPU, or customers just adopting more products on the platform?
So, see, first of all, us being CA helps a lot. Our narrative has been something people are adopting very easily. That if it has been built by a CA, then definitely the accounting platform don't have those trust issues or some those things that it will be fundamentally wrong. And secondly, the second generation business owners which are coming into their first generation businesses, those guys feel a need of automating processes. So that is also helping us to push more and more technology into the traditional businesses which are there in the market. So those guys are fueling us to help, like, yes, we are ready to adopt all those things. Earlier, there was some rigidity with regards to their accounting data, but with the help of new generation, we are able to go deeper into the traditional businesses as well.
And what kind of revenues are you targeting for this year at this point in time? And are you profitable?
Yeah, not as of now, to be very honest, but we will be very soon profitable into this. And we are expecting 1 crore MRR by the end of March 2027. And by within 3 years, we'll be at 100 crore revenues.
Okay, within 3 years, you'll be at 100 crore rupee revenue. You're now building autonomous finance agents for audit, tax, reporting, and forecasting, right? How close are we to a world where AI can sort of replace a large part of an accountant's routine work?
I would say for routine work, already 60% of the things have been done. And regarding the next 40%, which is where the main brain lies, those things will take at least 1 year. But the speed of AI, the way things have been happening, it can even happen in the next 6 months. We are trying to do something in the next 6 months. If it happens, then definitely we can meet again here to discuss those things.
And, you know, you're serving over 2,700 paying businesses right now. Can you take us through what the plan is to expand your customer base and your expansion plans at this point?
Yeah, so we are trying to take the CA route, because if you'll see traditionally, business owners usually trust their CAs more, and us being CA helps us a lot. So we are trying to take that route and go deeper with the help of CAs into our industry, and our ICI body is also helping us to do that. So that is one. Secondly, the traditional model which has been forever working, the referral partner model. So we are trying to onboard distributors at various local level and then go deep into it. And third and the last, the performance marketing have been working wonders for us, where I do a founder-led videos myself, where I explain the pain points of the people right now using their old accounting software, and explaining them how you can automate your processes. So those 3 things have been fueling our development, and there has been a huge inflow of accounting inquiries from the people organically as well.
All right, Abhinav, many thanks for taking time out and being here with us on Startup Street, and we wish you all the best on this journey going forward.
Thank you so much. Thank you for having me. Yeah.
Well, with that, it's time for us to head into a short break. But coming up next, can electric vehicles scale beyond the cost advantage, especially for heavier vehicles? We check in with Porter's founder on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Logistics major Porter is betting big on the EV transition. Speaking to CNBC TV 18, Shivani Bazar, CEO Uttam Digga said the company currently has 50,000 electric vehicles in its fleet, which it expects to grow by over 8 times in the next 5 years. However, the logistics player cautioned that fuel economics alone is not enough to drive faster EV adoption, especially for heavier vehicles.
For two-wheeler and three-wheeler, where I think the price difference between ICE and EV vehicle is fairly now normalized. I think it has started making a dent. I think it's far more better, even in cities like Delhi, where you have this no entry permission advantage. I think EV make far more than an ICE vehicle. So I think it depends on these. Category to category, the answer might differ. For bigger vehicles, I think it's still early. Hopefully, in next couple of years, we would be there.
From a fuel economy point of view, does it make the entire transaction more profitable? One is that. Second, that EV transition is also facing challenges because of the infrastructure. Would you say that is the biggest challenge right now?
So I think, answering your first question, fuel price, has it been a push for adoption? I feel yes. I think there has been, because of increasing fuel price and the outlook on the fuel price, I think there has been a push. But still, I think the biggest, when you look at owner come driver, the biggest hesitation is that, is it worth my life saving of 5 lakh rupees, 6 lakh rupees to put it in a vehicle where financing is a challenge, resale value is a challenge, infrastructure is a challenge, and so on and so forth. So I think that hesitation is still there. We've seen that Delhi has been one of the markets where I think these challenges have died down over the last 2 or 3 years. But in other markets, these are still a real challenge. Now, coming to the ecosystem, again, I think the government needs to take some initiatives. Us as a company, the entire ecosystem need to take some initiatives. And I think bit by bit, I think everybody is doing their bit. And we have made that journey in three-wheeler. Hopefully, in next couple of years, for heavier vehicles with the right policy initiative and corporate initiative, I think that journey would be done.
So we can say that Porter will go big on EVs from here on.
We are planning to, so today we would have 50,000 vehicles in EV, one of the biggest fleet in the country, and 10,000 vehicles just in Delhi. I think this is expected to grow close to 8 to 10x in next 5 years. So I think that's how big we want to go in EV.
From logistics, let's move to space tech. Space tech startup Astro-based Space Technologies is targeting its first rocket launch by December 2028, powered by indigenously developed liquid oxygen, liquid methane engines. The company is aiming to eventually put 1,000 tons of payload into space every year as it looks to help close India's growing gap with the US and China in space infrastructure. Meghna Sen speaks to Astro-based Space Technologies co-founder Neeraj Khandelwal about the company's ambitions and India's space tech opportunity. Listen in.
I started thinking about building a space infra company in 2018, but the government regulations did not allow it. So in 2024, I and Dev Kumar, we both started the company, and the only reason for starting it was very simple. Today, America owns 11,000 plus satellites, China owns 1,500, and India less than 100. This needs to change, and with that objective, we have started the company. The objective of the company is to send 1,000 tons per annum to the space. And see, it's not just about satellites. I think in a couple of decades, America and other countries, I think humanity will establish its permanent base on the moon. And if we don't do that, then all the research and the technologies that come out of space exploration, we will miss on that. ISRO has done a great job. Right, 50 years, but ISRO is alone in this. ISRO should not do this alone. I think a company like Astrobase should complement efforts.
So you have unveiled the first engine, and when is the engine going to power its first rocket, and what does the commercial roadmap look like?
Right now, this engine, we are already in the active firing campaign. We should be able to fire this within a couple of months. I mean, within 2026 at best. I mean, that's a good estimate from, and 2028 December is when we are targeting our first flight that is powered by 4 of these engines, and eventually scale the size of the flight from there.
Rocket building is a capital intensive business. So how much have you invested so far in this? And before deployment, how much additional capital are you planning to deploy?
I started with my own couple of $1 million, but then we raised some funding. We have not disclosed all of it. And I think we'll disclose this in time.
Okay.
Yeah, but we are very well capitalized.
So far, only American and Chinese companies have built this kind of engine, and India is now joining the race. But are you in talks with any government agencies or any launch companies that will use this engine?
Yes, we are. Definitely we are. I cannot disclose this, but this is the engine that everybody wants. So it's up to us to decide whom to sell, whom to not. That is the reality. Yeah. But we cannot sell to anyone because there are a lot of restrictions when it comes to engine exports. But we are in talks. Definitely we are in talks. But our objective is not to sell engines really. That's at best like a side business it can be. But these engines are very strategic in nature. Once whoever owns the engines owns the launch, and whoever owns the launch owns the space, right? So we want to do that rather than sell the engines.
How many engines are you planning to build going ahead?
By the time we fly first, we'll have 20 engines ready, all tested in the stock. Our initial flights will take 5 engines each. So for 4 flights, we should have that stock. And by that time, we'll also establish the capacity to build 50 engines per annum.
Any timeline for that?
2028. Right now, 2 are in production already. By mid next year, we'll have 3 more, right? And then we'll expand the capacity and take it to 50 engines per annum production.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates on the other side. Stay tuned.
Hello and welcome. You're watching Global Lens with me, Archana Solanki. We are kickstarting this brand new week with this top story. Now, is India staring at 100% US tariffs? Let's understand in detail. The US Senate has voted overwhelmingly to approve a bill to punish Russia and key buyers of its petroleum products such as China and India, claiming that such trade helps fuel the Ukraine war. Now, the Lindsey Graham sanctions bill targeting Russia has cleared the US Senate with an overwhelming 86-11 vote. So what happens next? If the bill becomes law, it would empower US President Donald Trump to impose additional tariffs of up to 100% on countries buying Russian energy. This measure would take effect 30 days after the law is enacted, and that puts India in the spotlight. Now, India has increased its purchases of Russian oil since the Iran war, partly to diversify its energy supplies and lower its import bill. But India is not the only country in the crosshairs. Other major buyers named in the bill include China, Azerbaijan, Hungary, and Slovakia. India is the second largest buyer of the Russian oil on that list. For India, this is not new. Remember, Washington has been threatening India with tariffs over its purchases of Russian oil for some time now. The US previously penalized India with additional tariffs in July 2025, before withdrawing them in February this year. And the latest data just goes on to show how much India has shifted towards Russian crude. According to Reuters, India's oil imports from West Asia fell by about 27% to 1.55 million barrels per day between April and June and the first quarter of this fiscal year. In contrast, imports from Russia rose 8.3% to 2.26 million barrels a day. Now, last month, India's Russian oil imports surged to a record 2.64 million barrels a day. That was up nearly 37% from May and accounted for about half of India's total oil imports of 5.24 million barrels a day. Meanwhile, India's imports of Russian crude oil rose to a record for the second consecutive month in July. According to data compiled by the Center for Research on Energy and Clean Air, India's Russian crude imports rose 2.1% in July compared with June. All right, Pramit Pal Chaudhary, India Practice Head, Eurasia Group, joins us on the broadcast. Pramit, thank you so much for making time and speaking with CNBC TV 18. The big headline, the US Senate has passed a bill that could once again see a massive tariff of up to 100% being levied on India for its import of Russian oil. The question is, how vulnerable is India? Because we are the second largest buyer of Russian crude if this indeed becomes a law.
So there are a couple of points you made. One, the law still has to pass through the House. It still has to get the signature of the president. So you're really looking at a law, given that America will go into holiday and then the Congress goes into recess, that you're probably looking as late as September, maybe even October. And if they don't get it done by Thanksgiving, even into December, before it actually becomes law. That's one. Second, we never used to buy Russian oil before the Ukraine war. So it's not as if India has had a long-standing dependence or requirement for Russian oil. We got our oil from other parts of the world. And Russia has a specific viscosity. It's a medium-heavy crude is what we buy from them. We are now getting a similar kind of crude from Venezuela. There is no shortage of oil in the world, so we can switch quite easily to another part of the world. Third, what we do with a lot of that Russian oil is we convert that into diesel. Because of the heavy nature of that crude, it tends to be mixed with light crude from the Gulf and then re-exported to other parts of the world, or a large portion of it. Some of it we consume domestically, but the bulk of it is exported. Who do we export that to? We export the diesel to the West, especially Europe, and some of it to the United States. So we and China together refine the heavy crude from Russia and export it to the West. So if the West decides to say, if we decide to stop buying Russian oil, we will, in theory, the countries that will be most affected will be the West. Bloomberg has already mentioned that in an article that Europe is now looking at a potential shortage of diesel for their winter. Because without Russian crude, Russian diesel refining capacity, and if India is sanctioned and China is sanctioned, there will be not enough diesel in the West to run their trucks, run their generators the winter. So there's a limit to how far this can go.
Right. Well, we understand that there's time for this and there's a whole process involved before this becomes law. But if hypothetically, if New Delhi asks for exemptions, what do you think? Will the White House agree, or could that be used as leverage in the ongoing trade talks?
Well, it can be used for leverage for two reasons. One is that Russia is not doing well on the war front. So there is a sense in the West that given enough pressure, a possibility of a ceasefire or even a peace agreement in Ukraine is possible. So therefore, unsurprisingly, given how important that war is for them, they're looking at piling up the pressure as much as possible. Yes, would America potentially use this as part of the FTA? I think that is perfectly possible. India has basically stalled on the FTA, saying in effect, saying we're perfectly fine with the status quo of 10% tariff. And you seem to be Washington is having problems getting a legal basis for higher tariffs to be applied. If President Trump is suitably moved by that, he seems to have lost interest in the Indian FTA. Potentially he could use this as a pressure point. But has India gotten exemptions before? And the answer is yes, partly because of this issue of diesel, and partly because if a large chunk of global oil Russian oil combined with what is already being lost via the Straits of Hormuz, the price of oil could potentially rise and probably would rise up in the United States as well. And if it's just before the midterm elections in November, this would be something that the White House would be, I suspect, very reluctant to impose.
Right. Ms. Chaudhary, you made a very important point that the West is also going to suffer if this becomes law. And, with fuel supply already impacted by the West Asian crisis, with the U.S. now trying to get rid of Russian oil out of the market, what kind of impact do you see on the rest of the world?
Well, global oil prices are generally linked together. So it doesn't matter if you happen to be in a part of the world which has surplus oil. If oil elsewhere in the planet goes into shortage or there's a crisis, you will find pump prices in your region, in your neighborhood rising. So that is exactly the problem for the United States. It is by far now the world's largest hydrocarbon producer. It produces more natural gas than the next two countries put together. It produces more oil than Saudi Arabia or Russia, but it doesn't make any difference if Gulf and Russian oil were to go off the market in sufficient quantities. The price of oil in the United States would rise. And as I mentioned specifically, diesel, America does not produce enough of diesel for itself. Its oil is largely sweet, light crude. It is a deficit in refining capacity. So no matter what it does, diesel prices will rise.
Right. Pramit, one final question, and this is about diplomacy and foreign policy. Do you think these constant threats of tariffs make it impossible for India to maintain a balanced foreign policy between the US and Russia?
Well, there are two very different relationships. The relationship with America remains a very strong economic relationship, even with all of our problems with President Trump, not so much the United States. America is our biggest FDI source, our biggest remittance source, our biggest FII source, and and alternates with China as our biggest trading partner. The Russia relationship is much, much smaller. It is basically about a few commodities, important ones, oil, urea, diamonds, a few other things, and weapons. And that the weapon part of that is shrinking dramatically. So it's very different there. The Russian relationship is a strategic one. We need to keep a balance of power in the Eurasian continent that is not aimed at India. In other words, when India and China go head to head, Russia must remain neutral in the same way that Iran must remain neutral when India and Pakistan go to head. That's a strategic relationship with a minimal economic quotient to it. Traditionally, the United States has not been overly concerned about a Russia relationship, but the Ukraine war has kind of changed that. But the issue is Trump is whimsical. He likes Vladimir Putin for some strange reason, given what he is. And he seems to go back and forth about Ukraine. So I think that in the end, what we will be looking at is an America that will eventually come to some kind of understanding with Russia, in part because what is happening on the battlefront in Ukraine is increasingly pointing to some kind of a ceasefire.
All right, that explains well. Thank you so much, Pramit Pal Chaudhary, for making time and speaking with CNBC TV 18 on this.
Thank you.
Meanwhile, the Petroleum Ministry, in a reply in Rajya Sabha, said that India has significantly diversified its crude oil sourcing. The number of countries India sources crude from has risen from 27 to 41. LNG sourcing has also expanded from 6 countries to 15. It's also reduced India's dependence on any single country, region or transit route. Moving on to the Russia-Ukraine war, at least 12 people have been killed and 39 injured in a Ukrainian drone strike on a region in central Russia. The attack targeted an industrial area near a major oil facility, making it one of the deadliest Ukraine strikes on Russia. Meanwhile, a Russian strike in northeastern Ukraine killed 5 people. The UN has warned that long-range strikes by both sides have intensified this year, resulting in a rise in civilian casualties. Israeli Prime Minister Benjamin Netanyahu has rejected US President Donald Trump's latest 15-point plan for Gaza in televised remarks. He said that Israeli forces will not withdraw from the enclave until Hamas is genuinely disarmed. Now, Trump's Board of Peace said last month it had reached an agreement for the complete disarmament of Hamas. However, Hamas said handing over its heavy weapons was contingent on Israel withdrawing its forces from Gaza.
The 15-point plan. I heard that there were those who said you didn't say it, but we did say it. And here, I am saying it again. Israel rejects 15-point plan. The IDF will not carry out any withdrawal until the dismantling of Hamas and its weapons. And when I say dismantling Hamas and its weapons, that means heavy weaponry, less heavy weaponry, and smaller arms. All weaponry. We're talking about a true dismantling, not a fictitious dismantling. We're now speaking with the Americans about this subject. They have ideas. Some of them are acceptable to us, and some are unacceptable to us.
All right, let's get the latest from the West Asia war. US President Donald Trump is signaling that Washington could be looking at imposing further economic pressure on Iran. Trump says that Washington is only semi-negotiating with Tehran. In an interview with Axios, Trump says Washington is watching Iran's economic situation, including its high inflation and lack of funds. He also said the US naval blockade in the Strait of Hormuz has left Iran in a very bad shape. Meanwhile, Iran's National Security Council has laid out 6 conditions for reopening the Strait of Hormuz. The demands include an end to US threats against Iran, a halt to military action against Iran and its regional allies, and the withdrawal of US naval and air force involved in the blockade. Now, Iran has also demanded compensation for damage caused during the conflict, among other conditions. Meanwhile, reports say the official who issued the demands has now been replaced. Mohsen Razai has reportedly replaced Mohammad Bagher Zolagdar, who had been appointed to the role only in March. Razai was already part of Supreme Leader Ayatollah Mojtaba Khamenei's inner circle, serving as his military advisor. The new appointment elevates Razai into one of the regime's most influential positions. Now, Iranian Foreign Minister Abbas Araghchi, meanwhile, says there are no direct talks with the US. He added that negotiations with Oman are continuing over Hormuz. On the other side, Yemen's Houthi militants launched missile and drone attacks near Al-Makha port over the weekend. At least 7 people were killed in these attacks. The Houthis claimed they were targeting Saudi interests in the region. The UAE, meanwhile, condemned what it called a hostile Iranian attack on an ADNOC vessel in Hormuz and in the oil market. Now, let's talk about the oil. Brent crude is trading around the $85 a barrel mark amid continuing tensions and uncertainty.
Our negotiations with Oman concern the establishment of new maritime routes through the Strait of Hormuz. These talks have progressed well, and I can say that we are in the final stages. The old routes will be replaced with new ones. Experts are currently working on the maps. This, however, does not mean that the Strait of Hormuz will be reopened. An agreement on the routes may be reached, but reopening the Strait of Hormuz depends on a separate set of conditions being met, and those conditions are being conveyed through intermediaries.
All right, on that note, we'll take a short break. Coming up, Unitree becomes China's first humanoid robot maker to go public. On the other side, we look at the company's evolution and its journey to the stock market. Stay tuned. India and Bangladesh ties have come under the spotlight as Indian High Commissioner Dinesh Trivedi met with Bangladesh Prime Minister Tariq Rahman today. The meeting comes amid a fresh strain over former Prime Minister Sheikh Hasina's presence in India. Dhaka has again pushed for her extradition, while both sides have stressed the need for dialogue and a conducive environment to strengthen bilateral ties. Now, Damascus and Moscow have reached an agreement on Russia's 2 military bases in Syria. Under the new arrangement, Syria will take control of the civilian facilities, while the military sites will be turned into joint training and capacity building centers. Syria's foreign ministry says the handover must be completed within 3 months. The agreement follows about 18 months of negotiations since President Bashar al-Assad was toppled in December 2024. More than 1 million people have been evacuated across eastern China as Typhoon Dolphin made landfall, bringing heavy rain and widespread disruption. In Shanghai, nearly 1,000 flights were cancelled, while transport services were also affected across the region. The storm has now weakened to a tropical storm, but authorities continue to warn of flooding and possible landslides. Now, Western Europe has recorded its hottest June and July on record as climate change fuels an intense summer of heat. Now, drought and wildfires across the region. The EU's Copernicus Climate Change Service says average temperature for the 2 months reached 21.62 degrees Celsius, surpassing the previous record set in 2022. Dry conditions have gripped France, Spain, Austria, Hungary, the UK and Ireland. A state of emergency has been declared in Western Canada as thousands flee a fast-moving wildfire in British Columbia. The Bald Range fire has doubled in size since Friday, now burning across 136 square kilometers. Police say 1 person has died, with Summerlin and surrounding areas among those affected. Moving on, the U.S. economy lost 23,000 jobs in July, raising concerns that the labor market has yet to stabilize after 4 months of positive job growth. This comes as a surprise, with economists expecting the economy to add 83,000 jobs, up from 57,000 in June. Despite the weaker than expected numbers, Kevin Hassett of the U.S. National Economic Council says the economy remains strong.
Right. Well, first of all, with respect to the jobs number, as you mentioned, it was negative, but there were a couple of special factors. The consensus was it would be plus 88,000, which I think is consistent with everything else we've seen, which means it's a pretty strong economy. And the reason it got negative was there was a big decline in government workers and people who were leaving hospitality because of the World Cup. And so if you think it's an 88,000 number, then you'd have to say that all the other signals like booming investment, booming wages, incredible factory construction, 85,000 construction workers now building factories when it was about 0 when President Trump took office. All of that says really strong economy. But if I were at the Fed, we respect their independent. I respect they're going to look at the data and do what they think is right. That this is all supply side stuff, which should increase supply, put downward pressure on prices. It's not a Phillips curve kind of thing where there's government throwing money at things and that's creating jobs. And so if I were at the Fed right now, I would either hold steady or cut rates because there's so much supply side momentum.
Can you understand, though, Kevin, the concerns about surrounding Fed credibility? These reports that he and Kevin Warsh have had several meetings together.
Well, the president and Kevin Warsh have been talking together for 20 years. I've been friends with both of them for a very long time. The president trusts his judgment. Kevin is the new chair. He's got some members that agree with him on everything, perhaps, and some that don't, and they have lively debates, and that's the way the Fed is supposed to be. Kevin Warsh is as independent as it comes. If the president were to tell him to do something, he wouldn't do it, but he would argue about why he's not doing it if he thought it was the wrong thing to do. And so I think that those conversations are productive. I think that Kevin Warsh has conversations with the Treasury Secretary and with me, and that's so that we all have an understanding about what's going on in the economy that's consistent across agencies.
The U.S. is deepening its push to secure critical mineral supplies. The Pentagon has committed a $400 million conditional loan to an Australian company to develop the world's first primary scandium mine. Now, the project in New South Wales is aimed at reducing Western dependence on China, which dominates global scandium supply and processing. Well, scandium is critical for defense, aerospace, and advanced technologies. A former lawmaker has been arrested after allegedly shooting dead a senior official inside a government office near Bangkok in Thailand. The victim was shot in the neck and later died in the hospital. His driver was also injured in the attack. The incident comes days after a deadly school shooting in Thailand. Now, do you remember those viral Chinese robots doing backflips or boxing each other at tech expos? Well, Unitree, the company behind them, is stepping into a very human arena, the stock market. Well, founded in 2016 by engineer Wang Xinjing in Hangzhou, Unitree started out making relatively affordable four-legged robot dogs. A decade later, it's set to be mainland China's first publicly listed humanoid robot maker. Now, the company has raised about $904 million by selling 40.4 million shares through its IPO, valuing it at roughly $9 billion. The stock debuts on Shanghai's Star Market this month, and retail investors have piled in, oversubscribing the offering by more than 8,000 times. But here's the part that makes Unitree stand out. This isn't just a futuristic robotic startup burning cash while promising robots someday. In 2025, Unitree shipped roughly 5,500 humanoids units, more than any other manufacturer worldwide. It raked in about $235 million in total revenue. Now, why does this listing matter? Well, it puts a real public price tag on embodied AI. Machines that don't just